Hi, and welcome to ABG's Investor Days. In total, 59 companies will present over 2 days, which is a record number of companies participating. Each company presentation will be followed by Q&A from the analyst, and this event is live streamed but can also be watched afterwards on Introduce. My name is Anna Denfors, and I'm a retail equity analyst here at ABG. With me today, I have Fiskars Group's Christian Tammela, who is Director of Investor Relations. So please go ahead, Christian, with your presentation.
Thank you, Anna. Let's get started. If you switch the slide, please. First of all, Fiskars Group is a global lifestyle company. We are present with our own operations in 30 countries, and our products are sold in more than 100 countries globally. Our most important markets are Northern and Central Europe, of course, North America, Japan, Australia, and China. So those are really the key markets for us. And actually, the most single largest market for us is the US. So that constitutes of close to 40% of our net sales. And I actually argue that there aren't that many big Nordic consumer goods companies with such a huge share of business in the US. So that's a really important market for us. We are based in Finland, but Finland is less than 9% of our net sales. So it's still an important market, but it's not that big. We have a unique portfolio of much loved brands. And if we actually switch slides, then we can see, and here we have them. So Fiskars is the most important brand for us, and but there are a lot of other brands that are familiar to, I'd argue, most of you here on the line. So in the Nordics, we have a lot of local brands that are their heritage in the Nordics that we have now brought forward to other markets as well and expanded. Why do we have these kind of many brands? One key reason is that if we take, for example, the tableware category, then actually, if we look at different countries globally, the consumers' tastes and preferences vary a lot. So just as an example, the kind of style that Iittala has is really kind of simple and clear-lined and sleek. That's really sought after, especially in the Nordics and Japan. But then, for example, that's not a brand that has a really high demand in, for example, China. So the Chinese preferences vary a lot and are very different, and therefore we have a big portfolio that we can cater different kinds of needs and preferences all over the world. And our brand portfolio and brands, that's what the consumer sees, but that's not the way that we drive our business. So if we go to the next slide and go a bit more into detail on that. So we drive our business through 3 different business areas, and these are all P&L responsibilities that they have. So they are really responsible for all the decisions that they have within their mandate. The kind of the different BAs are categorized by category. So Vita provides products for tableware, drinkware, and interior categories, and then they can choose which brands they use to do that and what kind of product offering they have. Iittala, Copenhagen, Waterford, Wedgwood, and now Moomin as a new one are the most important brands here, and I'll get back to Moomin a bit later. Terra takes care of gardening, outdoor and watering categories, and then Crea has this scissors and creating and cooking. So that includes our really famous classic scissors that have been sold over 1 billion pairs since they were created back in the days. If we look at the BA by size, you can see that Vita and Terra are roughly equal size in terms of net sales, whereas Crea is much smaller. But then if we look at EBITDA, which is the measure for profitability that we use, you can actually see that Crea is by far the most profitable business that we have. So this is the way that we look at the business when we talk about it. We had a Capital Markets Day approximately 1 month ago, and in that event, we launched a new strategy. And if we go to the next slide, I'll discuss a bit more about that. So the logic in our strategy is to focus on winning brands, channels, and countries. So it's all about focusing on where we are strong already and where we can improve even more. Within these, there are 4 important parts that are especially biggest ones driving our change in the next 4 years period. Commercial excellence, it's a lot about what kind of pricing, what products do we have in which categories, who do we work with, how is our brands visible to the consumers, and all these really basic things that we see that we have a lot of improvement potential going forward. Direct to consumer is nothing new as such. We have a lot of own stores. We have roughly 360 own stores, most of them in Asia. We have, for a lot of brands, we have our own e-commerce sites, but there's still a lot that we can improve in this field going forward. And then with regards to markets, US, as I said, is the biggest market already for us, but there's a lot that we can do to improve and grow there. For example, we don't have all products that we have in Europe, we don't sell currently in the US. So that's one example of what we can do going forward. And then China as a second really important lever for the growth story going forward. But then I'll just give you a few examples on where we see growth potentials. If we first go to talk about brands, go to the next slide, please. So Fiskars is our #1 brand. It's a global brand with it's a strong recognition. Its performance has been really strong. So it's about 40% of our net sales, and it has grown now for the last 4 years about 7% annually, and that's much more than the group average has done. We still see a lot of potential. So as I said, not the full portfolio isn't sold in all markets at the moment, and this is a really good example when it comes to Fiskars. So for example, this picture that we have here about the Norden cooking series, the kind of high-end cooking series, the cooking products are not sold currently at all in the US. Those are only sold mostly in the Nordics and Germany. So that's really a big lever for us going forward. Last summer, we launched a clothing range. That was kind of more of a marketing activity than and it was like a one-time event. And what we wanted to do is to see how kind of well the brand stretches and what kind of a welcoming does it have on the market. And it was really, really good. It was a big success. We gained a lot of publicity in a lot of different really big media globally. So that just shows us that while that might not be the most important channel or category for us to grow going forward, the Fiskars brand is capable of much more than it currently is offering. And that gives us really a lot of confidence in the ability to grow that brand. And it has really been rewarded in design. We had getting a lot of Red Dot awards. For example, the Fiskars product development team was chosen the team of the year in 2020, and previously that award has gone to teams such as Ferrari and Apple. So in really good company here. All right, if we move forward. Another way to build brands and to grow going forward is case Moomin. So that's kind of a new way to think about how we work. So we don't own the Moomin brands as such, but we have become in this fall a minority shareholder in Rights and Brands, which owns the rights to the Moomins, but also a lot of other characters and figures. So just some from the So they have a big portfolio, for example, of Astrid Lindgren characters. Currently, our net sales from these products, there are really not that many products that we sell. It's kind of limited offering from Moomin. We sell about 30 million worth on an annual basis. Now that we have this strategic partnership, that opens up a lot of doors for us to grow this business. So, for example, we can take it to new markets that there hasn't been sold previously. We can also, going forward, have the option to expand the product offering that we have. So we see really a lot of potential to improve this, and this cooperation is a really good new field for us to grow. All right, if we then go forward, as I said, the direct-to-consumer is important for basically all consumer goods companies nowadays. And such it's also for us. We really need to win in the channel shift, so we really focus on the direct channel, and that includes both the e-commerce as well as own stores. Obviously, a majority of our sales at the moment comes from partners, so it's not our own direct business. Our own direct business is really significant in the Vita business area, but not in the other ones yet that much. But it's growing in all, and it's more and more important. It's actually for many reasons. First of all, I mean, it's profitable business, but it's also a way to build the brands. And we also gain a lot of data on how consumers behave, what the kind of consumer preferences develop. So in such, it's really important for us to have a connection with the consumers, and therefore we're going to invest more in it going forward. We have grown our store base, not in all markets. In some we have actually reduced it, but for example in China, we are growing the amount of stores quite significantly. Talking about China, if we move to the next slide, China currently is not that big of a market for us. It's a few percentage of our net sales. But as you can see here, it has been growing really rapidly since we made the decision to really focus on China. And we see a lot of potential, so this is just the beginning. It's a market with strong demand. And interestingly enough, while we talk about tableware, you actually often talk about China, because that's kind of where the origins of these products. But then at the same time, branded tableware hasn't been that big of a thing in China in the past. And now that's kind of changing, and we are really in a strong position to benefit from that. We have a super local team, and they have a strong track record, as you can see here. And having a strong local team is really important, especially in China, because the market characteristics are so different from the Western countries, for example, in many ways, and therefore that's really crucial for our success. They have been able to grow quickly, and e-commerce is a main channel, I'd say, with up to 40% of our current net sales coming from e-com. Currently, we are selling mostly Wedgwood, so that's most of the growth here you can see is just from the Wedgwood brand. We have just in this year introduced Royal Copenhagen to the market. We only have a 1 or 2 stores at the moment by Royal Copenhagen. I think the second one is just about to open or has just opened. And all of the other 20 plus stores that we have are basically Wedgwood. So Royal Copenhagen is the next step that we are taking. And then obviously we are also thinking about what other brands we can introduce to the Chinese market going forward. But this is really a big growth opportunity that we have. So, and we see that over the kind of years, China has the potential to maybe not be the biggest of our markets. That's a far stretch to get close to the US share, but it can still be in our top 3 markets within some years from now. So really seeing a lot of strong growth there also in the going forward. All right, so with all these levers that we have and where we are focusing, I see a lot of growth potentials. That also boils down to new financial targets. So if we can switch slides, we introduced new financial targets a month ago in conjunction with the Capital Markets Day. We aim to grow organically by 5% a year. We aim to have a 15% EBIT margins, excluding items affecting comparability, by the end of 25. Then we have targets for cash flow conversion, so that we are able to invest and we're able to pay dividends. At the same time, we have a balance sheet measure here, net debt to EBITDA, to make sure that we don't, not over levered. And then our 5th target is the dividend, which is unchanged from what it was previously. If you go to the next slide, then to look about our figures. So Fiskars Group has had in recent years challenges, mainly related to top line. So that's why I'm talking so much about net sales growth, because that's what we really need to turn around and get on a track. We have now been growing for 6 quarters in a row, and it's really important for us to keep that momentum strong and growing also going forward. As you can see now, comparing Q1 to Q3 this year to last year, we've been able to grow some 12% now, and that strong growth is something that we, as I said, we want to keep on going forward as well. We're also able to improve gross margin, and that's a really important factor for us to create this 15% EBIT margin. A main driver for that is expected to be an improvement in gross margin. If we then look at how our profitability has developed, on next slide, please. You can see this is comparable EBITDA. So 2019 was a really difficult year for us, but otherwise we've been on an improvement track for quite some time already. And this year that is set to continue. During the first 3 quarters of the year, we made almost as much money as we did in full 2020. And now we expect in our outlook that we reach somewhere between 160 and 170 euros in comparable EBITDA. So that would be quite a big step up from 2020. Also here, we must make sure that our good momentum continues going forward as well. And if we then look at our dividends, next slide please, here, you can see we had a long growth of dividends here. We then distributed in for the year 2018 in 2019 a really big share of Wärtsilä shares to our shareholders, and that made us a clean consumer goods company, as we now gotten rid of all non-core holdings and assets. So now we are a full consumer goods company, and we've been able to get back to the dividend growth. We needed to decrease the share of basic dividends due to the fact that we had previously gained some from Wärtsilä. And now that we gotten rid of that, we didn't get that money from Wärtsilä anymore. But now we're back on the growth track, and as I said, our target is to have a stable, over time increasing dividend, which is paid biannually. This is all for me today, and now I think we have time for some questions.
Yes, so thank you for a really good and interesting presentation, Christian. I have prepared some questions here, and I think one thing that many companies is struggling with today, and something that everyone wants to know more about, is supply shortage and also increased input materials that many companies have been struggling with. So how have Fiskars experienced this, and what is your outlook ahead?
Yeah, that's true. That's a really big theme, and you can't really miss that. What comes to the supply chain, obviously we have not been unaffected by the fact that it's been really difficult at sometimes to get capacity, containers, and all that. However, we've actually not been that significantly affected by it. So we actually been gaining market share from the fact that we have been able to deliver better than many of our competitors. Not all, many others have also been performing well, but it has been really a major factor in a positive way for us that we've been able to mostly provide the products. A few years ago, thinking back, that you say that a competitive advantage was that you actually just were able to ship products. Sounded kind of funny, but actually now that's the case. So we've been able to mitigate that in a really good way. What comes to the price inflation, we are fairly confident with that we are able to get that through to end user prices, so that we are able to pass on the rising costs. For some products and some accounts, there's some lag between, because the inflation has been so rapid, so that we haven't immediately been able to transfer everything on to the prices for end user prices, but that's coming. So we are not. It's more of a timing issue in some extent for some products. For most products, we are able to get it done already. So we're in a fairly good position when it comes to inflation.
That's good to hear. And I also think another question that would be interesting to hear you answer and reflect about is that Fiskars have previously been active in the M&A and also divestment space. And if you look at your balance sheet, it's currently very strong. So what is your outlook on the M&A landscape, and do you have any potential prospects in the pipeline? And let's elaborate a little bit more on that.
Yeah, as you said, we target now a net debt to EBITDA factor of less than 2.5 times, and currently we are something like 0.4 or something like that. So we are really low at the moment, and typically Q4 is a cash flow strong quarter for us. So that might, if we don't look at leasing liabilities, that would actually put us close to zero net debt in financial terms. So that means that we have a lot of room for actions if we decide to do so. The most important thing to understand is that we are open for M&A, absolutely, but our by far most important factor for us to do now is to create organic growth. So that's kind of really a clear number one priority for us. And but we don't want to exclude anything, but because the nature of M&A is that we might have a good case knocking on our door anytime that you can't plan it in advance, and then you just have to be ready to take action once that opportunity arises. So we're not actively trying to get any cases at the moment, but we are not excluding that. So organic growth first and foremost. That's the most important thing. Obviously, we have a set of companies that we are interested in, but obviously we can't disclose what kind of list that is. But yes, there are more and less interesting cases out there.
No, that's understandable, Christian, of course. And let's continue a little bit with the organic growth. And I mean, if you look at your business areas, the Vita area, business area, has obviously performed strong and showed an increased growth. So what has been the main growth driver behind the growth in the Vita segments?
Vita is first and foremost, I mean, it's been somewhat of a turnaround now that we have these programs that are ending, that are designed to improve the performance, in particular of the Vita segment. But that's obviously not, that's about profitability, not so much about growth. Vita has been able to grow better now during the pandemic, we had a lot of store closures that had a negative impact. So that kind of rebound from that is positive. Then, for example, the entire China growth story is about Vita at the moment. So everything that positive that goes on there is just about Vita. And we were able to improve our brands, make them much more attractive for consumers. You know, Wedgwood as a good example that we have put in a lot of work in recent years, and that's really paying off now. And the same is now next coming up for Waterford. So just the overall improved performance and our actions are really showing results, and that's kind of the main driver there.
Yes, thank you, Christian. And I think we have time for one more question before we have to wrap it up. So let's finish off with a more long-term or sustainable outlook on the home consumer market. I mean, you have obviously seen some effects from the pandemic as many other companies as well. And what is your current outlook and how is your feeling about the home consumer market right now? And are there any specific trends that we should keep in mind going forward?
Yeah, what comes to the pandemic, obviously, it's really difficult to see what's going on to happen going forward. There's been a lot of normalization, especially when it comes to the US. So the US saw really strong growth during the pandemic in many of our categories, and that has kind of leveled off already. I think that most people or players in the market have think that kind of the demand has remained at a higher level than it was previously, and I guess that's a lot about people's renewed focus and the want to invest in their homes and gardens and all that. So there's more interest in having or you know the interest towards these areas is now higher. I wouldn't say structurally that's kind of a strong statement, but at the moment at least it has kept up really well, and so we are really positive on that outlook going forward. Obviously, there's going to be even more normalization once at some point we get more to a freer or pandemic-free world, and people start traveling more. But the kind of the drivers are in place, and people are really enjoying their homes. We are also focusing in our strategy really on the US and China, as I said, and here the demographics and also the kind of structural demand drivers are in place, and we are really set to benefit from those going forward.
Yeah. Okay, thank you so much, Christian. Unfortunately, we don't have time for more questions, but thank you for participating today, and thank you everyone who listened into Fiskars. We will continue our day with many more presentations, so thank you.
Thank you.
Welcome back. My name is Simon Johnson, and I'm an analyst covering tech and gaming here at ABG. Next up, we have Stefan Tengvall, the CEO of Fragbite. Stefan will hold a presentation of the company, after which I will host a short Q&A. So Stefan, the floor is yours.
Thank you very much. So let's go to the next slide, please. We have a quick or a short agenda, so with different topics, so we can take next slide. So welcome and happy for you to sort of listening to 20 minutes of Fragbite presentation. We're a fast-growing, profitable, and cash flow positive group working within esports and gaming, and sort of combining this experience we have in this field and bundle our sort of offer towards digital entertainment. We're organized in three different business units: mobile gaming, publishing and indie games, and esports, but also have an additional strategic focus when it comes to M&A. I'll come back to a little bit later about that. We're 60 people, sort of growing the organization continuously, significantly within both publishing and indie games business unit, but also within our M&A efforts and focuses. If we just quickly start to the bottom right when it comes to M&A, we have a strong pipeline, a strong cash position, and some really interesting prospect that we're evaluating and in quite sort of interesting discussions. Within mobile gaming, to the upper right, we develop our own gaming engines, two gaming engines, one war strategy game engines, which is scalable, where we can sort of release new continuous titles. Our mobile and publishing operations, we're having 16 titles. That's mostly pay-to-play games, so you will have to pay to download the games. Driven and experienced founders within this operation, where we also sort of publish the games on 15 different platforms around the globe. Within esports, we're running the biggest one, or a few. We're running the biggest tournaments in the Nordics, and also sort of have a scalable business model, and run one of the biggest communities within esports in Nordics. We can take next slides, please. The group was founded in 2015, and as you can see, I joined the business 2 years ago in the beginning of 2020, and the board revised the strategy of the business at that time, and we also sort of started our acquisition journey, where we've so far made 3 acquisitions, and to date 3 acquisitions. This year, 2 acquisitions in Playdigious and Fragbite. We'll talk a little bit more about these companies on the next slides. And as you know, then we also went IPO in the summer. The main reason for IPO is, of course, to use our own shares as part of the consideration when we sort of acquire more companies in the future. Next slide, please. Quickly about the mobile market, or the games, global games market. It's a $175 billion market, huge market. It's decreased a little bit in 2021 compared to the previous year. 1% less is the entire market. But what's interesting to see is, and what I want to highlight on this picture quickly, is the fact that the segment that we're active in the mobile gaming, which is the dark blue and the less dark blue areas, is continue to gain market share and has about a little bit more than 50% of the entire games market. And this mobile gaming segment is also sort of generating the most profitability out of the industry. More than 70% of the total profitability in the gaming industry is generated by mobile games, sort of built for tablets and smartphones. About 1/3 of the world's population is gamers or plays some sort of game. Next slide, please. What are our sort of operations when it comes to mobile gaming? I mentioned we have one business unit publishing in indie games. We acquired Playdigious in end of May this year. Super solid entrepreneurs. They've done the sort of the journey with one more company before they sort of founded the Playdigious. I'm happy to have them on board, but they also sort of overperformed on more or less every parameter that we set when we acquired this business and what we see so far. I mentioned they have 16 titles, so this is quite low risk operations when it comes to mobile gaming, because they license existing titles and they publishing or sort of adapt this game to PC games to mobile games. So they adjust them and release them on mobile. That's verified and sort of proven games that we sort of launch on other platforms, which has been proven to be successful. I would say this is one of the top of mind publishing indie games publishers that IP holders would consider when they want to publish their games on a mobile platform. If we look at the activities, I mean, during the last half year or last quarter, Playdigious has one game which is called Playdigious, which is performing very well globally, but specifically in China, where they have been, on the top list. We sort of display on this slide a few, data points where they actually when it comes to downloads, more than 2 million downloads, payable downloads on this game, and also been the top mobile game in China. During the quarter, we also have one more title, Evoland 2, that was approved by the Chinese authorities to be released. It's quite an exclusive sort of group of games that are approved to be released in China, about 200 games per year. So very happy for actually having one more game released in China going forward. We also had a few updates of the existing games the previous sort of quarter. We can take next slide, please. When it comes to our mobile games, where we develop our own gaming engines and our own titles, we work when it comes to publishing of these games together with Tilting Point, which is one of the world's leading publishers. I would say top 3 or top 5. They have a fund of I think they raised $200 million in total, just for firepower when it comes to sort of marketing mobile games. We have, as I said, we have 2 scalable gaming engines in these operations or this business unit, where we continuously launch new titles. So we already launched a game called MMA Manager, where you are an owner of a gym and you recruit fighters and trainers, and then your fighters go and fight other players' fighters. We are releasing in a couple of weeks or next coming weeks the sequel of this game, which is called then MMA Manager Ultimate Fight. So before year end. We also release a new sequel our existing game called Capital War, which was released towards the Middle East version when it comes to our strategy, war strategy game. And we're releasing a Western version of this game called Army Battle, the coming, in near future. And of course, I said that we have scalable game engines, so we can continuously and will continuously and have in our plans to release more games on these scalable game engines. Next slide, please. If we spend some time on the esport market, this slide is just to show you quickly the importance of expanding our esport operations to outside the Nordics. So whatever parameter you look at on this slide, the Nordic market constitutes about 1 to 2% of the entire esport market. You can see that when it comes to enthusiasts and revenues, it's close to 2%, but when it comes to awareness and live streaming audience, it's about 1%. So it's very growing market, underlying growing parameters when it comes to esport, but the Nordic market where we're present is just a small piece of the entire global market. Next slide, please. If we look at the esport markets, it's way, lower than the gaming market. It's about, this year, it's a little bit more than $1 billion. Since 2019, it's grown 11%, but from now on into 2024, Newzoo expects the market or the total addressable market to grow about 16 to 17% per year. On the right side of the slide, you see the different segments of revenues, and you can see that sponsorship is way overrepresented of the total revenues in the industry. And I think this is the characteristic of a rather immature market. The esport market is rather immature when it comes to revenues, but you can see, so if you compare football or soccer towards esport, when it comes to media rights and ancillary sales and stuff like that, esports is rather, immature and hasn't been able to, so far, hasn't been able to successfully monetize on the giant audience and the crowd that actually followed the industry. But you can see that the fastest growing revenue streams is not sponsorship, but the other sort of revenue streams. Next slide, please. If we dive into what we are doing within esports, I told you we are one of the leading esport companies in the Nordic. We run our own leagues and own our own IPs. Frag League is one of the biggest esport tournaments in the Nordics, targeting amateurs or grassroots practitioners of the industry. So we offer everyone that wants to, esport to play on their capacity level in a professional manner with the professional broadcasting of the show with professional commentators. And of course, you have a huge if we look on the diagram to the right, you have a huge fan pool. We saw that on the previous page. And within the ecosystem, we are running the tournaments, but we also running a community, one of the biggest communities in the Nordic, with more than 200,000 followers on a monthly basis. And we our role we connect the amateur players, the sponsors, bringing in the sponsors, and also choose distribution platforms for where how to broadcast and how to distribute our the leagues and content that we produce in the industry. Also worth to highlight, so what you probably sort of read that we also press released it, is that we, together with the Swedish Chess Association, will build the first e-sport league when it comes to chess. And it's called the Svenska Schackligan. We will also partner with chess.com. And in this sort of partnership, chess.com will rather be the arena where sort of the distribution platform in order to reach as many fans and audience as possible for this league. But we will sort of be the organizer and also bringing in, you know, inviting players, but also bringing in sponsorships. More so if I do a comparison with Champions League, for example, chess.com would be the arena like Camp Nou or Old Trafford, and we would be FIFA organizing the entire tournament, and also selling all the sponsorships. Interesting to the left-right that we also sort of within our esports, we build the organization or the business unit on 4 pillars. Frag League, or the leagues that we run, or either white label, I've already touched upon. We drive our communities, leading communities in the Nordic. We also run our creative studios, where we build marketing materials and marketing concepts together with our sponsors. The esports industry is rather immature, so we need to help them build and and also sort of teach them how to address the rather sort of demanding fans, which is really young. 16 to 35 years old is overrepresented in the sort of target, in the audience compared to other sports. Next slide, please. I mentioned that one of our focus areas is, of course, acquisition. We're growing fast organically so far, and also and through acquisition, of course. But if you compare Q3 to Q2, we had a nice organic growth, but we have a focus area in recruiting or in acquiring strategic, profitable, strategic, and fast-growing companies with great entrepreneurs. And we're in great talks with, intensive talks with some of potential targets here. And why are we doing this? We will continue to grow organically, but of course we need to diversify. We want more titles and diversified risk in the business. We currently have 19 mobile titles, but also acquire potential, IPs, games that we can use in esport concepts going forward. This is a value creation, or this create shareholder value for sure. There's a piece of multiple arbitrage is a great opportunity to do that, and it will continue grow, target growth or continue drive growth through the company through these acquisitions. And as you know, we've done 3 so far, and we'll continue to work hard on this. Next slide, please. If we quickly highlight the Q3 and first 9 months, in terms of numbers, we sort of report revenues in Q3 of 44.1 million, which is a 35% organic growth from previous quarter, the second quarter this year. Total revenues pro forma, given that we estimate that we have owned the acquired companies from 1st of January is 99 million. And the adjusted EBITDA, or actually the reported EBITDA, was 2.9 million in Q3. And then we had 200K of one-off items during the quarter. So the adjusted EBITDA is 3.1. We have, as I mentioned, an underlying strong profitability and an underlying positive cash flow in the organization or in the group. And we have a lot of activities going forward with a lot of releases in plan, which I will touch upon next slide. We're well capitalized when we exited Q3. We had 69, close to 70 million cash in the bank account. And we also sort of recruited our CFO, Lars Johansson, very experienced both in M&A, but also listed CFO, as a CFO in listed companies. Next slide, please. Here we list 10 activities that will be released the coming 7 months, or during the end of this year and Q1 and Q2. It's new titles on our existing scalable game engines. It's new esport concept that will be launched. I told you we will launch Svenska Schackligan, the chess league, during December. But also when it comes to Q2, new announcements. We haven't announced the name of the titles, but promising titles that will be released by Playdigious during next year or end of first half of next year. So in total, 10 activities that we list for activities the coming 7 months. And this is not an exhaustive list. I hope that we can actually add more activities on this list. But it gives you a sort of understanding of there's a lot of activity in the group going on. Next slide, please. Quickly, financials. Next slide. I touched upon the fact that we reported in Q3 44.1 million SEK, and reported EBITDA of 2.9, and adjusted EBITDA of 3.1. When we go down to EBIT or net results, we have about 11 million of depreciation on goodwill every quarter. So that makes the net numbers 10 million or marginally more a negative. If we look, it doesn't give us a good, no meaning really to compare against previous years, since we done 2 major acquisitions during the year. So what I want to highlight is pro forma first 9 months revenues 99 million, and the underlying profitability of 3.5 when it comes to reported EBITDA, and the adjusted EBITDA 2.3. I think we can do a lot when it comes to revenue margins. As you can see, we have about 7 to 8% EBITDA margin currently. I think we'll work hard on this topic and how to sort of increase the profitability in each business unit. I think now we're about to launch a few new titles going forward. So that's one of the reasons we scaled down MMA Manager during this quarter and are just about to scale up. So in a little bit in the gap when it comes to that. Next slide, please. Quickly about the cash flow. Normally companies in our public companies talk about net debt. In this company, we talk about net cash position. So in total, we have about short of 70 million cash in the bank account, whereof 17 is bank debt. So our net cash position in the business is 52 million. but in total, close to 70 million cash in the bank account. And as you can see on the left side, our cash flow from operation and underlying cash flow is positive. Then we made some investments in acquisitions. Of course, that creates a negative cash flow. But apart from that, I'm in strong cash flow position. Next slide, please. Next slide, please. And just to sum up, so Fragbite Group, we're profitable, fast-growing, and cash flow positive company, offering digital entertainment, combining our experience within developing mobile games and esport, and we'll combine that. That creates, rather a unique position compared to competitors. I believe it's only us and MTG that actually combined esports and gaming in our offering. That's about it. We open up for questions. Thank you. Next slide.
Thank you, Stefan. I'm afraid we don't have time for any questions because the next presentation is coming up in just 2 minutes. But thank you so much for the presentation.
Okay, thank you.
Have a nice day.
Bye-bye.
Bye.
Hi all, and welcome to this presentation with Tethys Oil. My name is Carl Fredrik Schjøtt-Pedersen. I'm covering Tethys Oil from ABG. Presenting on behalf of Tethys Oil today is the CFO, Petter Hjertstedt. So without further ado, Petter, the floor is yours.
Thank you, Carl Fredrik. So today I have the pleasure of presenting Tethys Oil, an Oman-focused, debt-free, dividend-paying E&P company with focus on exploration, but with 11,300 barrels per day of production. And we have 5 blocks covering 50,000 square kilometers onshore in the Sultanate of Oman. Here's some quick facts over the company. We've been around since 2001. We're listed on the Stockholm Exchange, have a market cap of just above $200 million, almost $60 million in cash in the balance sheet, no debt, free cash flow positive for the first 9 months of the year, and 27 million barrels of 2P reserves, and a further 14 million barrels almost of contingent resources, all in our blocks onshore in Oman. So the core area is, since over 10 years, the Sultanate of Oman on the Arabian Peninsula. We have been there for 10 years. We have production experience, we have exploration experience, and we hold an interest in 4 different EPSAs, that is exploration and production sharing agreements, of which 1 is in production, and 3 others in the exploration phase. And the combined license area is corresponding to about 18% of the area of the Sultanate. Here's a map of the various concessions in the country. It is a very diverse group of oil companies active in the country. Everything from the majors such as Shell, BP, Eni, but also it's also a country friendly to smaller and junior companies such as Tethys. So it's a very open environment, and one of the few in the region that is open to companies of all sizes. So a bit more about Oman. It is on the tip of the Arabian Peninsula, outside the Persian Gulf, and has a production of about 1 million barrels per day. Is not a member of OPEC, but an active member of OPEC Plus, and it is a very open environment for companies such as ourselves. I can't actually see this presentation. Is it just blank? Okay, it's not supposed to be a blank. Okay, moving on. Right, we have our 4 licenses, blocks 3 and 4, where we have 30% non-operator. It's a production and license until 2040, and then we have our 3 exploration licenses, block 49, where we have just early this year drilled our first exploration well, completing the commitments of the first exploration period. And there we partner with the American onshore company EOG Resources. On Block 56, we are operators since earlier this year, and partners with a group including the 2 local players and the Indonesian conglomerate Medco. That's in its second period. And Block 58, we're in early stages. We're 100% interest holder and operator. Blocks 3 and 4 has really been the foundation of Tethys Oil's operations in Oman. It's been in production since 2010, and has had a production in excess of 13,000 barrels per day net to Tethys before limitations. Currently around 11,000 barrels per day. It's a light sweet crude, 39 degrees API, and currently have full activity on the blocks with 3 rigs actively drilling, actively shooting seismic, and exploring and developing simultaneously. We're also looking to utilize the gas, associated gas produced, and for power generation on the block. So a full scope project going on. I have blank slides here. I just have a set of blank slides. All right. Okay. Block 49, where we, as I said earlier, we drilled the first well, first exploration well earlier this year, the Thameen well. We encountered hydrocarbons, but no flow rates were established. After extensive analysis, we have concluded that it's most likely low permeability leading to a very tight reservoir and will need further stimulation to flow. And currently we are in negotiations or discussions with both the government and our partner EOG on next steps on how to pursue the most likely unconventional potential of the block. We farmed out to EOG earlier this year and got the exploration well carried, and we now look forward to the next phase of most likely unconventional exploration together with a expert in the field. Block 56 is a block with a variety of opportunities geologically. We are currently preparing to start drilling a 3-well program on an area called Al Jumd, where there has been extensive drilling and 3D seismic shot in the past. We see a potential of potentially establishing the commerciality of a number of leads and prospects in that area, starting with these 3 leads, and beyond that there are further 10. We see a good potential of that coming to development quite quickly if commerciality can be established. Aside from that, there is the central portion of the block, which we are currently shooting seismic or about to start shooting seismic, and which will most likely lead to drilling in the years to come. These are areas completely geologically independent of each other and shows the diversity of opportunity on the block. Block 58, we signed the license middle of last year in the middle of the pandemic. We have a 100% license interest. It's located to the south of Block 49 and the sort of southwestern part of the country, on the edge of the major block in the country, Block 6, which is held by the semi-state-owned PDO, and moves into that South Oman Salt Basin, which has been very prolific for PDO. And in an area that is new to us, but very familiar for Omani petroleum geology. There is plenty of data on the block, and we have 2 identified leads, and some already covered by 3D seismic, and one where we intend to shoot further 3D seismic to mature a prospect. Just some quick financial highlights from the past quarter. You can see we had free cash flow of $13 million, an achieved oil price of almost $67 per barrel, and an OPEX around $10 per barrel, and the average daily production of about 11,300. The achieved oil price reflects not the full potential of the oil, the spot price in the period, due to a lag in the pricing. 2-month lag in the pricing of oil sales out of Oman. So the higher oil prices we've seen during Q3 and Q4 will be realized with a few months delay. But still very healthy financials on base of good production and good oil prices. And our balance sheet is boringly solid, no debt, plenty of cash, and a strong equity position. This is despite actually distributing almost $16 million to shareholders earlier this year. So a good capacity to invest in our blocks, good capacity to distribute cash to shareholders, and still have a very solid balance sheet. So in conclusion, the investment case, I mean, we have a company with a strong production base, with very favorable terms in all our licenses across both production and exploration. With robust cash generation of $20 million year to date, cash balance of almost $60 million. We've been paying a dividend since 2015, is something we certainly strive to continue to. We have a very active work program across all our blocks with production drilling, exploration drilling, seismic, and plenty of news in the year to come, and plenty of activity that should be value creative. And we also have some exciting non-conventional potential on Block 49, which is a bit out of the ordinary for this part of the world, but certainly something we're very excited to be part of. And in this coming quarter, in this current quarter, or maybe even early next year, we expect to start our own drilling campaign on Block 56 to unlock the commercial potential of that Al-Jumd trend. And with that, I want to hand it back to you, Carl Fredrik.
Thank you, Petter. I'll kick off with a set of questions. So if we could start off with production, and Oman being partly limited in terms of production due to its affiliation with OPEC+. Your production has been very stable, but it has not grown as OPEC+ has been allowed to increase production levels. How is the relationship there, or how does it work when OPEC+ is easing the production cuts? Why doesn't that feed into your production numbers on a monthly basis?
That's a very good question, Carl Fredrik. I would say that the main consequence of OPEC+, apart from the very sharp drop in production back in 2020, was that we were put in a position where we essentially had to cut back investment significantly to be able to preserve the cash flow of the project. And that investment, of course, has remained low for a very long time, from mid Q2 of 2020, essentially through to almost mid-year of this year. And as that investment activity is now coming back and picking up again, well, only then can we see production coming back. So we have seen actually quite a lot of production coming on the back of what is essentially quite low investment for that block. So we expect investments to continue ramping up towards the end of this year and potentially even next year, and we should see the results in that in due course. But it is very much a function of investments.
And yesterday you published the production levels for October, which was down a fairly substantial amount relative to September. Is that kind of a temporary effect for that month only, or is it a reflection of?
Yeah, I think we guided in conjunction with the Q3 report that we expect production for the year to be at about 11,100 barrels per day. We ended the third quarter with 11,300 about. So clearly we are expecting a lower level during Q4, and that is in part the effect of this lower investment not yet materializing in production, and also some temporary difficulties in terms of the water handling and the changes in sort of shift in operations on the block as we ramp up. So we expect that to be overcome, coming back to sort of the levels previously seen quite soon, but growth will have to wait a bit further.
Oh, makes sense. And then historically, you have been able to, on a continuous basis, add more reserves to your reserve base, meaning that you have identified more volumes than what you have drilled and produced. What would this look like going forward? Do you have kind of, I guess, as volumes are at high levels, it's harder and harder to maintain a positive reserve replacement ratio. How should we think about that for the coming years? How confident are you in continuing to grow the reserve base?
Well, naturally, it always becomes more challenging as the comparative base grows. So having had that very strong track record for many years, we're very proud of that, but we do realize it does become increasingly challenging as the numbers become higher and the block matures. But I would say there's always been a multitude of sources boosting those reserves. I mean, it's everything from exploration leading to new discoveries, adding new reserves, but also in no small part, I mean, the performance of the existing fields has been a very important factor, and we continue to see a number of our fields continually performing better than expected. So I'm quite confident that over the years to come, we will continue to see very positive reserve replacement. But where exactly it will come from one year to the other, that's difficult to predict. And but we certainly see very good performance in many of our fields. We see lots of potential still on the blocks. We are coming back to full investment and full capacity in operations. We certainly see a good chance of unlocking that exploration potential in the years to come. The exact timing of which is sometimes difficult to predict, but I see no reason to be less confident in the long-term reserve trend for the license.
Then, before we move over to the balance sheet, drilling on Block 56, which is planned to commence now in Q4, I guess. We are in Q4, so hopefully it's right around the corner. Will you announce the spudding of the well, and exactly what should we, from the outside, be looking for? What would be a positive result?
Well, it remains to be seen if and when we announce the spudding of that first well. But I would say that these are two of these wells are essentially appraisal wells on known discoveries where the commerciality of the discovery is yet to be established. And I think that's the key here. It's about establishing flow rates and being sure that we can achieve sufficient flows from these fields to motivate what essentially would be a fairly light, small-scale development. While as we announced in our Q3, the three prospects on a gross basis hold approximately 7 million barrels of resources. We see that the value of those barrels is very high, and they're accessible because of the shallow reservoir and the ease of being able to drill and develop that. But that is assuming we can get sufficient flow rates with the kind of drilling we expect to do. So I think that's the key to look for.
And if you are successful on Block 56 in this exploration drilling, is this and given that it's a moderate-sized discovery, is this an area which it's possible to, for example, truck the oil out of, or would it require infrastructure investments in pipes, for example?
Most likely, we would be able to truck the oil. It is very close to infrastructure. It's close to other producing fields of a similar nature. It's close to some of the main pipelines. And it's this low threshold that also makes it very attractive. And given that there is a large number of follow-on leads that could, if they work, be hooked up to the same production infrastructure, we see a very good potential of perhaps developing this as a small cluster that can utilize existing infrastructure in nearby blocks and in nearby area.
And then to your balance sheet. You don't have any debt, and still, when COVID-19 hit, you scaled back substantially on investments. How should we think about kind of the capital allocation priorities? Is it so that you will maintain a very strong balance sheet? You call it a boringly strong balance sheet, or is it so that you will use it to do counter-cyclical investments? Or will you do pro-cyclical investments, or will you increase the distributions, or will you do transactions?
I would love to do all of the above, but it all comes down to opportunity and also the where we see the most value being created. And we're actually in a position of luxury where we feel we're not that sensitive to the short-term oil price fluctuations. So we see with our now expanded portfolio of exploration licenses that we can confidently plan quite extensive exploration on these, which we see as very value creative, irrespective of the oil price climate the coming 3, 4, 5 years. At the same time, we can maintain a very attractive dividend to our shareholders on the back of the production from blocks 3 and 4. And this gives us just a very different planning horizon. Now, we do expect to put the money at work. We currently see a cash position that perhaps we hadn't expected if you'd asked us a year ago, simply by virtue of the oil price being that much stronger. And equally, we would have expected perhaps some of the spending to have picked up a bit faster during the 2021. And that has resulted in that we have a slightly higher than expected cash balance than we did expected a year ago. But we certainly have no lack of projects or either to spend on, and while also being able to clearly prioritize the shareholders' desire for more dividends and return.
And what drove the slower than expected ramp up in capex? Was that the lack of projects, or was it all of the limitation that has been imposed on us due to COVID-19?
I would say it's mainly a function of operating under restrictions for a long period. It means that simply getting things working in the field with quite strict sort of anti-COVID infection regimes can become quite cumbersome. There have been outbreaks on rigs and which have all had no serious consequences for any of the involved, but it does mean that you have to halt operations for a short while and ensure that there's no further transmission and equally at the same time, we've also seen a lot of other players picking up activity, so the demand for a lot of these services has also been very high and higher than perhaps we would have expected. Again. So securing rigs, securing seismic crews has been quite challenging because activity in the country is picking up, and we are not the only ones seeing the potential and opportunity in Oman. So investment is certainly.
Is that due to prices, or is it due to securing rigs and securing crews? Is that a matter of pricing, or is it a matter of the absolute availability?
Well, we're always looking to secure a good price, and we won't take any rig or any crew at any price. So there's always a question of negotiations. But ultimately, yes, there is a limitation. And we see this. This is an industry that perhaps hasn't received the total investment in the past few years that it could carry, and that does create some bottlenecks in certain portions of it. So yeah, that is at least in the shorter term a limitation. In the longer term, that usually evens out. But yes, when we're trying to ramp up quickly, that becomes a clear limitation.
Yeah, we are running out of time, so I'll finish up with one or two last questions. Just to make sure, have you secured now all of the infrastructure and people that you need in order to execute on your budget for capex for 2022?
I believe so. I believe so. We and that's the beauty of having several licenses as opposed to the situation where we were just a couple of years ago when we only had one operated license. We now can secure contracts that span more work over several licenses, and that does make us a more attractive buyer of services, and it puts us in a better negotiating position. So yes, we feel confident that we have secured all the necessary resources.
Okay, excellent. So the upcoming main trigger is the drilling of on block 56 of Al Jumda, and beyond that, it's ongoing operations. And I guess from our end, we look forward to follow you. And thank you so much for the presentation, Petter.
Thank you, Carl Fredrik. Thank you.
Have a good day.
Hi, and welcome to our next presentation at today's Investor Days. My name is Jacob Lemke, and I'm an equity research analyst here at ABG covering the healthcare space. Our next company presenting is OssDsign, and with that, I leave over to the CEO, Morten. Please go ahead.
Jacob, thank you very much, and thank you very much for having me today. If you go to the next slide, please. As always, when we do this presentation, we have the normal disclaimers relative to forward-looking statements. Next one, please. But in case there are any new to OssDsign, OssDsign is a Swedish-based company. We are headquartered in Uppsala, but really have a global presence. Our main focus is really on bringing next-generation bone replacement products to the market. We operate in 10 markets today, and everywhere we operate, we have fully patented, we have full regulatory approval, and we are fully reimbursed. Next slide, please. But I really want to talk to you about the clinical challenges that we are addressing. If you go to the next slide, please, because you'll see that they are very profound. First and foremost, if we start on the cranial side, unfortunately, a lot of people have traumatic brain injuries every year. Some will need to get hospitalized, and some will need an implant. Now, the number one challenge we are facing is what we call post-op infections. So infections coming out immediately after the operation, or at least in the foreseeable future after that. And the literature here clearly shows that is 10% or even higher. Just a few months ago, the UK registry came out with a 16% explantation rate and 10% explantation only due to infection. So this is a major challenge when you're dealing with cranial surgery. Similarly, if we go to spine surgery, then unfortunately, as we grow older, a lot of us will have degenerative diseases, will have spinal instability, and we would need a surgery. And here you need something what you call a fusion, where the implant itself is growing together with the body. Now, unfortunately, what we see is that at least 1 in 5 simply don't achieve that outcome. So when you add the clinical challenges in cranial and you add the clinical challenges that we see in spine, we are talking thousands and thousands of patients who do not achieve the outcome. It's extremely painful for patients, and it's extremely costly for the healthcare system and therefore the society. So these are the clinical, very real clinical challenges that OssDsign is addressing. Next slide, please. So what is it really that OssDsign is bringing to market to deal with that? As I said, we are really bringing out the next generation bone replacement product. And what is it that makes them special or unique? It is essentially that the whole way we design the products is that they are stimulating the body's own healing capabilities. So the body is a fantastic phenomenon, and it has many capabilities. And essentially, we are helping the body heal as it was intended. Next slide, please. So if we go into the technology platforms and the products that we have today, then we have our cranial patient-specific implant. Now that product has shown tremendous clinical results. Just last week, we actually published updated post-market surveillance data on 1,480 implants, and clinical outcomes have improved and now show only a 1.6% explantation rate due to infection. Now, that needs to be seen in the context of the 10% or even more that I just talked to before. And this is something that we have constantly demonstrated from the very first very difficult cohort in 2018 at Karolinska. We also showed 1.9. So we've now consistently shown what this product can do, and it is just a much, much lower observed explantation rate than anything else in the market right now. We have regulatory approval in EU, US, and Japan, and we also have what we call osteoconductive clearance in EU, and we are the only one in the US that actually have that. And what that means is that during the healing process, the implant actually resorbs and turns into bone, together with the patient's own bone. So very strong clinical data, very proven clinical data that we're bringing to market here. Next slide, please. Now, the other product that we also started selling here in the last couple of months in the US is our bone graft called OssDsign Catalyst. What we have here is only preclinical data, and that was also what was used to get the 510(k) clearance in the US. But these preclinical data are phenomenal, to be honest. When you compare it to other things that have been done in the market, other synthetic bone graft as it is, when you test it in a preclinical model, it's a very discriminating model. It's essentially rabbits. So you're asking rabbits to jump around for 12 or 26 weeks, which is, of course, a test on steroids relative to what a human being would be doing. And what we see here and what we demonstrated is a 90% fusion rate after 12 weeks and 100% after 26 weeks. When you compare that to other products that are currently in the market, they were actually performing at about half that level or maybe even less. And the results that we've shown in this preclinical model is actually on par with BMP2, which is Medtronic's Infuse. It's a bone morpheus protein, so it's not a bone graft, but it is by far the biggest selling product in the US market right now, probably around $700 million. So again, we're taking this to market. Surgeons are used to looking at preclinical data. This is something that has resonated extremely well with all the surgeons we've spoken to so far. Next slide, please. If we move a little bit to the company overall and away from the technology, then OssDsign is right now on a journey to become a broader company with a lot more potential. If you go to the next slide, please. For the first 10 years, OssDsign was focusing on cranial implants. Right? It's an addressable market of around $400 million, give or take, growing nicely profit. But now we've also entered bone graft, and bone graft is a much bigger market. It's growing at the same rate, but it also comes with a much higher gross profit, typically north of 90%. And what it means for us is that we now have a 5 times bigger potential. We're operating in a $3 billion USD market, but I think also very importantly, the bone graft market really is fully scalable and it's a high margin product, so we can build the company without having to invest as much as least as you need to do on the cranial side. So 2 very attractive spaces we are in and a much bigger potential for OssDsign in the years to come. Next slide, please. Now, bone graft can be used in many places. We actually cleared in the US also to use in trauma surgery and what we call kind of load bearing, so smaller extremities. But our key focus is within spine. And why is that? Well, clearly spine is by far the biggest user of bone graft, partly because of some of the very big clinical challenges I talked to earlier, but also because spine is an area where a lot of us in OssDsign actually have previous experience. So bone graft and spine may be something that's new to OssDsign, but it's not known to many of us. We have people in production, in marketing, in sales in the US, myself on the board, and other people in the management team that have previous experience in this. So it may be new to OssDsign, it's not new to us. And it also means that we have a lot of surgeon relationships in the US actually that of course we are leveraging to its full right now in the early commercialization phase. Next slide, please. And of course, we'll be using our commercial infrastructure that we've built over the last 4 or 5 years. We have direct distribution, direct sales forces in Europe. We have our own subsidiary in the US working alongside, lots of sales agents called distributors locally, but they are commission-based. And then we also have agents and distributors in southern parts of Europe and Singapore. Right now, of course, with Catalyst, we are really going heavy on the US. Next slide, please. I also wanted to talk a little bit about a very exciting year, because every quarter has more or less been more exciting than the previous one. And if we start left to right, we started the year moving into larger production facilities, which essentially means that we can grow the business right now without having to invest more in the infrastructure. We also had a very successful fundraise where we raised 270 million in a 185% oversubscribed rights issue. And that really allows us to go and execute on the strategy that I'll talk to in a second. Now, during the year, we've also had some successes, in particular in the US. We've won a number of large GPO contracts. We won Premier, one of the absolute giant GPOs in the US. We were also awarded a contract called the DARPA with the US military and veterans departments. Two very important wins, big sales potential, but also really a testimony to the quality of the technology and the clinical data that we have. And then in this fall, we also launched OssDsign Catalyst, actually ahead of our own plan, which means that we are now actively both selling bone graft and cranial implants in the US. And now over the last couple of months, we also started our first clinical trial on the bone graft called TOP FUSION. That's going according to plan. It's taking place with some very big known surgeons in Varga and László in Hungary. And just as I said, within the last couple of weeks, we also published updated post-market surveillance now on PSI with even better clinical outcomes than what was previously reported. So a very exciting year and some extremely important building blocks, both to help us sell now, of course, but I think even more importantly, to set us up for a very different future in the years to come. Next slide, please. I also wanted to talk a little bit about some of the clinical programs that we're working on. This is an absolute top priority for the company. If we start with the cranial, on the cranial franchise, then really the post-market surveillance is by far the strongest data set you have when you're talking cranial implants. It's a broad average across many different indications, which traumatic brain injuries, of course, has. So that is an annual publication. We just published it. It will come out next year. But we also know that every time there is a comparison between our cranial PSI product and other technologies, we just come out better. One of the challenges have just been in cranial that there's simply not enough being published. So we are working with KOLs, so key opinion leaders in EU. We've just recently just launched an international registry. It's an academic registry, so we are keeping it at arm's length, but we are definitely supporting it. And we are just about doing the same thing in the US with some really important brain surgeons actually over there. So very meaningful investments from our side in data that will allow us to demonstrate even more how strong the cranial PSI is relative to other things on the market. For OssDsign Catalyst, as I said, we started our first clinical study called TOP FUSION that is running. We are, of course, going to see data, on an ongoing basis, but really the key data point when you're talking bone graft and spine is the 12 month. That's where you know for absolute certainty what the fusion rate is. So that's one thing we're doing. We are also in process of setting up what we call a bone graft registry with a number of sites in the US, which essentially allow us to capture lots of patient data much faster than you do in a clinical trial. It's also a much broader data set. We know that some of the clinical challenges in spine is particularly around certain comorbidities, like if you are a smoker or diabetic or other things of that nature. And all these things we'll capture in the registry, and that will allow us to publish data, white papers, and other things that will be meaningful for both sales and marketing purposes, and of course also to attract the attention of surgeons in general. So those are some of the things, at least, that we are working on, that we are investing very heavily in the business right now. Next slide, please. So if we talk a little bit about the future for OssDsign, as I said, this is a very different future than what OssDsign have had in the past. So if you go to the next slide. Earlier this year, we launched our new 25 strategy called Ascend 25. And really the future for us is just keep executing. We've executed extremely well on that strategy so far this year, as I showed you, and it is continuing to do that. And what it essentially means for us is that US is by far the biggest and the most important markets, and we will disproportionately direct investment towards that market now. We also need to continue to build the bone graft business that we have. We need some more products in the portfolio, of course, but also we definitely see that as a global product over time, as soon as we have clinical data to also get new regulatory approvals. Generally, an innovation and expansion of the portfolio, I think it's important. We need to keep building on the strong technology platforms we have. And as I showed you, we are making some very significant investments in clinical trials and registries and other similar things, probably at the extent of a ratio of 3 to 4 relative to earlier. And then last but not least, as we said in the strategy, we'll focus on operational efficiency. And really the most meaningful place for us to achieve that is really on the delivery time. This is a patient-specific implant. As you saw, it is showing some very, very strong clinical data, but you also need to wait a little bit longer because it takes time to produce a ceramic implant as we are. So we are very obsessed with trying to bring down that delivery time and make the offering stronger, of course, in the market. If you go to the next slide. So this was a very short recap on OssDsign. It is a changed OssDsign. It is an OssDsign with a very different future. And you know, just to summarize what I've said today, I think it's very clear that we are addressing a very real unmet clinical need. What we're bringing to market is really the next generation bone replacement products. Our Cranial PSI is a ceramic. It's the only one, as I said, with osteoconductive claim in the US. Our bone graft is nanosynthetic and synthetic at a level no one else is in the market, right? Where we are not just mimicking the bone structures, but we are actually mimicking the mineral crystals inside the bone. That's the level we are operating on. A very extensive growth potential, much bigger market, X5 to what it was before, scalable market, high margin market. Clinical performance, I showed you, Cranial PSI, very strong, very, very promising preclinical data that we can sell on in the US. Surgeons are used to looking at preclinical data in spine and bone graft, and it is meaningful to them. And last but not least, as I said, we already have a strong commercial presence. We'll, of course, keep building that in the years to come. But, you know, relative to a company of OssDsign size, this is really an asset that we have, which means that we don't need to start building just going from scratch, but we can actually leverage that to accelerate instead. So, you know, the sum of all of this for me is that we are very uniquely positioned for growth relative to where we are. We've delivered extremely well, or executed extremely well on the strategy so far, and we have an exciting future ahead. So, Jacob, I think that was my presentation, and I'm sure you have some questions for me.
Yeah, thank you, Morten. So maybe if we start with Catalyst, and if we look, you know, at the preclinical data you have presented so far in rabbits, which I believe looks quite promising. But how well do you think that this data translates into the potential success in human trials you're conducting right now?
It translates well, right? I think what you can see on the references are made to other synthetic products in this called the Boden model, which is a very discriminating animal model with the bunnies. You know, a lot of the other products where we have access to the data, they actually only fuse somewhere between 25 to 50%. And yet we know that in human beings, they typically sit around the 80% mark, give or take. So we know that most products in the market right now are showing less fusion in animals than they actually are in human beings. Of course, with us showing 90 and 100%, you can go above 100, but it does mean that we feel very comfortable that this will also translate into very strong clinical results in human beings.
And if we look at the spine fusion market, I mean, it's quite consolidated between a few large players, but also perhaps if we break down the market, I guess there's a bit less competition in your niche. So maybe it would be interesting to hear you talk a bit more about the sort of market dynamics and how you're differentiating yourself from the competition.
Yeah, I mean, of course, when you're playing in an attractive market, right, you're not the only one that have seen that. I think, Jacob, there are some nuances to what you just said. Yes, the spine market from a hardware, from an implant point of view, is certainly concentrated among, the typical top 4 or 5. Now, the bone graft market is a lot more scattered, actually. You have a lot more smaller players there. You also have a lot of products in the market that carry very little clinical data, actually. And then I think it's important to distinguish because, yes, there are a lot of regulatory approvals on bone graft in the US, but we are probably where we think we belong to the 4th generation category when you look at the technology platform on OssDsign. You cannot compare the 3rd or the 4th generation to the 1st generation. If you look at some of the market reports, you will see that the early, let's call them the early products in the market and the later products in the market, the latter category is expected to grow probably about 4 times faster than the earlier category, right? So what I'm saying is that, yes, there are many products on the market. There are also many products that I would argue are old and certainly don't carry the clinical data that is necessary to also scale to a meaningful place. So I feel we're well positioned, to be honest. And as I said, surgeons, more or less every 510K clearance in the US is done on preclinical data. So surgeons are very used to looking at preclinical data. They also have a very good idea that if the preclinical data is showing this, then how does it translate into clinical outcomes in human beings? So we feel we are in a good place, to be honest, despite the fact that, yes, the market is crowded. But as I said, I wouldn't really compare OssDsign Catalyst to some of the other products out there.
And if we look at the early sales trajectory of Catalyst, I think it's quite interesting. Could you maybe say anything about when we can expect meaningful contribution from that product?
Yeah. Listen, I mean, as I said, 2021 for us, of course, we are obsessed with sales, right? We are a growth company, but when you take a new product to the market, the most important thing here this year is really on building what we call centers of excellence or strong KOL ambassadors, because ultimately you need surgeons also to vouch for your product to other surgeons. So that's really the focus this year. But we have a clear expectation that already next year we would start to see meaningful contribution from Catalyst to the business.
Okay, I think that was all the time we had today. So I would like to thank you for participating and everyone watching. We'll now take a short break before our next presentation.
All right, thank you very much for having me, Jacob. Have a good day.
Thank you.
Hello, my name is Mads Tinggaard. I'm covering Danish financials for ABG, and I have been looking forward to extend a very warm welcome to the CFO of Bank Nordic, Rune Nørgaard. So welcome, Rune, and please go ahead with your presentation. Thank you.
Thank you, Mads, and thank you for having us. As explained by Mads, I'm here to present the investment case of Bank Nordic. Yes, and I'm CFO of the Bank Nordic Group. During the next 20 minutes or so, I will be covering a quick introduction to our activities, where do we do business, how large an entity are we. Then I will look a little bit into our equity story, take a slightly deep dive into our credit risk portfolio, quite important as we are a banking group. Then we would look at have a quick look on the macroeconomics, covering the two markets that we're doing business in, and finally I will round off with our outlook for this year and our coming plans for distributing dividends. But if we start off with the slide that you have in front of us, in front of you, this is a quick presentation of Bank Nordic and our activities. We are a banking and insurance group. We do banking towards corporate and private customers on the Faroe Islands, where we are headquartered. And we also have banking business towards private and corporate customers in Greenland. And as I said, we are also an insurance group. We have life and non-life insurance activities, but only on the Faroe Islands. Relatively speaking, the home market, the Faroe Islands, is just the bigger market than Greenland. You can see that if you measure by loans, like 6.5 billion Danish in loans on the Faroes, and just slightly above 1 billion in Greenland. And the market share, we're just above 40% on the Faroe Islands and slightly below 20% in the Greenlandic market. We've been doing business on the Faroe Islands for ages, more than 100 years, but we've only been active in Greenland since 2010. On a group level, loans, well, yeah, no surprise. We are just above 7.5 billion Danish kroner. And when it comes to insurance activities, if we take the first 9 months of this year, just below 100 million in premiums. And the main revenue is from the banking activities, net interest and fee income, for the first 9 months of this year, of just above 250 million Danish kroner. Just a little bit about our size. We are traditional banking and insurance business. We do our banking through 5 branches on the Faroe Islands and 1 branch in Greenland, and just below 200 employees in the group in total. The insurance activities are done through fully owned subsidiaries, and then we have 1 smaller subsidiary acting as a real estate broker, also only active on the Faroe Islands. If we flip to the next slide, we can use this to talk about our approach towards these 2 markets that we are active in. The Faroe Islands, it's our home market. We are what you call some kind of local champion. We have a relatively large market share, and our ambition for that market is not as much as grow our market share, at least not in banking. We want to grow in insurance, and we also want to grow in pension savings and investments. We see a unfulfilled potential in the Faroese market. When it comes to the Greenlandic market, we want to grow in all areas going forward. The main characteristic of the Faroese market is that we are up against 1 other major bank, local bank on the Faroe Islands, and then 2 smaller, so 4 in total. But in Greenland, we are only 2 local banks, us and the local bank having the larger market share up there. As I said, we are a traditional bank, at least for now. We're doing business through our branch network, but we're also moving into a more digitized world, a more automated world, not only within the bank, but also the Faroe Society and the Greenlandic Society. If you know the Danish market, we are not as digitized in general in society up here on the Faroe Islands and in Greenland as you could see in the Danish market, but we are getting there. And of course, we will join that journey. And our main focus the coming year is transforming the bank from traditional banking into a more to be relevant also in a digitized format. And we have an ambition of improving our customer experience through through digital tools and ways of communicating with our customers. The other benefit, when you look besides improving the customer satisfaction or the experience that the customers have with doing business with the Bank Nordic Group, we also see digitization and automation as another way to improve our efficiency. So the main strategic focus going forward is to deliver end-to-end digital customer experiences, and that is both internal process as external processes are going to be fully digitized, but always with a opportunity for the customer to opt for a personal advice or personal relation with one of our key account managers. And of course, develop an efficient organization, driving down costs. So the ratio between cost and income will improve during the coming years. We, as I will come back to it a little bit later in my presentation, we have a fairly low risk credit portfolio today, and we aim to maintain that going forward. Our capital position is quite comfortable. You could say too comfortable, would somebody say. We have a CET1 target of 20%, and we are well above that target. And of course, the upcoming distributions of extraordinary dividends is a part of the path of moving down our CET capital level to our target level going forward. Target-wise, we have set quite high standards. Or we could just flip back to the previous slide, sorry. We have set targets both in respect of customer satisfaction and employee satisfaction and towards our shareholders. I'm quite pleased to let you know that in respect of the employees, we just finished a satisfaction survey, and then we are above our targets, so that's quite nice to know. We have set a fairly ambitious target for our customer satisfaction, and then we have some way to go there. In respect of the shareholders, we just updated our targets to a return on equity of 10%, above 10% after tax. And that is a target that when we say we are aiming at above 10% after tax, it is in a normalized loss environment. We've seen subnormal losses for the last years. So going forward, we aim to deliver 10%, even though that we are going into a normalized loss scenario. And as you can see, we're going for a cost-income ratio below 55%. Just flip to the next slide. We're also fully committed of making a positive imprint on the two societies that we're doing business in, Faroe Islands and Greenland, and set fairly ambitious targets in respect of CO2 emissions and also on the more social side on gender diversity going forward. Just flip to the next slide. As I mentioned, just a quick dive into the risk profile of the banking business. The loans between corporate and private are more or less evenly split, 50-50. And we look at the private side, it's quite well collateralized. It's more or less like a mortgage institution, Danish mortgage institution, like collateralized portfolio. And when we are talking about the corporate portfolio, we are quite well diversified between the different sectors. So in all, we are quite comfortable with the risk profile. And on the right side of the presentation, you can just see our capital levels, and as the upper one is on the CET1, and we have a target ratio of 20, and you can see we're quite well above. And the way we are going to reduce that going forward is through extraordinary dividend. I'll get back to that later in my presentation, and through our dividend policy and share buybacks. That's a long-term goal, so we will not get there in 2022, but over the coming years we will get closer to the target. The MREL capital, we are in place in respect of that. No problems there. If we flip to the next slide. I just promised some quick words on the macroeconomics on the two markets that we are doing business in. The Faroe Islands, as you see on the GDP growth, we have actually done quite well. Had a slight drop in 2020, as so many countries over the world, but we have a steep rise in this year, and we have a positive outlook for this year and the coming year in GDP-wise. So quite comfortable numbers there. Exports is getting back to a high level again after a drop. Export prices, mainly export prices is fish products. We've seen them not as a steep increase as we've seen in previous years. So export prices are a little bit lower now than they've been before. Unemployment-wise, virtually non-existing. Air travels, a second leg, but still a small leg of the Faroese economy, is tourism, and it had a very positive development up to COVID-19, and of course took a drop as in many other countries, but it has been on the rise in this year, and we're quite comfortable that in a COVID-free world, or a COVID in a world not closed due to COVID, tourism could be a very attractive leg for the Faroese economy. Housing prices is on the rise on the Faroe Islands, and it's something that we have a close monitoring of the housing price development on Faroe Islands. Flip to the next slide. The Greenlandic economy, actually they've done better during the COVID crisis than many others. Just a flat growth for GDP in 2020, and been on the rise since. Exports is also seen a slight decline, mainly due to lower prices in the main export products, that is cod, shrimp, and halibut. Unemployment also very low level in Greenlandic terms, and the same pattern when we come to air travels. In Greenland we monitor closer the retail sales, and then they've also been on the rise. So the economy, both on the Faroe Islands and in Greenland, are doing quite well, I would say. Even though that of course the two countries are also affected by COVID. Could you flip to the next slide? And as I promised, some quick words on our outlook. We have revised it a couple of times this year, and now we expect to land a net result after tax in the range of 230 to 250 million Danish. We are quite pleased with that result, and it's driven by the improved core business on the banking side. On the insurance side, we've seen some very high claims this year. So the insurance business are not adding that much to our net profit this year. Quite pleased to saying operating costs are kept flat, and we still have impairment charges to remain at a very low level for 2021. And as you can see, the outlook, as I mentioned, and GDP-wise from both Faroe Islands and Greenland are quite positive for this year, and they are also positive for 2022. And then lastly, but not to be forgotten, we have announced that we would pay out a 700 million extraordinary dividend, and we have already paid out in October 450 million. Previously, we announced that we would pay out the remaining 250 million with one half in next year, and then the last part in 2023. But we decided to move that a bit forward to paying out all in all of the remaining part of the extraordinary dividend in the coming year. And then we for now maintain our dividend policy of 50% payout ratio, supplemented with share buybacks going forward. And I think that was a quick run through of Bank Nordic as an investment case. And I have time for questions. I don't know, Mads, if you have.
Yes, I do, and thank you. That was, that was very well done and to the point. And I think, one of the things you mentioned here was Greenland doing better than many other countries. And we did see in Q3 a rather high growth in Greenland, and it is clear. Being a part of a duopoly on Greenland does look quite interesting. What kind of growth rates do you expect on Greenland in the coming years?
Well, of course, at least what to be able to be above GDP growth. So if we foresee something in Greenland that looks like the growth numbers that we've seen this year of approximately 2%, we do expect above 2% going forward. We want a bigger market share in the Greenlandic market, so that would be somewhere above that we are aiming at. Of course, we do take cautious steps because we want to grow both in private lending, but also in corporate lending, and we don't have that much hurry in respect of corporate lending. We would like to land the right customers, and we are slightly getting there, but it can be a more lengthy process to you could say to groom the Greenlandic corporate customers towards a favor of us, and maybe a lot can come in 2022, but maybe some will come in 2023 instead. That's hard to predict, but we are out on a mission to take market share in Greenland for sure.
Yeah, and what is the main driver of your growth? Is that just being another option for for the people on Greenland, and how does it? Your opportunities in the corporate segment, is that also supported by geopolitical interest, or how do you see that?
If we start on the private side, it is of course we are a second option, but it's more like we would just compete on what we're competing on the Faroe Islands, that is giving good, sound financial advice to our private customers, having some good products with the right price, and that has been a successful formula for the last couple of years, and we think we just keep on doing that. On the corporate side, of course, there are large customers in Greenland also that are too large for the local bank. Of course, we can go into corporations there, and we have done that. But on the other hand, there's a lot of local, quite interesting corporate clients that we would like to have on our books. Geopolitics doesn't really affect the lending that much. It often comes with huge international grants or the like, and then just injected into the economy. For example, the Danish state have injected a lot of money into the ongoing development of the airports in Greenland. Yeah.
Okay, so but landing one of the big whales, that would be more than a few percentage points then in lending if you manage to do that.
Yeah, that could be the case. Yeah.
Okay, and then I was just curious when the ambition of 10% ROE in 2024 with normalized loan losses, I think 40 basis points of lending and guarantees. I mean, do you factor anything more into this normalization? For example, higher rates and NII in that scenario?
Not higher rates, but of course we factor in that we reached the CET1 target of 20%. Of course, that's the main driver. But then it's just cost focus and then increased activities in Greenland and on the insurance side and so on. That we foresee that will be the way forward to a above 10% return on equity. In 2024.
Yeah. Could you help us a bit more with the timing of your next Jumbo dividend? What is in play? What is the moving parts around the timing?
Well, it is of course we have an extraordinary general meeting coming up in March as usual. We haven't announced our financial calendar yet, but there's of course an event where we factor into or plan to take some decision in respect of distributing dividend, but we haven't fixed we haven't been fixed on setting it all on the ordinary general meeting. The only fixed thing we have said about the Jumbo dividend is that it's going to be paid out in 2022, and rather sooner than later.
Do you have a hope for some of the large shareholders and perhaps also the Faroese state participating in a buyback tender auction instead? Is that something you're looking for, or you're not really expecting that?
That would be a hard one to answer. We really don't know.
Okay.
Of course, we would, if we hear something, we would listen. Yeah.
But otherwise, it's a dividend.
A dividend is, of course, as we did with the 450, is a pretty straightforward way of distributing. But if we can see that there's the other possible way to go that is beneficial and not too detrimental for the shareholders, we will of course look into that.
Yeah, and sure, of course, there's a kind of asymmetry between your shareholders on that one, and there's a issue with the Faroese withholding tax. Have you done anything to help your shareholders with the last Jumbo dividend to kind of avoid double taxation?
Well, we've done as much as we've been in dialogue with the Faroese tax authorities. We had that dialogue before we paid out in October, but unfortunately we didn't really get that far in respect of that. So I think we've done what we can do. Unfortunately, at least as the things looks right now. So don't see any major changes there.
I saw something with a service facility. You could send in documents and get help.
Yeah, I think we announced that one quite close to the dividend date this autumn, and of course we would look into that and see if there's anything there we can do better the next time.
Did you help a lot of shareholders through that service?
I don't have the numbers.
Okay. Then a final one, Rune, and it is on the Lumumba papers, if we can call them that. It's popping up again now. What can you tell us about this case, and can you confirm it's exactly the same one that was brought up in 2019?
Well, I can't really comment on anything in respect of this AML issue, and it's not because I don't want to, or we don't want to. We're just restricted by law to say anything. So that's why we haven't really been commenting on the case. But as far as we can see from the stories in the news, it is the same case as were in the news in 2019.
So under the general rules that you operated when this case happened, would you be expected to decline the transaction, or would your obligation be just to report it to the authorities?
It's the same general rules in place now in that respect as were then, and we have previously explained how we comply with those rules, and well, nothing has changed in that respect now compared to then. So we have the same approach today as we have always have in respect of these kind of matters.
Yeah. Okay, Rune. Thanks a lot for participating here on our Investor Day. Thank you. Thank you.
Bye.
Hi and welcome everyone to today's presentation of Flexion Mobile. My name is Stefan Knutsson and I'm an equity analyst here at ABG and covering the service sector and also Flexion as a company. And with me today I have the CFO of Flexion, Niklas Koresar. Welcome, Niklas.
Hi, Stefan. Thanks a lot. So thanks for this. So I'm going to dive into Flexion Mobile. So if you can have next slide, please. Yeah, so Flexion Mobile is the leading distribution platform on the Android market. So first of all, we're not building games. We're a service company to the mobile games industry. And basically what that means is that we go to the biggest leading developers in the world and we secure the distribution rights for these games in the stores we work with. We're a London-based company, 66 staff. The founders, Jens and Per Lauritsson from Helsingborg, are still very active in the company. And we have a run rate about 29 million pounds, about 350 million krona. We're EBITDA neutral in the company since a couple of quarters. We work with a revenue share model, and that means that for any revenues that is generated within an app in a store, we share that revenue with the channels and the game developer and us. So we have a very, the model is very aligned in what we want to achieve. History is very important. Companies founded more than 10 years ago. We were leading on back in the Nokia Ericsson days. So we work with the big players like Sony, BlackBerry, Nokia, Orange, Vodafone, EA, etc. And that's very important for our current position. I'm coming back to that. We are in the gaming market, so we're not in gambling, we're in gaming. And on the gaming market, we focus on the mobile segment, which is the biggest segment within gaming and where you see the biggest growth. And on that market, we don't distribute games into app stores. So we focus on Android. It's 85% of the devices out there, in the mobile phones out there. And on that market, we don't distribute into Google Play. We don't distribute into China. So we look at what we call the alternative market. It's still an absolutely massive market. It's fair to say we've grown a lot. So we have about 10x on our revenues since we IPO'd in 2018. So the Flexion train is steaming ahead. Next slide, please. So our position on the market, so the game developers on mobile, they have two distribution channels, Google and Apple, everyone the same. And then they struggle with the rest of the distribution. So we're offering the third distribution pipe to the market. So with us, they can cover the rest of the market more or less effortless. Next slide. And why are we here? What's this about? So basically, as I said, all the game developers are in these two stores. So the stores are heavily overcrowded. There are 4 million apps in each store. So discovery of games is the biggest problem on the market because the game developers are very hard to be seen. So they have to spend awful lot of money on user acquisitions and advertising. And basically, the bigger you are, the better you get. But there's a lot of developers struggling. At the same time, it's very hard for them to reach out to new stores because the games has become very complex. And they're very cumbersome to distribute in another channel. So they are kind of maybe half-hearted in one other channels, but they're not updating the games. They don't give it enough love. So they're effectively in these two stores. There is a market problem here, which we have solved. Next slide, please. So what we have done is to develop a full service offer. You can call it a one-stop shop where we are doing all the service stacks needed for alternative distribution. So effectively what we're telling a developer is that, give us the file that you've developed for Android for Google Play. We then take that file, convert the file and do everything needed. And so basically the offering for us is give us your existing file. We do everything for you and send you back money without you having to do very much yourself. So it's a very powerful offering to developers. We're the only people in the world who can do that. Sorry. We are a service company, but we're also definitely a technology-based service company. And the underlying tech is that we automatically can convert that game file that the game developer writes for Android. So we take control of that file by effectively hacking ourselves into the file with the developer's permission. And by doing that, we take control of the file and we can add the functionality needed so we can repackage files automatically for all stores. And that's something that's very important because these very advanced games are updated even up to every week, so you can't do it manually. We're the only people who have the service offer and the technology. We have two patents now in the US on the technology and the patent pending in Europe. Next slide, please. So the stores we are working with is the biggest stores outside Google and Apple. So we're very close to Samsung, to one store in Korea, Amazon, Huawei, and also some of the newcomers on smart, manufacturing smartphones like Xiaomi, who's coming out. There is others also coming like Oppo and Vivo. They all have kind of Samsung and Huawei is a 15 to 20% global market share on mobile phones, and these new Chinese players in the Western market, they're 5 to 10%. So our reach here is absolutely massive. So if we deliver a game to all these stores, we could well be on half the world's mobiles. So what we're working on is that together with the stores is to get the users to start using the smartphone's own store here. So the upside is absolutely potential. The drivers for these stores is, of course, to generate revenue, but it's very much is to build their own ecosystem. The leader is, of course, Apple, who was a hardware company and has become, if anything, a software company, but who's someone who still make awful lot of money on hardware. Fantastic model. So these guys are trying to do the same. And you also, so it's very much building your own ecosystem. And take an Amazon. The last thing they want is me as an Amazon user go to Google Play for gaming, because I go in and out of games all the time. Because then I get caught in the Google ecosystem and their advertising. So they want to retain the users. Other big drivers are, for example, regulatory pressures on the two existing stores, but also stuff like market changes. Where it's been mentioned about this IDFA, when Apple take control of the data of the users, and those kind of initiatives or changes are kind of forcing the developers to look outside their existing distribution models. So, for example, we have seen now definitely a big increase in interest on what you can do with the stores we are working in. Next slide. This is a slide we get a lot of questions on. People can't really grasp why, if this is such a big opportunity, why are we the only people who are doing this? And the answer is very much the history. And to build the technology, you need access to the games, and really the top end of the games, so the most advanced games. But you can't get the games if you don't have the technology already, and you can't get the games if you don't have the distribution power. But even if you would have distribution power and technology, you wouldn't get any games because you don't have any other games. You don't have any reference when you sell to them. So it's the only way really to do this is start really early, but simple tech, simple technology and channels, and slowly build up your offering. And this is, of course, what we've done then since 2007 here. So we come now to a position where we are the biggest. And why go with someone else if we have the biggest portfolio in the world of games? So we are building really, really strong barriers of entry. So next slide, please. And this is very much what our current strategy is today about. Yes, we are there to grow our revenues, but revenues is the mean to build a market share. That is the tool to secure the position on the market. So what we're doing at the moment, we're clearly the first mover on our market. We are building, as I said, really high barriers of entry. We have secured the biggest portfolio of games in the world as a third-party distributor. And there is a content on the market there's a saying on our market that content is king, and we are definitely the king and the emperor at the moment. We also have, what's pretty cool actually, is that because of the technology, we have access to the games we're working with, and also on a setup where it's very easy for us to integrate new service offerings or trends in the technology, in the games. So we are now in a position where we can look at these new trends, and when something is coming, and we're also working with on a portfolio basis. So a developer has 5 games. See a new market trend, it's there, but it's not, you can't justify it on 5 games, but we with 25 games and a very simple setup can then look at these new trends. So everything we're doing at the moment is to secure this position on the market, to have this really, really unique market position. Thanks. Next slide. So if we look at a little bit about the quarterly results here and our positions, which we released 2 weeks ago. So we now have 22 live games. Is that a lot? There are developers with hundreds and thousands of games. But we are working with the leading games in the world. And so those games alone, those 22 are making in Google Play $40 million. And the reason why I mention Google Play is that that's our kind of reference point, how strong the games are. And we are at the moment generating about 10% of Google Play. So these games on a monthly basis combined in Google Play, 40 million. So that's $500 million annualized. And Google Play is about a third of the market. So that's $1.5 billion IP we're working in. So it's the top end of the game. And what's really, really cool here is that during the last quarter, we secured 4 other, really big titles. And their Google Play value is $36 million. So in this quarter alone, we doubled the potential of our portfolio. And this really shows the model. It's very easy for us to take in new games relatively to build a game. And when we get it right, you get a lot of growth potential in the company. Next slide, please. So going a little bit deeper in what drives the revenue of the company. And going back to 6 quarters ago, we had then 5 leading games, 5 what we call top tier games. And they were about 80% of our revenues. And they averaged per month per game $130,000. And what have happened over the last 6 quarters is that we've grown that average revenue of those games from $130,000 to $600,000 per month. And that is the revenue driver of the company. But if you think about it, we're still only, Google Play is 40%, so we are 4% of the total revenue of this game. So why not go to 10% or 20% of the total market? So there's still a lot of potential. And then when you add another 4 games here with the same potential as the rest, you really can see the growth potential of where we are. Next slide, please. So when we look at the revenue growth, I think it's fair to say, as I said, we've grown a lot. Our compounded rate about 17%. This quarter was flat in revenue growth, quarter over quarter, but we're coming out of a pretty strong quarter. Last quarter, we was 20% growth quarter on quarter, and we're also in a quarter when didn't really have very much new games that was driving revenues. And from a campaign basis, we're very much waiting for the 4th quarter, which is, of course, super strong quarter, both November and December. We're still on track we're about 40% year-to-date growth. So the Flexion train is steaming ahead. Next slide. This is a for me as a CFO, a very cool slide. Over the quarter, I think we grew over 10% quarter-over-quarter in gross profit. And the cost base, and here I very much look at salary cost because that is the key cost for us. Then we have a fair bit of FX that goes up and down because we are, I think it's fair to say, a truly global company. I think we have sales in 90 countries. So, and that one, the staff cost was down in the company over the quarter. And if we look at this of a longer perspective, we're up 4x on gross profit over 10 quarters, and we're up 25% in the cost base. Over the last year, I think we're up 35% of gross profit and 10% of the cost base. So it's, you can see next slide, is that we are now in a phase we stabilized on neutral EBITDA, and now, is to push ahead and start generating positive EBITDA in the company. Next slide. So summarize this. The existing strategy, which is the green side, it's a super simple strategy. The only thing we're doing is add revenues to existing games. Going from $130,000 per month to $600 and beyond. Add more games. Grow the number of big games from 5 to 9 and beyond. And add more distribution. The last one was Huawei last year, which then really kind of lift the whole revenue potential of the whole portfolio up to a different level. So that strategy is a very large growth opportunities. You get more and more diversification of the games from, you go from 5 to 9 big games. And also, what's something you really start to see here, that it is very painful to build a platform. But when you come there, you get to critical mass. You have a very low marginal cost in the company. I think that is what we start to see. To grow existing games from 130 to 600, the only thing you have as extra cost is a bit of channel management, where you try to get more marketing in the stores, but it's very limited. And now when you add more of these really massive titles, the marginal cost of that is very low. But if you at the same time can actually look at even, we're in a position we can look at even throwing out some of the lowest performing games because they don't make very much sense for us anymore from a kind of margin contribution point of view. And then you can come down to almost zero marginal cost on this. So there is a lot. I think for us going forward, and me and CFO is very much look at both the revenue performance, but also the cost performance. Start to price your cost base in the company to drive your EBITDA going forward. So that's the existing strategy. From a strategic point of view, I think it's fair to say we're done. And so strategically, we're now very much looking at adding new service offers to this. At the moment, we are very good at selling coffee, but if you have that market position, why don't start to sell cinnamon buns and salads? So that's what we're looking at, and that is within, for us, is paid traffic. So the green strategy is organic traffic, where we work with the stores and get free advertising, but paid advertising is now coming to the market, and you have influencer marketing, you have data-driven marketing, you have store optimization features, driven marketing, etc., etc. You have hybrid distribution solutions where you go directly to the mobile without a store. You have direct end consumer features. All stuff where a developer or a third party needs all the functionality that we are providing. So we're the perfect partner to help them with these new strategies. And then you have traditional user acquisition. As I mentioned, IDFA driving developers outside their existing distribution patterns. And why shouldn't we be the go-to party between user acquisition in our stores and these developers? And if you get that right, these developers have unlimited budget. So that's very, very exciting. So for us is to look at, are we building it up internally through partnerships or through, kind of very selective M&A strategies where, small companies, 10 to 30 people, EBITDA positive, and with not too crazy valuations, you can look at maybe acquire to top up that quicker than build it in-house. So that's what we're looking at. So the blue one is very much to put a super turbo on something that is moving very fast already, and also start playing around much more on the margin play, because the green strategy is a revenue growth, low margin business, and here you can look at high margin strategies on top of that. At the same time, as you then will drive the revenues on the green side with those activities. So it's super, super exciting. Thank you.
Perfect, Niklas. I would like to thank you for the presentation and do a short Q&A. And I would like to start with the large game deals that you have signed lately. Do you foresee any difficulties in taking them to market, or will it just be more of what you already have proven that you can do?
The stores are screaming for them. They are, these are games that the stores really, really would love to have. And so we're working really closely with them with really strong, launch campaigns and marketing strategies going forward. So if anything, I think it's easier to launch these games than the other ones.
And operationally, on your side, you don't foresee any bottlenecks?
It's hard to say. I think the bigger the games, the more organized they are as developers. So I don't know. That's not a problem. These are super professional people, and yes, it's quite easy to work with them.
Perfect. And then you mentioned your barriers of entry for competition, and someone who has the technology is of course Unity, and they do have a distribution offering. But from what I have seen, they seem to be losing out on the distribution channel side. I mean, how do you reckon their competition? Is it something that you worry about at all?
So I mean, first of all, I've been in this company for 8 years, and I've seen a lot of companies coming in. They have some technology or distribution idea, and after 2-3 years they're gone. And we have said for quite some time that Unity, which is a development platform for games, is probably the biggest competitor for us. They haven't had Amazon as a distribution offering. And what we saw was last week, I haven't all the information, but it says on the Unity platform that Samsung has selected to leave them. So now they can't offer Samsung either. And this is, as I said, this is what's happening. You have a lot of parties coming in, but in the end, they struggle to get the big games, and then it doesn't make sense. So it's one more out of many. But it shows, it is really, really complex, hard. But as for us, when you come there, your barriers of entry become stronger and stronger and stronger. So pretty cool.
Yeah, and another risk then perhaps is that your selected distribution channels grows larger. Would that mean that it can incentivize game developers to go directly in those channels?
Absolutely. Of course they can, and some will. And that's the nature of an open, perfect market. But if we are generating a lot of revenue for them, and also remember that we are doing all the work for them, will they disrupt that revenue stream and try to take it over and build up their own team with all the pain that it causes? Some will try, some will fail, and some may succeed, but it's not really a big threat. But the whole model for us is to have a very, it's a portfolio, flexible portfolio. So games are coming in, some are leaving, and then we can take in more games, because the cost and the time for us to take in more games is very, very small. So it's short. It's not a threat. It's just part of how it is.
Perfect. And by that, Niklas, I would like to thank you for coming here and presenting with us at ABG.
Perfect. Thanks a lot. Nice to be here. Thanks.
Hello and welcome back to ABG Investor Day. My name is Rebecca Järdrup and I work as an analyst here at ABG, covering the IT tech sector. With us today we have Patrik Settlin, the CEO of Litium. He will give us a presentation about the company and where it is heading. Patrik, please go ahead with your presentation.
Thank you very much, Rebecca, and hi all of you out there. It's great to be here to tell you a little bit more about Litium and what we do and the plans we have ahead and the potential we see for ourselves in the future. Like Rebecca said, I'm Patrik. I'm the CEO of Litium since 2 years back now. Prior to that, I had a long career in e-commerce on the merchant side, where I've been, for example, I've been the MD at Komplett in Sweden, Denmark, the largest online retailer in Nordics today, and I've also been the CEO of CDON.com, which is the largest marketplace in the Nordics. Heavily chased by Amazon these days, but still the largest one. And prior to joining Litium now, I was 4 years at Visma, and the largest subsidiary in Sweden, doing some product and business development and M&A in a CPO role there. So, and as you probably know, Visma is one of the true SaaS giants today in the European market space. So, and now I get to combine the two and help other companies succeed in e-commerce while building an awesome software company in the get-go. So for a guy like me, this is a perfect thing. It's pretty much a dream job. All right, Litium, I'll tell you a little bit more about it, just to do a quick flyby of current state and the business, and then we'll talk about the market trends and the potential, so we'll spend the time right where it's most important. But Litium is a tech company within the e-commerce space. Our product is an e-commerce platform, which comes with great functionality out of the box, but also can be customized to your specific needs as a customer. So it's really all the tools you need to run advanced e-commerce in today's market. It's delivered through a SaaS business model, so you subscribe to it as a client, and we go to market through a partner go-to-market model, which means we've got e-com experts selling, implementing, and supporting the platform. So this is a highly scalable go-to-market model when you get it right and you get traction in it. We are based in Sweden. We got Nordic. The Nordics is our target market, and more specifically, we call it the mid-market. It's product selling companies within manufacturing, distribution, and retail, with above 10 million SEK in yearly revenues or revenue sales. So this market consists of, we appreciate, it's about 15,000 companies. So it's a pretty big market in the Nordics, but also we are looking beyond that, and we are routinely beating up bigger players coming into our market in our home turf. So we don't really see any limits for the platform itself, and our clients use the platform in a global environment. So you go worldwide when selling. We got tons of clients selling in Europe, of course, China, and in the Nordic America. So there's no limitations in the platform. Okay, we've been doing this for a while. So back in 2013, the product company Litium that we know today was born. Prior to that, if you look up our history, we were a consultancy firm started back in '98, but this was divided into a consultancy side and a product side, and the consultancy side was divested back in 2013, and the product company was born. And through the years, we've added, of course, capabilities to both the platform and to the company itself. And we've been listed at Nordic at Nasdaq First North since December last year, 2020. Today, we got quite a bit north of 200 customers, pretty evenly split between B2B and B2C, and we got plus 40 solution partners, really the best ones in the Nordics. The true e-com experts are with us in our solution partner network. And sales through the platform is way surpassed 1 billion euros on a yearly basis. So there's quite a bit of chunk of the Nordic e-commerce go through the Litium platforms. All these efforts combined have left us with this financial profile today. We're just south of 60 million in ARR, our main KPI, which is annual recurring revenue. This was the Q3 report, and that was a 20% growth year over year. Pretty much all of our revenue is from the platform and the recurring revenue, so over 95% of the revenue is from the recurring model. We got a high gross margin of approximately 70%, which of course is a good thing because it leaves us with lots of room to maneuver to either invest in growth like we do now, or it also shows something about the profitability that we can bring in the company going ahead. So, but at this point, we've been investing in growth, and we've been doing that for quite some time. But if you've been following us, you've also been seeing that our EBITDA has been progressing and actually been improved for all of the quarters in this year. And in third quarter, we broke even on EBITDA, so we're definitely moving in the right direction. But the story for us is growth, and that is what we're going for looking ahead as well. So on the right there, you see that we got a long number of quarters with growth in ARR behind us, and we aim to continue that, of course, and also accelerate it. Okay, what have led us here is this, pretty much our mission statement, our focus on delivering great values to our customers. So our mission statement is to make our customers outperform their peers in digital commerce. And we got quite a few examples out there of customers doing just that. I want to bring up a few to give you some flavor on it. For example, we got Dynamic Code, who's in health tech. They were the fastest growing company in Sweden last year. They went from 20 million in sales to 280 million in sales. And their core business is DNA tests, but also this has been powered by a large uptick in PCR testing because of COVID. But just to be able to scale up, and that's a massive scale up that they've been doing, and they've been having Litium as their digital growth engine, and it wouldn't have been possible without that. So, I got an example from Finland. This is one of our Finnish customers, Dermosil. They're in beauty products. They've just won the Entrepreneur of the Year in Finland, and they've been praised for the trailblazing e-commerce, which is built on Litium. And one of our most talked about customers these days are RevolutionRace, where they made an IPO in the second quarter, and they just released their second report, and they doubled both their sales and their profit again. And they've been with us for 2.5 years now. I think it was since they changed to the Litium platform, and they've been, I mean, it's 3 or 4 times sales. So just goes for show that the Litium platform both drives and supports massive scaling. To be that successful, like the examples on the previous slide, you need a couple of things. The market landscape that you're looking at today, regardless of what vertical you're in, B2B or B2C, or what you're trying to achieve, as a business leader today, you're faced with a lot of opportunity, but also a lot of threat in the digital landscape. For example, I mean, the go-to-market possibilities are changing all the time. There's new channels popping up, new sort of display areas where am I going to be on this or am I not? And the competition is fierce, it's transparent, everything is global, and you're just facing all the competition all the time, 24/7, right? So it's rapid, it's complex, there's lots of opportunity, but also lots of threats. So you need sort of things to manage this. And to be able to do this and to get tech that supports what you need to do in the business, you need 3. Our point is that you need 3 basic things. You need flexibility to be able to maneuver. What works today might not work tomorrow, and new opportunities comes along all the time. You need speed to act, to go for those, either to go for opportunities or protect yourself from threats. And of course, you need capabilities to drive sales on a large scale, on a global scale. And then you need Litium. And this is where our product is great. It really solves this complex environment in a good way. The product itself, this is a very talky slide. I'm not going to go into the details of it, but on the left there you got pretty much the main components of the platform. You got the PIM handling all the products and how they relate to each other and all that makes this sellable, the products. You got the presentation layer, the CMS, and you got the commerce component, which handles order management, campaigns, and all business logic in the platform. On the top there, you got storefronts, whatever way you want to display the products that you're selling, or if you're going through marketplaces or other sales channels. And the connectivity in the bottom to hook up to your ERP, to your warehouse management system, personalization, and so forth. So you got all the ingredients to make a real advanced digital sales machine on the left there. But what our customers love about it is something I put on the right there. So just to give you an idea. So the first thing is the flexibility of it. You can use the parts separately or as a suit. They will work excellent together, but they also work excellent one by one. So you can pick them apart and you model use and use the best of breed strategy that much talked about these days. There's also a lot of buzz about something called composable commerce, and this is exactly what composable commerce is. You take the parts and you can use them to whatever need you're having at the moment, and you can also change them as you go along, which is that sort of modularity and flexibility. Flexibility is really what you need as a business leader today. Also, our building blocks is flexible in a way that you can actually recode them, so you can modelize them exactly to your exact needs. It doesn't just come out of the box. You can also redo them and customize them 100% if you like to do that. But they are great out of the box, so most customers choose to have them stay that way. The PIM handles seamless product management at very large scale. This is something that you really need. It's pretty much a must-have if you want to run advanced e-commerce today. If you're going to handle tens of thousands, millions of products, you really need a product management system to do that. You can't really do that manually or in a too small scale. So you need a tool that supports all the processing, and you can automate a lot of the processes with pictures and text and so forth. It's a powerful sales engine. In the new version now, we got the new campaign engine coming out, and also we got a globalization framework that's been in the product for quite some time. You can easily go to new markets. One of our clients, Didriksson, they said, pretty much I just click one button and I got the new country up and running. So that might be a bit simplistic description of things, but it's not far from what's actually going on. So great globalization network to go and sell worldwide. So just a few things and what our customers really love about the product. Now I got a few slides that talks about the testimonials of the flexibility and the globalization. I'm going to skip through this because I need to be on time and talk about a bit more about the future. Also about the positioning of our value proposition, the customer acquisition model that we're using, the logotypes, some highly skilled e-commerce solution partners that we work with in the Nordics, and the logotypes of very prominent and excellent customers that we got with us. I'm going to stop here for a little bit just to talk a little bit more about our clients. We got, like I said, north of 200 clients today, 50-50 split between B2B, B2C. This is something that makes us stand out a bit when you look on platform, because we are very strong on the business-to-business side, but also on the business-to-consumer side. And this is a good mix, since B2B is a couple of years back, and they all look for the sort of capabilities that consumer companies are pursuing today. We're pan-Nordic. We got clients in all of the Nordic companies, except Iceland, and also partners in all the Nordic countries. We got high retention rate when customers tend to stay with us for a long time. Of course, there is churn happening, but usually because someone been bought by another company, they want to move to some combined tech platform, but it's still an unusual event for us today that people or clients that choose Litium tends to stay for a long time. And the volume and the platform I already talked about, but there's tons of volume going through, and this is great potential for us going forward as well. All right, looking forward. That was a bit longer than I thought, but I got like 5 minutes, right, to go? Yeah. So looking forward, I'll just run this quite fast. On the commerce side, B2C side of commerce, the transformation from physical to digital is ongoing. It's a very strong trend. This was boosted by COVID, like we all know, but the trend was strong before, and we foresee it to be very strong for the foreseeable future going forward. And to be successful in this space, you need to be able to do two things in parallel. You need to be super relevant for the individuals and run it at very large scale at the same time. And this is quite a hard equation to solve, but you can do it by technology, and AI and ML is helping us today to do this. On the business-to-business side of things, we see that more companies will start to sort of reconsider their traditional sales model. Relationship sales is a bit different from the transactional sales that e-commerce has been built on, but now we got the tools, we got the abilities, and also we got the demand from the buyer side for our clients that they want a more digital experience, which is something they need to cater to. So we really see a wave of business-to-business companies switching to digital sales coming in. Many have already, of course, started, but this is only going to increase. And we see that business-to-business companies tend to look at business-to-consumer companies, what they've been doing to build great customer experiences and efficient sales and value chains. In commerce tech, tons of marketing tech solutions out there. Forrester expects there to be some specialization, so there will be specialized tech stacks for every sort of vertical out there in a couple of years down the road. And this also speaks to flexibility, because to be able to grasp the opportunity and the threats that you're facing, you need to have a flexible core to accommodate all those edge technologies that you might want to use going forward. And there's there's lots of investments going into the sector. Of course, it's a very attractive market. It's growing, and there's tons of opportunity here. But there's lots of influx of capital to both the merchant side and the software side, and we are both in both of those arenas. So that helps our business as well, of course. Okay, and looking at this, the trends going forward, we are very happy now to be able to announce that we've just released our latest value packaging, Litium Commerce Cloud. This consists of three main sort of building blocks. We got the top modern e-commerce platform. It's just been refactored to Microsoft.NET Core, .NET 5, which is the latest technology framework from Microsoft. This actually gives us an edge, because a few of our competitors haven't moved to this new latest framework yet. And the techies and the solution partners, they really want to use the latest and greatest in technology, and they love this move and to be able to work with the new technology. To go with this, we've also launched a customer success program to help our clients get the best everything out of the platform, to use it to its maximum capacity. So it's a package like insights and trainings and so forth. And to round it all off, we got the dynamic business model that we launched. So we taken our greatest unique selling point, flexibility, and also packaged it into our business model. So now we got the dynamic pricing model. It's more of a pay-as-you-go. So it's connected to how much the customer is actually selling and the capacity they are using to do so. So this gives us better ability to grow with the customers going forward. And also it's great for them, of course, and this aligns with our mission statement. And if they win, we win as well. So we really love this business model. All right, I'm closing in on the final pages here. Hope I'll be okay. Growth potential going forward, the most important stuff. I'm going to click these three up at the same time, because the Litium Commerce Cloud, our new value packaging, really gives us better potential to grow in these three dimensions. We're on a strong market. We already got a good position. We are already performing at a high level, but the new version of the platform really gives us even better market attractiveness. Scaling by partners, like I said, the new platform also make the solution partners of ours really add the likability to the platform and to work with it. It has really been increased with the new modernized .NET 5 core. So that's a great thing for us. And the new dynamic business model, a new platform, and the customer success program all together gives us a better ability to grow with our customers going forward. So it's up to all those. And B2B, talked a little bit about it. we got a really strong position in B2B, and it's only become better by the technology uplift, of course. But here we've been strong before because our flexibility, our platform really caters to the needs businesses companies are having and what they will face going forward. So we can help them in a great way to digitalize their sales and to reach new customers. So this is a really strong side of ours in our business model and in our platform. Penetration in the Nordic markets, we got 200 plus customers, like 15,000 in the target market. So there's tons to do still, tons of potential in the Nordics. But also, since we are winning over global players in our home turf on a regular basis, we really don't see there should be nothing stopping us going abroad, of course. But the competition is definitely hard out there. But if we can win in this market space, the Nordics, which is probably the most advanced tech market in the world, I might say. Usually you are pretty competitive when you go outside. At least that's our experience to it. So we think we got a great potential to go beyond. Acquisitions, we are taking a more active role in this market space. We see consolidation coming within platforms. We already see it happening to some extent. We think this will continue, and we see ourselves taking a proactive role in this going forward. So we got an overarching, we got a buy and build strategy. Yeah. All right. I think I need to cut it there. So I'll just have the key takeaways as a backdrop while you maybe ask me some questions, Rebecca.
Thank you very much for the presentation, Patrick.
Thank you.
My first question is regarding the Lithium Commerce Cloud that you launched last quarter.
Mm-hmm.
Can you tell us a little bit more about how this platform is different from the previous one?
It's really the business model. The platform itself has been modernized, but the business model, we have been doing a pretty, traditional small, medium, large packaging where you can buy additional packages to cater to more volumes in orders or products and so forth. But now we are simplifying this and also make it more dynamic. So you'll have a basic subscription which contains a lot of capacity for the customers. But then on top of that, we got the dynamic pricing depending on how much you sell and how much capacity you're actually using. So this is much better for the clients and for our customers, and also, it gives us more potential to grow with the customers as they grow their business. And the beauty of it is that we actually align our targets. So we want our customers to do fantastic because when they win, we also win. So we will grow our business value when they grow theirs.
Thank you.
Yeah.
And you touched upon it. You mentioned M&A.
Yeah.
What kind of acquisitions are you targeting or looking into?
Well, we're looking at basically things that are close to ourselves and our core business. That's the most, interesting sort of cooperations we are investigating. Yeah.
Yeah. Interesting. And also, when it comes to growth versus profitability, what is Lithium's strategy?
The $1 million question. No, but basically, we like growth. We've been investing in growth. We think our position is really good to keep on growing, and the market is strong. We got a strong position. The rationale to keep on investing in growth is really strong, right? So, but eventually, in the end, we want to build a value machine for our shareholders, and so that's what we're going for in the long run, of course. But I think we want to grow the company bigger before we turn more to profitability. It makes the most sense, I would say. Yeah.
Yeah. All right. Thank you. I think our time is up. Thank you very much for the presentation, Patrick.
Thanks for having me, Rebecca.
Thank you very much.
All right. Cheers, guys.
Hi, and welcome back to ABG Investor Day. My name is Rebecca Gärderup, and I am an analyst here at ABG covering the IT and tech sector. Today, we're gonna have Careium here presenting with the CEO, Carl-Johan Zetterberg Baudry. And he will give us an update and a brief about Careium. Carl-Johan, please go ahead.
Thank you very much, Rebecca. As Rebecca said, my name is Carl-Johan Zetterberg Baudry, and I'm the President and CEO of Careium, where Careium will actually have its first day of trading on Friday, December 10th, when we will be listed on First North, because Careium is a separate listing from Doro and the former business area Doro Care within Doro. We can take next slide, Rebecca. So Careium, and the focus on Careium is we want to transform senior care to ensure that we help individuals to live independently with increased stability of life, and also ensure resource efficiency. Because we are confident that the growing elderly population is one of society's largest challenges today, where technology-enabled care is one of the key solutions to this equation. Where we in Careium, through our integrated technology solution, the strong service delivery organization we have, and experience in transforming senior care, and especially going from analog to digital, we want to be a key force in solving this equation and ensuring independence and resource efficiency. Next slide, Rebecca. Maybe to give you a better example of what we do at Careium and a little bit of the solutions that we deliver on a daily basis, then I would like to introduce you to two of our end users, being Arthur and June, where June suffers from dementia and also with a clear risk of falling. She's taken care of by her husband, Arthur, who's also old and suffers from typical sort of conditions when you get older. But thanks to our products and services, being care phones, fall detectors, movement sensors, both Arthur and June can continue to live at home with the safety and independence that they want and that they deserve, where Arthur can feel sort of reassured that June is taken care of, even when Arthur is not have the opportunity to support June. And they are, of course, connected to our contact center, where as if something happens, they always have us as a backup service 24/7, both from a contact center perspective and responder service perspective. So this is a clear example of two of our end users and how our services and products support the independence and well-being of seniors. Next slide, Rebecca. So I will give you a short introduction about Careium, talk to you a little bit about the market that we serve, and then again, some more focus on how we want to transform senior care. Next slide. So Careium today, Careium is a market leader in Northern Europe in technology-enabled care, where we serve roughly 400,000 end users on a daily basis through our 1,000 employees, where we handle around 25,000 incoming alarms to our 6 alarm receiving centers that we have in Sweden, Norway, and the UK. From a revenue perspective, Careium is approximately 0.6 billion Swedish kronor in revenue, of which 80% is revenue from the services we deliver and recurring revenue based on the service delivery contracts that we have. And Careium has grown since, you could say, the start in Doro, when Doro acquired Caretech back in late 2014, with in average 21% per year. Next slide, Rebecca. So our vision at Careium and what we are dedicated to on a daily basis is we want to make sure that all users live a richer life, feel confident, secured, and cared for. We'll take next slide, Rebecca. So our business is technology-enabled care services that we deliver and are used both by the end user senior itself, by relatives and caregivers. And it consists of both software, hardware, and services, where hardware, the main hardware pieces are the care phone or the home hub and different sensors, such as smoke alarms, bed sensors, motion detectors, and other sensors. And then software solutions, both in terms of our own alarm receiving platform, but also a platform for device management, data management, and user management, where we cater both to individual living, people living at home on their own still, and assisted living sheltered schemes, so care homes. We are the market leader in Northern Europe, where we have a market share in Sweden and Norway of roughly 40% in number of connections in the market that we handle. UK and the Netherlands, we are a little bit above 10% in two markets that are more fragmented than the markets in the Nordics, where our market share in the UK and in the Netherlands also gives us a market leading position in these two markets. Next slide, Rebecca. So Careium have grown with roughly 21% per year for the last 6 years, where we are now close to 600 million Swedish kronor in revenue, of which 80% of the revenue comes from services. Because mostly of our business is driven through public procurement, where municipalities, local authorities are our main customers, where we to these customers deliver sort of three different distinct business models or offerings. One is the managed service offering, where we deliver the service piece, the software piece, and hardware as a fully managed service to our customers. The second element is software as a service, where we deliver our software platform as a service. And the third element is hardware or product sales that account for 20% of total revenues. And products can be a part of the sales to a customer. So a customer could, for example, be a customer of fully managed services to us, and in addition, we also do some hardware sales to the same customer. The main sales that we see in products are to the markets outside of our home market, Sweden, Norway, UK, and the Netherlands, where we also sell our products to similar companies as Careium in countries such as France and Germany. And as our business is predominantly a public procurement business to local authorities, the average contract length with our customers and local authorities are 4 to 5 years. So typically a contract would have an initial contract length of maybe 3 years with an extension opportunity of 1 + 1 year, giving us an average of 4 to 5 years in contract length with our customers. We can take 2 slides ahead. Oh, sorry, no, 1 slide ahead. 1 slide left. Because I think this is an important element of what we do at Careium as well. Because both to us and to our customers and to our end users, sustainability is a very important factor. And we contribute to a more sustainable society in what we do on an everyday basis. And especially we see that the work we do at Careium contributes to a more sustainable society through efficient use of resources, a greater inclusion in society and more independent life. And also that a lot of the products and services that we deliver and that we develop, they have a long lifetime and as low as possible sort of life cycle effects on the environment. Now we can move 2 slides ahead, Rebecca. So let me give you a short sort of insight to our market. Senior care and society are facing a number of challenges as a result of the growing elderly population, both in relative terms and in absolute terms. The number of seniors or people above 65 years of age will grow significantly in Europe in the coming 30 years. And in addition, we also see that, and to a large extent as a result of the growing elderly population, there is a clear funding gap in care costs that is also set to increase quite dramatically in the coming years. And in addition to sort of a funding gap from a financial perspective, there is a funding gap, you can call it, from a resource perspective, where there are not already today, and that challenge is just set to increase in the future, where there's a lack of sufficient resources in healthcare professionals. But from a positive sort of perspective, you could say that being able to treat people or for people to live independently at home is a clear opportunity, because residential care is around 4 times more expensive than home care, and hospital care is then twice as expensive as residential care, which means 8 times as expensive as home care. That's why we at Careium, we are confident that technology is part of the solution, because that will enable seniors to care at home and reduce costs for society. And as a positive effect as well, both for the individual itself, but also for society and for relatives. And we at Careium, together with Doro, we have initiated a commission of loneliness that we are very involved in. And in sort of one of the studies we've done, we've seen as well that people living independently at home, they typically are mentally feeling better than people living in residential and hospital care as well, even though individuals in residential and hospital care have maybe more individuals or other people surrounding them on a daily basis. But from a mental wellness perspective, people living individually at home are feeling better. So that's a positive effect as well, not only as we see from a cost and an independence perspective, but also from a mental well-being perspective. You can take next slide, Rebecca. So maybe to show a little bit more concrete why technology-enabled care will increase quality of life for seniors and reduce cost for society. Because with technology-enabled care, we see that we can delay institutional care. People can stay longer in their own homes or in residential care. We can reduce hospital admissions. We can enable seniors to live independently in their own home. But we can also enable friends and family to stay informed and to stay involved. And most importantly, we can help the individual, so the end user, the senior, to live with increased independency, safety, and quality of life in their own home. Next slide, Rebecca. So based on sort of some of the challenges we see that society are facing, there are a number of growth drivers impacting our market. The addressable market grows as the number of seniors is increasing and is set to increase in the coming years. But also we see that the penetration of technology-enabled care services is increasing. And also the scope of services that's delivered, because technology will enable and are enabling new type of services. But the scope of services are increasing, and as a result, the average revenue per user is set to increase. And finally, which you could say is more of a transformation that needs to happen in the market that will drive growth in the market, is an analog to digital shift, because in many markets, technology-enabled care are still based on analog solutions, meaning that the connectivity is typically through the old PSTN copper-based communication lines. The Nordics are digitalized, but a large part of the rest of Europe, they're not. And this is a transformation that needs to happen, because in many countries, the analog networks are going to be shut down in the next few years. Why sort of a transformation, a digital shift, and what we believe sort of more mature market will be a result of that shift. And all these factors in combination, but also sort of each and every one of them working sort of in their own right, will drive a strong growth in our market in the coming years. Next slide, Rebecca. So how do we at Careium want to be sort of a key force in transforming senior care? So we can take next slide, Rebecca. One of the key elements that we see is important and that technology will enable us to do is to move from a current market in technology-enabled care that is based more on analog connectivity, more standalone systems, and more reactive type of solutions. By that, I mean typically an event has happened and you trigger an alarm based on something that's already happened and you need assistance. What we want to move to, and that we're focusing on and building sort of our new type of services towards, is a digital future where there's sort of digital integration, where there is integrated hardware and software and services solutions instead of standalone systems, where we are looking at actively, you can call it monitoring, or actively viewing daily activities of life in order to move to a future market that is more predictive, proactive, and preventive. And just sort of to say a very simple example of the predictive, proactive, and preventive future, in the first instance, it's not more difficult than to be able to maybe analyze how has call patterns evolved during the last 2 months. Or we have medicine dispensers, for example, and bed sensors, where we can actively see if a new medication is given, maybe the sleeping pattern changes, and we can see that an end user are awake very much at night, they need to go up, maybe go to the toilet, maybe to take a glass of water, whatever it might be, because we see that maybe the medication or the dose of medication that they have received have impacted other elements. And then we can more proactively see, okay, we need to change the medication, or feedback to the doctors that they need to review on how they can change the medication. In a more long-term sort of future, utilizing sensor information, we could, for example, start to detect, is there early signs of dementia? And then start to put in proactive activities in order to, in best case, sort of hinder dementia from occurring, but probably most likely, which will be an extreme sort of importance to the end user, to relatives, and to society if we can postpone dementia and sort of limit the symptoms from it. So by that, that's what we mean, going from a current market being analog, standalone, and reactive to a digitalized, connected market that's predictive, proactive, and preventive. Next slide, Rebecca. What's important for us from Careium's perspective in order to deliver on tomorrow's solutions and more proactive, preventive, and predictive solutions is our integrated technology and service delivery platform. That's based on, you could say, the software platform that's almost a base that both caters to alarm handling and notification handling in contact centers, but also, as I said, device management, user management, data management, in order to be able to do the analytics that we described in tomorrow's solutions, which we are using in our service delivery, but that also can be sold as a service to other service delivery companies in other markets. Then you could say the first pillar on the software foundation, that's devices and sensors, where we are focusing on developing sort of selected few products that we see are core in the solutions that we deliver, being predominantly the Carephone or the Home Hub. Other products, such as smoke detectors, motion sensors, watches, we will use best-of-breed third-party products for the solutions that we want to deliver and integrate them into our ecosystem. And this is to the second pillar, being the service delivery, where our contact centers that we today have in Sweden, Norway, and the UK, handling around 25,000 incoming calls every day, in combination with responder services and field engineers, all these three elements combined is our integrated technology and service delivery platform, where we differentiate to a large part of our competitors, having all three elements in the solution, all three pillars in our offering. Next slide, Rebecca. So what we want to achieve going forward with our integrated technology platform is to continue to drive growth. As said, we've grown in the last 6 years with an average of 21% per year, and we want to continue to drive both organic growth that we want to drive through increased market share in individual living, further expanding our market position, our offering into assisted living market, delivering new type of services and tomorrow type of services to expand average revenue per user, and also to focus on the digital shift to happen. Where I said, Sweden and Norway are digitalized. Looking at our largest home market today, the UK, that's to 95% still analog, where we want to be one of the companies who will drive the digital transformation in the UK and to ensure sort of a more mature UK market. Next slide, Rebecca. And in combination with driving our organic growth, we will continue to have an active acquisition agenda. In the last 6 years, you could say, since the first acquisition of CareTech back in 2014, we have continued to acquire a number of companies, both to give us a platform in new countries, such as the first acquisition in Norway, the first acquisition in the UK, and the first acquisition in the Netherlands. And then we have continued, especially in the UK, that's a fragmented market, continue to strengthen our position in the UK to have a strong base to leverage the digital shift to happen in the UK and our experience in that digital shift. So acquisitions will continue to be both in new markets to get a platform to build from in a new geographical market, but also to strengthen our position in some of our existing home markets. So that will continue to be a focus for us going forward. Next slide, Rebecca. So finally, in summary, I would say Careium, and we are sort of a stock-listed company from Friday. We will focus on transforming senior care because technology will be one of the key elements in solving many of the challenges that we see in society with an increasing elderly population. And I am very confident and sort of very excited to start the journey of Careium when we are stock listed on Friday as a separate company and continue to build a strong technology-enabled care company to support end users, society, and relatives, and transform senior care. Thank you.
Thank you very much for the presentation, Carl-Johan. Just one question. You mentioned that on Friday is the first day then when Careium can be traded. What do you see as the greatest advantage when no longer being a part of Doro?
The key element for us sort of separating Doro and Carium is to ensure the right focus for both businesses, because our customers, our business model, and our offering differ between the two companies. And being separately listed will give us a greater opportunity to give each business and each sort of customer and offering the right focus to ensure that both companies are as successful as they can be.
All right. Thank you very much. And thank you again for the presentation. I think our time is up.
Okay. Thank you very much.
Thank you very much, Carl-Johan.
Hello and welcome to this next presentation here at ABG Investor Days. My name is Simon Granat and I work as an equity analyst at ABG covering IT and tech companies. And today we're super excited to have Fortnox with us and its COO Johan Lundgren. And he will present the company for about 20 minutes or so, and then we will follow up with a shorter Q&A session. So with that said, Johan, please go ahead and present.
Great. Thank you, Simon. Great to be here at the ABG Investor Day. You can go to the next slide, please. So my name is Johan Lundgren, Business Unit Manager and COO at Fortnox. Unfortunately, our CEO, Tommy, couldn't join today, so I will be the one that runs through the presentation. It will be pretty straightforward. I will go through Fortnox in a brief, some number, go through our customer offer and some of our products, and touch the M&A strategy we have. That's pretty much it. I think we can do in 20 minutes. So let's jump into the next slide. Just briefly about Fortnox, you could believe that we are a five-year-old tech company, but we're actually celebrating 20 years this year. And the business has really been taking off the last, I would say, 10 years. We are located with head office here in Växjö, where I'm located. And then we have offices in Malmö, Linköping, and Stockholm, and we are about 600 employees. Next, please. And if you would look at Fortnox, like, let's put it in the words, in a nutshell, we are coming from being the company that gave back a lot of time. And what I mean with that is that through a small amount per month, a company became much more efficient because we removed through other products a lot of administration. So that's been the success path for Fortnox. What we want to do going forward is to be closer to the core business of any company and support them also to grow their business, meaning that we will have more products closer to core and more, for example, insights that will help them to be more successful. So if we go to next slide, you can see our vision is then to enable a prosperous society shaped by thriving businesses. So we really believe that by using our platform, you become more successful, and of course, successful companies supports the society in whole. Next slide, we can see briefly how we are organized. We have 6 business units within Fortnox, and we set up this structure last year to get closer to customers and our stakeholders. And we believe that this setup makes it easier for us to grow and to also to adapt if we would do any further M&As, acquisitions. So we have to the left Pengar and Entreprenören, business units working mainly with the product development. And to the right-hand side, we have our sales teams working with direct customers and accounting firms. I will come to that a little bit later. And then we have something called marketplaces, where we have our app store and Offerta, and then Firman, or the firm in English, which I'm representing, which consists of all the supporting divisions, which are, for example, HR, communication, IT operations, infrastructure, workplace, legal and compliance, finance, and so on. Cool. That was in a brief about Fortnox. Let's jump into our offering. Can jump to the next slide too, Samuel. Thank you. So I'm trying in this picture to illustrate a little bit how our offering works. So we provide a full package to small and medium, large enterprises, like a toolbox that makes them run and boom or blooming their businesses, basically. So we have our own native products that we're developing in-house, which we are maybe most famous for our automated bookkeeping or solutions around employees and so on, which I will touch on a little bit later. But we also have open APIs to our platform. So we invite and partner with a lot of different vendors to be able to cater for all different needs through the platform. So we have more than 400 connections with other parties. And for that, we can then deliver bookkeeping, but you can also get payment solutions from our partners. So we can build industry-specific solutions which are tailored for an industry need, which could be, let's say, a carpenter or a farmer or a lawyer. So if you go to the next slide, you will see how we are tailoring from like the offering to our pricing strategy, where we are the 99 kronor a month company for a product. and for one user. And I think this is the real success of Fortnox, because the ERP system back in the days were not tailored for small and medium companies. So it was only for the large one. So the on-prem solution you could find back in the days were very complex or too complicated and expensive. And now we have something for only 99 kronor a month. You get an ERP system that are tailored for your needs. And then you can add on with products based on your needs. And you have transaction-based fees also connected to billing and payslips and invoices. Or we deliver packages with a discount, or we deliver solutions, like I said before, based on industry needs. So going to the next slide, you can see it in a different visualized way, how we are delivering our offering. And it's extremely scalable because it doesn't cost us that much to add a user or a product. And a customer for us is a company, and then you have users on which could be an employee, a CFO or CEO. So that's how we scale the usage. And we believe that what we call solutions is something that vertical within the offering is something we believe can grow a lot going ahead to catering it for different industry-specific needs. Great. Let's jump to the next slide then and talk a little bit about our customers. So first, starting off with to look at how do all the customers enter our platform? And we have main two distribution channels. So the one to the left, the direct customers come through our website. We have a direct relationship, or we have all the accounting firms that we work with they use then Fortnox as their backbone system. And every time they add a client or a new company, that of course becomes a customer on our platform too. So either the direct customer also often move between the sides due to that you sooner or later often need support from an accounting firm. Then you can actually be on both sides. And then you have the companies under the accounting firms often start to do things themselves as invoicing, adding receipts and so on. And then they also use the platform themselves at the same time as the accounting firm use the platform. So I think this has been the success looking back is that we have been building strong relationships with accounting firms. And looking on the next slide, you can see our market position connected to this. We have plus 20,000 accounting firms in Sweden. We have thousands of them using Fortnox as their backbone. So we have the big five, and we have the 25 biggest accounting firms after the big five. So we are predominant within large and medium and potential to go within the small ones. But this win-win relationship where we provide products and a platform for them to be smarter and more efficient enables them to improve their business and relationships too, of course. So that's through the accounting firms, we onboard a lot of customers, of course. The traditional corporation on our platform is typically 5 to 9 employees. We see that we have big potential to grow both to larger enterprises and smaller. So for example, we just during this year released something we call Salary Mini. So if you are self-employed, you can through a couple of single click on your mobile, pay out your salary. And we do everything in the background for you. And at the same time, if you look at the larger companies, we, just an example of course, but Fortnox is using our own ERP system, of course, and we are pretty big compared to the average company you see here with a lot of certificates per month in a quite complex structure. So it works very well for even larger companies. Cool. Let's move further to look at some numbers. So starting with sales and EBIT then. I think it's the figure says itself basically, but we have been very stable in terms of growth and EBIT growth during the last years. And this is back to 2017 Q1 with a roughly 50 million in sales to last Q3 that we reported nearly 250 with a solid profitability over the years. And we actually reached above 100 million in EBIT for the first time last quarter. And we have an average revenue per customer at 184. Cool. Let's have a look at the next slide. Growth and margin is important for us together internally because we measure it as a rule of 60. That's the Fortnox rule. You often say that a company like Fortnox measure themselves on rule of 40, but we always aim for rule of 60, which we've been very proud of been reaching for a long period of time, and we continue to aim for that, of course. So last quarter was super strong with growth plus margin close to 80. Next slide, we can look at our customer base. It's similar to the sales. We are growing steady with customers. We will aim for 700,000 customers at 2025. So if you look at the next slide, you see some of our ambitions in brackets. We usually don't talk that much about future-looking statements, but we have been mentioning during Capital Market Days that we are aiming for 700,000 customers and an RPC of 300 with higher usage of our products and a different maybe mix also of our products. But since the business model is quite straightforward, you can do the math yourself if we would reach this. It's very ambitious, but we're also very confident in our plans going ahead. Let's jump into the product areas. So this is how we are structured within Fortnox. We have 9 product areas. These are our building blocks. And beneath, we have roughly plus 30 products, product teams that are working. And I will jump into the light green today. So let's jump into accounting, because I mean, accounting, of course, is the real game changer back in the days when it really took off, since this was the first time companies, accounting firms and authorities could find a platform to communicate and collaborate through in an efficient way. And this is still some of our strongest advantages, this product area with extremely high usage. And we believe, I mean, we are, or let's put it like this, we are investing a lot to always be forefront within this. And the end goal, the end state is, of course, to have a no-touch, fully no-touch accounting product, meaning that everything would be automatically done. Reaching that, we will have bookkeeping in real time, for real, so to say, which would give us tremendous advantages. We will be able to look, to be relevant, I mean, what's in the book here and now, but also be able to predict much more in the future. One piece of the puzzle that's been missing for many years is on the next slide, that also I want to share, is that we released our new product suite now during September. And it's basically everything that's happening after bookkeeping. This has been very asked for all the accounting firms, when will we have this product? So we did an M&A or we bought Agoy, a company in Stockholm that had built this module and product. So we integrated that to our platform and is now rolling it out to accounting firms during fall, and will scale it during next year. So this is a very important piece of the puzzle to have a very strong offer within this area. And previously it was not possible to do it in the cloud. It's a very complex processes usually done on-prem solutions. The next product area I will touch is billing, a very competitive and a competent ecosystem of things you need when you sell services, goods, or both. Or if you sell a lot of inventory or goods, you have a good inventory systems through this setup too. And here we are integrated with a lot of partners. I mean, for example, if you look at time and project, it's very different to report time if you're a lawyer or if you have a hairdresser or a carpenter. And here we need strong collaborations with other vendors, which we are integrating into our platform to deliver a much more than industry-specific needs. We are sending roughly one invoice every other second, and we have more than 10% of the GDP in Sweden through our building. So it's very used and a well-functioning product area. The next one is about people, and very smooth end-to-end experience for all involved parties. We have, of course, then employees and employer and a lot of different authorities, but it is mainly about then salary payments, tax, pensions, time reporting, and more. We believe that we can reach 1 million payslips within the coming years. And of course, you can imagine, I mean, the relationship we create with so many employees and the opportunities that lies in that going ahead. Next one is then financing, where we basically offer, I mean, invoice service, where we help the customer to distribute the invoice, get paid, bookkeep automatically, and so forth. So this is an area we believe we can make a big difference for small and medium enterprises with the size and knowledge we have on our platform to really give competitive rates and support with, I mean, everything that is supporting your cash flow, liquidity, and working capital, and so on. To the right, you see some of what we've been communicating before about products we believe in that we will develop. It's the buy now and pay later, or get paid instantly. So we believe we have a lot of good development in our roadmaps connected to financing. And for a couple of weeks ago, we also did the merger with Capcito, which is strengthening this area a lot. Also from that company delivering even smarter real-time credit scoring, which will be key within this area going forward. Great. Let's jump in to the M&A part. Just to, I mean, I want to touch on this due to that a part of our growth journey going ahead is that we will have our eyes open for companies that will complete us on our platform. So some of the target groups you can see to the left that we believe could be an option within the M&A area, but it's important that the product offer is scalable on our customer base that we currently have, that we can extract clear synergies, that the technology is not outdated or too unique, so it's doable to integrate it without too much costs. And I would say typically 5 to 200 million in sales, what we look at, and that we see that we can set a plan within 2 years to reach our rule of 60. So it's rather just to put the light on that we will continue to have our eyes open on this area, and we've been quite active during 2021. And then to finalize these 20 minutes, a little bit where I started. Fortnox is coming from, I mean, the burden of administration and removing that from businesses to give back time. We want in the future to take a broader perspective of how we support companies to be successful. So we will continue to be best in class on our core products, but we will also then continue to deliver more insights and products closer to their core businesses to support companies to grow and prosper even more. And here we believe we can bring a big value, and from this increase the customer intake, increase the usage, and from that increase the RPC per customer, and reach our targets for 2025. That was it for 20 minutes. Thanks you a lot for listening.
Thank you so much, Johan. A great presentation indeed. Initially, I'd like to ask on one of the slides you showed earlier, where you showed a picture of your various customer acquisition channels. Could you talk a little bit about the pros and cons on when a customer comes directly from the website versus when it comes through an accounting firm?
I mean, that's a good question, Simon. I think pros and cons, there are always pros and cons. And I think if we go for the accounting firm, it can take some time before you actually understand you are on Fortnox platform. But on the other hand side, you have an accountant that can support you and guide you what you need. So I would say it's always two sides of the coin for both ways into the platform. And on the other side, you have the opposite coming from being direct customer. Then you don't have that support from the accounting firm to guide you in the fastest way.
And thank you for that. In the first half of 2021, you have made some internal improvements. Could you talk a little bit about what has that meant for your business? All these shifts that you've seen from platforms within the finance offering, etc. How well equipped are you for growth as we are soon to enter 2022 here?
I mean, we have done some investments during the year, and one part is the finance platform that been partly struggling, to be straightforward, during fall, but we are now moved all the customers to all the data and functionality to the new platforms. We believe that will support the growth for next year. But we've also done some infrastructure investments, which lies within my area. For example, how we see on our core infrastructure, IT and operations, which has been very successful during. We were more or less nearly done after summer, and that will help us to scale efficient let's see how you scale efficient in terms not only efficient but also with high security. So we changed the whole infrastructure, how we steer our datahallar. I'm struggling to find the word in English. Data center.
Yeah. Thank you for that. And I know you touched upon the subject recently, but it's also a relevant question, I believe, given that you recently announced the acquisition of Capcito, which I think sounds like a very interesting company. Could you talk us through the initial rationale behind this acquisition?
About Capcito is coming from starting off from the call it the frustration of that small startups or small companies and medium companies couldn't get the same financing opportunities as larger companies can. So we believe that that's a very good match with what we have on our platform, since we are a company really directed towards small and medium companies. So we believe that we can create a synergy between the companies and the technology and the customer base, and be able to provide financing in a very competitive way.
And in your 2025 targets that you have statuted for in conjunction with the Capital Markets Day here in January, you have some forward-leaning targets. Would you say that there are any specific product areas that are particularly important for them to achieve in order for you to reach these goals, or is it more so that you need to achieve broad-based growth here?
We haven't communicated any specific rationale behind that, so I wouldn't say. I mean, we aim to grow on all the different products we have, increase usage and broadly. But of course, as we're investing in finance, it's a very important area for us to contribute to the future growth.
Thank you so much for attending here, Johan. We will now end the session. So thank you so much.
Thank you very much. Have a great day, everyone. Bye-bye.
Bye.
Hi and welcome everyone for the next presentation of today's seminar. My name is Daniel Thorsson, Equity Research Analyst at ABG, covering the IT and tech space. And the next presentation is with Proact and the CEO, Jonas Hasselberg. So go ahead, Jonas, welcome.
Thank you very much. Thanks for having me. And thanks everyone for listening. I'll spend a couple of minutes here just going through who is Proact and what we do and how are we doing. And then hopefully you'll get a good picture of us as a company. So starting here, just a basic introduction. We've been around for about 27 years. We're a Swedish IT company, of course. We're based out of Stockholm, but we have presence in about 13 countries across Europe. We deliver business value to our customers, and I'll go a little bit deeper into that here in a second. We serve primarily mid and large size enterprises across Europe. We have about 4,000 customers that we serve on a regular basis. Our turnover is just above 400 million euros. And with our last acquisition here few months ago, we're about 1,100 employees across the countries here, as you can see. But I want to take a step back and just talk a little bit about the trends in the market and what's driving, in particular, our customers. And there are three main trends. Most of our customers, if not all, are going through some sort of digital transformation. They're trying to improve their business in, can be a number of ways. They want to deliver a better customer experience, or they want to make better decisions by analyzing data, or they may want to automate production or processes, whatever it may be. And all of this they're trying to enable through IT. And this is becoming, of course, a very important business driver for our customer and therefore for us. So that's one of the key trends that we're building our strategy and our future on. The other strategy is what we call multi-cloud, which is more of a technology trend. And it's all about how technology is being used and how IT in particular is being architected to enable the transformation customers are driving for. And it's about cloud technologies, so scalable, agile, fast deployed technologies, but in a number of different ways. It could be what most people refer to as the public clouds, or the Microsoft and the Googles of the world, but it may also be cloud technologies that the customers deploy in their own data centers, or if they let Proact run it for them. And our strong view is that the world is not becoming easier necessarily for our customers from a pure technology perspective. Development is moving very, very quickly. Technology is evolving fast. Skilled resources are difficult to find, and our customers are typically more and more dependent on partners like ourselves to enable their transformation. And then the third trend, and maybe the most tricky one, or if I may say so sad one, is cyber threats. So the need for our customers to protect their data in particular and their IT infrastructure in general from attacks. So cybersecurity and cyber protection is the third very important trend. And all of these three are very much driving our strategy going forward. So what we do, we're a specialist. We're very niched, if you will, in our value proposition. We are all focused on delivering value to our customers through their data. We think data is the new gold for our customers. This is where a lot of their intelligence and potential lies. So we want to help our customers from everything to create a strategy around how they manage and store and protect their data, to the actual physical storage of the data. And obviously we talk about large amounts of data here from large enterprises, connecting to the data. So the data may be distributed across many different sites or maybe different data centers. And we want people from a number of different locations to get access to it, from laptops, mobiles, whatever. Security and protection, of course, not only against cyber threats, but backup, recovery capabilities to know that the data integrity is always there. And then last but definitely not least, then getting the actual value out of the data, which could then be analytics, automation, artificial intelligence. So these are kind of the value propositions we want to help our customers with. We have 4 main revenue streams or service lines. Consulting, so we provide help with our customers, everything from data strategies, technology architecting, technology implementation, operations, training, classic consulting offerings to our customers. So that's number one. Number two, managed services. So we run IT infrastructure on behalf of our customers. So IT as a service, if you will, and these are then what we call cloud services or managed cloud services. Third, hardware and software. So this is a reselling business, typically vendors, pretty known vendors like Dell and NetApp and Cisco, in terms of reselling and implementing large implementations for their infrastructure. And then last and definitely not least, support. So making sure that our customers' IT is up and running and is always up to date. So 4 main revenue streams that are underpinning our business. Obviously, the actual products we're offering are quite a wide range. We always put our customers at the forefront and center of our portfolio here. And then in this wheel, you recognize then the five value propositions and a range of products ranging from storage solutions, networking solutions, disaster recovery, cybersecurity, cyber monitoring solutions, artificial intelligence platforms. So quite a breadth of products and services to cover all these areas. And one thing that we get a lot of questions around, well, is how do we play in the context of what we call then the public cloud or the hyperscalers, which is another term. So the Microsofts of the world with their deployment. And our position there is we play very well together with them. They provide another technology platform that we can work with and develop services on top. So when we engage with our customers in this multi-cloud discussion, we have a lot of discussions around when do you use Microsoft and what are they best for, or the Google or the Amazon. When do you let Proact run some of your infrastructure, and what things are most critical for you as a customer to manage yourselves? Data is obviously mission critical. A lot of our customers do not want the data to leave country borders or maybe not even leave their own premises. So that's a very good topic to discuss with customer in terms of when do you let it flow over country borders? When do you let somebody like Microsoft or Google to store it for you? And when it's more crucial and critical for you as customer to manage it yourself. So we support all of these deployment models and are pretty transparent to what the customer feel is best for them. Wanted to highlight 2 customer cases that are, we think, pretty descriptive. There's a Swedish customer called Fortnox. They are a forward leading and leaning software as a service company based out of Sweden. They deliver effectively ERP or ERP software to mid-sized companies, and they develop their own mission critical platform. So they run the software on their platforms on behalf of their customers, and Proact is delivering a range of both in-house platforms that Fortnox is managing themselves. They run it across a redundant set of data centers that are geographically distributed. We manage the network connectivity between the data centers for them, and we provide some of our services to secure the data in terms of backup and disaster recovery. So it's kind of a very typical customer for Proact in the sense that they engage with us on our complete set of product lines, so consulting, managed services, system sales, and technical support. So a very, very typical and very good customer on our behalf. Another case I wanted to highlight, which is a little bit more recent, is a Swedish insurance company called AFA or AFA. They are also a customer of a company that we acquired here in the spring called Conoa. So together we are delivering a new application development platform for the customer. So they want to get their time down for developing new applications and updating their applications from usually what took them months down to hours or a few days. And we're doing this by delivering a complete new modern cloud native development platform that enables them to be much, much quicker in how they iterate and develop their software. So another good example of how the technology we provide and the platforms we provide helps our customer gain some very clear business value for them. Strategy-wise, from a numbers perspective, we've been pretty clear that we want to continue to grow our business. We have an ambition to grow at least 10% per year over the period of time, or on average, I should say, 10% per year. We do aspire to grow our profit margin, measured as EBITDA, from today's roughly 6% to 8%. And then we want to move our revenue mix to services as much as we can. We're currently running about 60% resell, 40% services. And we think we can be at 50-50 in the near future. And this helps us give a little bit more predictive revenue stream, better profit margins, but more importantly, a better value and better relationship with our customers. Strategy-wise, we accelerate our strategy very much through acquisitions. We've done 4 acquisitions here in the last 2 years, so we try to be at a pace of about 2 per year. 2 years ago, we did an acquisition in the Netherlands of a company called Peopleware. They are very strong and very skilled in running end-to-end infrastructure or IT environments on behalf of their customers on top of Microsoft technologies, both on the workspace but also on the infrastructure side. They brought about almost 30 million euros into our business and almost 220 very skilled specialists and technology-savvy engineers into our organization. They are now fully integrated into Proact in the Netherlands. We're operating in one team towards our customer with a combined portfolio and under the same brand. And then about a year later, in October of last year, we acquired a company in Manchester, UK, called Cetus, very good in hybrid cloud solutions, so very technology focused on helping customers with that hybrid or multi-cloud environment that we talked about 13 million British pounds, 50 employees, also now almost fully integrated and operating, at least within soon, under the Proact brand in the UK market. And then here in Stockholm, in April of this year, a smaller company called Conoa, that are probably among the best in the region, if not the best in Europe, on cloud-native development platforms, super skilled consultants. And then last and only recently, a rather big company in Germany called AHD. Very good in running managed cloud services, complementing us very well also regionally in Germany. So they have a strong foothold in the Düsseldorf area, which is an important business region, of course, in Germany. So 4 very good acquisitions that are both giving us market share and new customers, but obviously complementing us as well with regards to the expertise and the portfolio. A little bit maybe now outdated in terms of numbers from our last quarterly report, the Q3 report in end of October. Good growth on the services side, positive development on our profit and gross margins. TCV is a terminology we use to describe the sales or the bookings, if you will, of cloud services. TCV stands for total contract value, so it's the value of the contract over its committed length. Could be 3 years, could be even over 5 years in some cases, and a good growth also in the bookings of new managed cloud services in the quarter. A little bit of a revenue decline. We spoke a lot about it at the time of the release of the report. Definitely some negative impact from the pandemic still in terms of engaging with customers and customers being willing or able to make investment decisions. Also seeing a little bit of impact from the semiconductor shortages, which is very general and broad in the marketplace. And obviously also looking forward, the COVID uncertainties, of course, remain, and we continue to see that also in the marketplace currently. So if I summarize, I think we are very clear in our position, and our position we think is very strong with regards to where our customers are going with their digital transformation journeys and their ambition to drive business value out of IT. We are specialists. We are focusing, helping our customers get value out of their data and out of their information. We're looking very positively at the investment trends over the next couple of years. We think the market is growing anywhere between, well, in the traditional business, we're in a couple of % per year, but more importantly, in the services part of the business, probably at least 10% per year. So we're playing in a good growth part of the IT industry. And obviously, we're executing that growth strategy, both with the the strategy in terms of broadening our portfolio and how we execute our strategy, but also, as we spoke about, the acquisitions that are complementing us from both the growth but also the portfolio. So that, I think, is a summary of Proact. Thank you very much.
Excellent. Thank you very much, Jonas. I have a couple of questions to follow up with.
Shoot.
First one, you covered the global component shortages and the freight rates. How has it affected you in the last year? And have you seen unmet demand, so that you have demand from customers but you can't really deliver? Or how does it really affect you?
Yeah, I think we've been relatively spared from it. I think there's been other parts of the IT stream that's been more impacted, of course. We've all read about it in the news, and car industry being one example only in terms of having had challenges from a semiconductor. But yes, we are seeing certain vendors, certain products being impacted, and we haven't seen it yet improve.
Okay.
If anything, it's probably more challenging now as we get towards the end of the year. So it remains a bit of a challenge. We've been relatively spared, but it is becoming a worry for our customers. A lot of our customers, of course, running their projects, they want to deliver on some of their IT investments, and the fact that uncertainty around deliveries are out there in the marketplace creates uncertainty and worry with our customers. So it's still there, and unfortunately it has not been better towards the end of this year, but if anything, a little bit worse.
Okay, and difficult to say when it's going to resolve, I guess. What do you think?
I mean,
First half of 22 will be affected, obviously.
I think so. I mean, we don't have any insights more than anybody else, but if you see what the big companies in terms of vendors and semiconductor producers and the big automotive manufacturer are predicting, it'll hopefully ease off during the first half of the year and be better by mid next year.
I see. My second question was on the market growth, and you touched upon that. Low single digit on the traditional IT services and hardware, and then more than 10% on the cloud-related ones.
Yep.
We haven't really seen that in the last couple of years for Proact. When should we start to see that again, and what is the main driver on delivering on that?
Yeah. No, so there's growth in the marketplace in general, and particularly if we look forward, I think you're absolutely right. There's been a couple of years of turbulence, if I may say so, the last two, because of the pandemic, which has impacted IT investments. And I get every now and then the question whether we've been impacted in a net positive or net negative way from the pandemic. And I'd say probably net negative, but not terribly bad. There are definitely industries that have had a tougher time. A lot of our customers had to shift their focus on enabling remote workforce, a lot of investment in laptops, remote access, just helping their end users be productive when working from home, and less maybe a little bit on IT investments. So that's been one shift, if you will, during the pandemic. And the other piece is that as we push a lot of our growth and a lot of our strategy on delivering IT as a service with 3 to 5 year commitments from our customers, they've been definitely more reluctant to engage in long-term contracts during the pandemic.
Okay.
So our view is that we've seen it already, and hopefully if the pandemic now goes away, we think the growth opportunities are there. The market is definitely there. It's just about getting access to customers and letting customers have time to make decisions on the more long-term thing and not the short-term reactions.
So a little bit late cycle affected, it sounds like. It will come a little bit later for you, for example.
Yeah, I think as soon as we can engage with customer on a normal basis and they can start investing in their long-term strategies and not short-term, adapting to the pandemic, we'll see growth.
Yeah. My next question was on the customer types. Public customers, private customers. Do you see any changes or differences between those in how they have reacted in the pandemic, but also on the cloud and system sales in general?
Yeah, I think if you start at the end of your question, I think public customers are a little bit more careful. And I don't think they're careful because they don't believe in the technology, but back to where our core is and our strength is about managing data. And obviously public sector has a little bit stricter requirements and regulatory issues to take care of when it comes to storing data, and therefore a little bit more concerned with not storing it on premise in their own control. So we've definitely seen a little bit of hesitation to move to the cloud and finding ways to do that in a way that's regulatory okay. On the more commercial side and the private sectors, we, in general, I think see smaller companies being a little bit quicker because their IT environment may be slightly less complex, whereas big customers are either having complex environment or may actually find that running their own IT infrastructure still better from a performance and price perspective. And this is one of the reasons why we don't see the world going all the way over to the public cloud, but we will live in a mixed world for as long as we can see.
Yeah. How important are the most recent acquisitions for you to drive organic growth ahead? Will they contribute, or will they enable you to cross-sell any products or services? So how should we think about them strategically?
They are both, of course, helping us grow organically. I mean, we're buying companies that have a healthy business, that they are profitable, they have a sustainable, strong, established business. So we're pretty picky on our acquisitions. We want them to be well-functioning companies on their own right. But yes, we're getting a couple of benefits of them. One is cross-sell, upsell. So typically they have a slightly different portfolio than we have, or sometimes very different portfolio than we have. And together we can then bring a broader set of products and services to our customers. I think Conoa here in Stockholm is a perfect example. They are really good in helping customers deploy then what we call cloud-native application development platforms. We have the skills to make that operational and run it as a service. So together we can also not only do cross-sell, but actually develop new products and services together. So both organic growth from their core business, but definitely synergies in terms of having a better offering when we go together to our customers.
And how important is size for you? You are pretty big in the Nordics. You have a decent size in UK and Germany.
Yep.
Do you feel like you have reached a sufficient size to reach your margin target, or do you need to be a bigger company to reach that?
I think scale definitely helps, and we will continue to grow because we think it's important and will help us drive scale, and it will be one of the drivers, if you will, to go from our current roughly 6% EBITDA to 8%. And the other piece is just being even better in actually doing the service delivery. So professionalizing the way we deliver services, which will both, maybe most importantly, deliver a better customer experience, but also help us do it more automated and using tooling in a better way to get efficiency. So I think size is important from both of those perspectives.
And when you look at acquisitions ahead, are you looking for service-related companies to drive your system service mix towards the 50-50? Is that very important for you when you look at it?
It is, both because it's a quick way for us to bring skills in. It is a bit of a chase for really good and clever people out there, and acquisition is, of course, a quick way to get a lot of skills in, and is pushing us much quicker into the strategic direction of improving our services mix. So acquisitions you will see going forward will have probably a higher degree, or should have a higher degree of services revenue than we do ourselves on average.
And then my final question is on cloud solutions here. Which is the perfect client? You mentioned Fortnox case example here, but which is the perfect client or end sector that would like to have a hybrid cloud? Parts of the data in the public cloud and parts in the private, where you really can add value. Which sectors has the highest demand for that?
No, I don't think there is a particular sector, but we do see that customers with, let's say, either complex IT infra. So Fortnox, I think, is a great example. It's not a huge company, but obviously they are software as a service company, so their IT is mission critical, and so that's a very good example. And here, like we spoke when I presented that case, they buy everything we have, right? They are running some of the IT in their own premises because they want to be in control of their platforms. They let us run some of the services like networking and backup because we're experts in it, so we can do it as better than anybody. And they're using the public cloud for certain things because it gives them some agility or innovation and productivity for that matter. So I think those are very representative. And frankly, I think a lot of our customers will go in that direction.
And to follow up that case example then, is the profitability for you, I guess it's higher than your normal group levels for such a contract where you do everything? And do you have a scalable delivery so that you don't need to move 3, 4, 5 people to Växjö and their head office actually? Can you do it remotely?
We have a pretty scalable delivery, and we're running our delivery out of 4 what we call delivery hubs across Europe, and they're serving all our 13 markets. And that is one way for us to kind of find that perfect balance between scale and delivery, but also being close to the customer at the same time, because it's super important for us that we're really close, and we should feel the same heat our customers do when things aren't working, and obviously we should be able to celebrate when it is working with the customer. So We're running delivery out of 4 hubs. They are managed jointly, so we're standardizing the way we do things. We're doing continuous improvements and development in the same way across the hubs. So we get scale without being too far away from our customers.
Yeah. I think that's a good end note. That was the 25 minutes with Jonas and Proact. And thank you everyone for listening in, and thank you Jonas for joining the seminar.
Yeah, okay, thanks.
And
for thanks for listening.
And we have the next presentation in 5 minutes.
Thanks.
Thank you very much. Bye.
Det kan bli kjempebra. Ja. Hvis man på en måte får med seg den veksten inn fra Q4. Veldig spennende. Hi everyone, and welcome to this presentation with Play Magnus. My name is Eirik Tune Øretsland. I'm an analyst with ABG, and with me today I have the CEO Andreas Thome. He will give a 20 minutes presentation, which will be followed by a Q&A afterwards. So with that, I give the word over to you, Andreas.
Okay, good afternoon everyone. So my name is Andreas Thome. I'm the CEO of Play Magnus Group, and I'm here actually from Dubai, where Magnus is currently playing the World Championship match against his opponent Nepomniachtchi from Russia. So we have now come quite some days into the World Championship match, and really good to see that Magnus has taken a solid lead. So he won the last. He's now up 5-3. So that's quite encouraging. And we from Play Magnus Group, we have a lot of activities here during the match and these weeks here in the Expo, and I will come back to some of that later. But as some of you might be new to our company, we will give a bit of like a background presentation, and I will come into some of the more recent developments later. So let's go to slide number 1. Yeah. So Play Magnus Group was founded by Magnus Carlsen back in 2013. It's really the last, let's say, 2 years that we have started to, in a meaningful way, develop the company. And I will come back to like some of those. We have done a lot of acquisitions, and I will come back to some of those later. But this company is really about driving innovation in chess and driving innovation into this millennia-old sport. It's a lot about digitization, digital platforms, and in our mission we have outlined that we would like more people to play, but also to watch chess. So we know that chess is very, very exciting to watch when it's presented in the right way. Chess is a game that's actually quite easy to play, but it's more difficult to improve. So, so one of our other missions has been to encourage more people to learn and study chess. And we own the #1 chess learning platform, Chessable. And another very important part is to stimulate the ecosystem and actually to enable more people to earn a living from chess. And when we develop products and when we develop services, we always have this in mind, that like we wanna stimulate the ecosystem, because we know that that's what is needed to like really drive something forward. And here we have taken a leading role. So we can go to the next slide. So when we look at this chess opportunity, it's very sizable, and I mean it's one of the biggest games in the world. And chess is played by more than 650 million people globally. And what's really interesting is that it's moving rapidly online. Chess is actually a game that's perfectly suited for the online play. And another important thing with chess is that it's global. So chess is played all over the world. It's not a game or a sport that's only popular in certain parts of the world. And it's popular all over the world, but it's extremely popular in some of those big geographies, like in India, in Russia, in America, in the Spanish-speaking world. It's really big and growing. It's also growing actually very fast in China. And another important part is that chess has this really positive impact in health, in education, and in equality. And we know that as the population of the world are growing older, like the mental health is something very important, and we see that chess is playing a very important role there. And another area is that chess has a very high cultural relevance and awareness. And as we saw in 2018, in 2020 with the Queen's Gambit, it was the most watched Netflix show of the year. And another thing which is really important for us is that chess is in the early days of development. So there are a couple of companies out there now, primarily us and chess.com, that are the commercial companies in this market, but it's really in the early days of development. It's really in the early days of what we could call commercialization. So that's of course a great place to be. And then we have analyzed like all different kind of parts of chess which we could go into. But what we see exciting is that chess creates opportunities within esports and within e-learning. And these are the two areas that like we have developed products around. You know, esports, we have developed products around our Champions Chess Tour that many of you have heard about. Around Chess24's Play Zone, we are developing, you know, esports assets. And around e-learning, this is, you know, with Chessable and, you know, with the Silver Knights acquisition that we have done for learning. So, you know, so these are really the two areas that we are, you know, really growing into. So we can go to the next slide. Yeah, so let's look a bit at like what the company has been doing, our financials. So, you know, the KPIs that like we have been measuring has been, you know, booked revenue. And if we look at our latest quarter, which was Q3, you know, we booked $6 million, which is up 210% year over year. And if we look at year to date, 2021, we have booked 17.3 million, you know, up 214% year over year. So, you know, it's a really, really strong development there. And if you look also into our organic growth, most of this growth is organic. Then what is good to see is that the revenue is following, you know, so like the revenue development, 5.5 million, up 176% year over year, and year to date, 15.2, up 207% year over year. And the reason that, you know, the revenue is a bit smaller than the bookings is some of our partnerships for the Champions Chess Tour that is booked in one quarter and then recognized over a bit of a longer period. So, you know, another important KPI we have is the number of monthly paying users. So we have come to 60,000, is up 69% year over year. And this is either people subscribing to our digital services or buying digital chess courses on our platforms. And again, you know, as we talked a lot about after Q3, this is definitely one of those KPIs that are most important for us to continue developing. And with some of our new product releases, we are very confident that, you know, we should grow the monthly paying users significantly into next year. And then we have the RPPU, basically how much are we making in revenue per paying user, and this is 18.2 and is growing also fast year over year. And the reason it's growing is that our product mix is really improving into those more, you know, high ARPU countries, high ARPU customers. So that's why the RPPU is also growing for our company. And we have a solid cash position of around 22 million as of November 15th. So, you know, we raised quite a lot of money in 2020, and we are, you know, really have been investing substantially, but we have a strong cash position in our company as well. So you can go to the next slide. Yeah, as I said, you know, we have really been growing, and it's quite remarkable actually for us that is working inside the company to look back at these slides. And you know, it is only 2 years ago that like we had 3.6 million in revenue. You know, in booked revenue last year we came to 9.3, and you know, when by the end of last year we looked at like 14 to 16 for this year, and you know, we have just continued to outperform that, you know, quarter after quarter, and now our guidance for this year is 23 to 25 million. And you know, 23 to 25 million might not be big compared to other companies, but it's quite big when you come from 3.6 only 2 years ago. You know, so really, really solid growth here, and you know, we also see moving forward that like the path is really looking promising. And we said that when we went IPO, we set out the 60 million target for 2025, but you know, we are definitely much ahead of that plan, and we should be able to reach that 60 million goal before 2025, given the speed and the pace that we have in the business now. And in terms of growth initiatives, you know, it's keeping on investing into the product development. We have hired a lot of engineers, and now we are starting to see those benefits coming. Is to continue to invest into the Champions Chess Tour, which is really, really important. All the best players in the world are playing in our tour. and then keep on looking for smart M&As, interesting opportunities that can either help the company grow faster or like be more profitable. So we can probably move on from there. Next slide. Yeah, as I said, we have been through a very busy period in these last 2 years. We have done 8 M&As. The 2 most important M&As, Chess24 and Chessable, those are really like the backbone of the company together with the Magnus brand. But also last year, was a super good year for our company. We were able to to go on Euronext Growth. We were able to raise the capital, and with that capital that we raised, we were able to acquire several new companies, specifically in the chess content space. So we acquired content which improves the margins for the company. But like we have also been able to do other things which we couldn't have done, like developing the Champions Chess Tour, but also like signing like a long-term partnership with FIDE, acquiring the broadcast rights for the World Championship matches. So right now, when this World Championship match, Chess24, our brand, is broadcasting this match to the entire world. So so like with that capital, I really think we use that to put ourselves onto a great growth plan moving forward. So we can go to the next one. Don't know what that means. Now I don't see a slide, I just see something. Just see a white slide here. Be able to go to the next slide. Yeah, okay. I don't know if I missed a slide or not. I don't think so. So now let's look a little bit at like some of our recent developments. So like, what is the most exciting things which we have done lately? So one thing is that we just ended the 2021 season of the Champions Chess Tour, which is our tour. It was really a massive success. 44 of the world's best players was playing in our tour. We had more than 150 million live broadcast views, 29 million hours watched. We had a massive media and social media around it. And, it was so huge also to see all of these great corporate partners wanting to join our tour. And, we signed some great contracts with companies like Meltwater, MasterCard, Airthings, Skilling, Gold Money, Opera, FTX, Julius Baer, and Aker BioMarine. So it was like really a dream come true for us. And like already in like the first year of operation, we are almost like break even on this initiative, and looks so promising for the coming years. And I think most of the top players, they found what we did so innovative and so meaningful. So like this is something huge, not only for us as a company, but like for the entire chess world. So we can talk a bit more about that on the next slide, I think. Still waiting for the slide to come here. Det går bra. Okay. Are we live? Are we live again now? Okay. So yeah, about the like success of the tour, and like really great viewership numbers, players were playing, and the partnerships were there as well, with all these amazing partners that like joined. And what has been super important for us as a company is this like innovation in the professional chess. Like when you're coming with something new, you have to do it different, you have to do it better, and you have to take advantage of technology and new concepts. And I think that's really what the tour did. Like we brought this like fantastic broadcast, but also like this esports feel. Our finals, the players played in like this esports arena, and we really promoted like chess is also like a cool game that can be showed really excitingly. And that was successful. I really feel that was very successful. And also we have been always innovative in terms of like new technologies, and I think what we did, for example, with our NFT portfolio for the Champions Chess Tour, that was another example of that, where we created like the first NFT trophy in chess. That was given to the winner of the tour. That was actually Magnus, but it was also auctioned out to our fans around the world, and it was a person from a fan from Singapore that bought that trophy. He paid, I think, somewhere like 6.5 Ethereum. So today that's like costing, I think, $4,400 or something for an Ethereum. So so like it's still starting to become meaningful, and like this just shows that when you control like a tournament concept end to end, you have also the opportunity to do all of these innovations. And also very important is our Challengers Tour, which is the tour under the Champions Chess Tour, where we have had young boys and girls competing, equal amount of boys and girls. They played on teams, and really cool to see also that like we were shortlisted for this gender equality ESG awards for the tour. So so like we just keep on pushing boundaries, keep on like improving, and it's quite rewarding to see the results we've had so far. So we can go to the next slide. Yeah, and then this was a huge one. Like we signed a real milestone contract with MasterCard. We announced it, I think it was in October, and the MasterCard is joining the tour. What a quality stamp! That's like one of the absolute top brands sponsoring any athletes or any sports organization. Magnus became their ambassador. They're partnering with the Champions Chess Tour. That just makes things a lot easier when you're going out there, to acquire other partnerships. It's a great company to work with, and we believe this is like the beginning of a long-term partnership, which we can do with them, and really exciting to see so far. Big stamp of approval for the tour as this leading chess circuit. Yeah, you can go to the next slide there. But our company is much more than like the Champions Chess Tour. It's much more than esports. It's also a chess learning company, and that's why synergies are very important. So like, how does this different two businesses we have, the esports business and e-learning business, how are they coming together? Yeah, how are they synergistic? And I think a couple really good examples is that like the tour players and the tour ambassadors are creating courses on our learning platforms. So like we know that a learning platform is only as good as the content and courses that are on it. And so many of the players have been coming on. I think 50%, like 5 of the top 10 players have created courses, and so many others have done it. And this is like so cool for our fans to be able to like learn from the best. But it's also a great opportunity both for players and for ambassadors to make more money, because some of these Chessable courses and the learning courses we have, they monetize really well. And this is done under a rev share. So we want to give the people that are creating courses the opportunity to also, benefit from it. And, a huge synergy for us is how these two things are working together. Yeah, we can go to the next slide. Yeah, and then, Chessable, which is the cornerstone of our e-learning product, of our e-learning business. That one has really grown with regards to content. So like the platform now has more than 600 courses. But in addition to that, we have a lot of courses on our other platforms. Chess24 has more than 400, iChess has more than 500, and some of the acquisitions we did, like New In Chess and Everyman, they also bring hundreds of courses there. And organically, Chessable has grown, tremendously year over year. It's a lot of these paid titles, but also a lot of free titles. And now in this quarter, we had so many great releases: Anish Giri, Magnus' Challenge, and Nepo. Our popular commentators, Judith Polgar and Kramnik, they all published new courses. And we keep on digitizing content all the time. So we take great original content, which is there from like New In Chess and Everyman, and we digitize that content, bringing it back to life, making it into like a recurring revenue stream. Yeah. Okay, we can go to the next slide. And then, what we have all been waiting for, probably like the biggest opportunity in our company moving forward is the new Chess24 Play Zone. This is super important for us to compete better with chess.com. Is really to have a place where, like, when people come online to experience chess, most of them would like to come online and play chess. And we haven't been so strong there up until now, but now the Chess24 mobile app is out, the new Play Zone is being launched, and into 2022, 2023, this is definitely an area which I'm sure will grow really solidly for our platform, for our company. And when we first have people in there to play, it just makes it a lot easier to recommend people learning content and do other things. So huge milestone for the company. And now when we have launched the first mobile apps for Chess24, they came out just like a week back or so. So it looks really good. We can go to the next one. Yeah, and then another important thing for us for Chess24, it has always been the broadcast. That has been the reason that people have come to Chess24 in the past. And we can see now from the World Championship match that Chess24 has been a market leader in terms of broadcast. And the English stream of Chess24 with the Oslo studio combined with the expert stream of Anish Giri and Judith Polgar, that has been the most popular. And then of course this is a great platform for us to launch new products like the Play Zone. When Chess24 is popular, there is traffic on the site. It just makes it a lot easier and better to launch new products. So really happy with that development now during the World Championship match. You can go to the next slide there. Yeah, and then I take a couple of financial slides here in the end. So we looked at those those bookings. The bookings, they have been very, very strong year over year. Also revenue has followed the same, but it has been we had a really good growth between Q1 and Q2. Then it was a bit flat into Q3, and as we said in our last presentation, we expect that Q4 again should be growth in terms of bookings. Q4 is the seasonally strongest quarter for companies in our industry. The same should go for the next one, which is the monthly paying user. That has also been a bit flat in the last quarters, but they also come off really solid growth back end of last year and Q1. So, again, they're both because of the seasonality, but also new product launches, should be strong also for these KPIs. Yeah, we can go to the next slide. Yeah, and this one is more about, what has been driving our business. Our two by far biggest segments are the dark blue and orange, which is the dark blue being the courses, typically digital courses sold on Chessable, and the orange is the partnerships for the Champion Chess Tour. Both of these two areas have been growing very fast. The area that we want to work much more on into next year is subscriptions, which has been a bit more flat, but they're now with the new products for Chess24, we feel quite good about this. Okay, I think we have the last slide here now. If we go to the next one, yeah, I think we can actually skip this slide because I covered it. Most of our growth is organic, and I think this one is a very important slide. Scaling the business into 2022, getting closer to that break-even point, starting to narrow the burn rate. So a couple of things there that we have outlined, right? So it's the higher revenue from our core businesses that we expect to see into next year, primarily Chessable and Champions Chess Tour, new products, new product launches that we have had recently, Chess24, very important, the Chessable Classroom, expanding Chessable also into the classrooms. And then, we have some acquisitions that we are also starting to, take out synergies on Aimchess and Silver Knight. So those should definitely lead to higher revenue. And then it's this efficiency and effectiveness of our operational model. We have acquired a lot of companies. We are definitely starting for this company to collaborate more, taking out some synergies, improve on the processes and system side, and also simplify the corporate structure is now the area that we are working very, very intensely on. So I guess that we can just go to the last slide, which is more like placeholder, and as we have very little time, I think actually I just play it over and we can take some questions in the end.
Yeah, I think maybe we have time for one question. We can take a question regarding the World Championship in chess, which is ongoing right now as we speak. Can you explain how this typically affects Play Magnus and what you're doing to position yourself towards this activity?
Yeah, well, I mean, we know that the World Championship match is by far the time of the year that most people are tuning into chess, watching it, but then also being more eager to play and learn. That's for sure what we have seen the previous years, and we are seeing it even more right now. There was a release by Esport Charts that came out a couple of days ago, which stated that the numbers this year is much higher than it was in 2018. They also said that Chess24's English stream is the biggest channel, which was great. So we have seen very high numbers, and those numbers they also translate then into us setting more premium subscriptions for Chess24. They also lead to us to sell more courses on Chessable, and also this time as we have the new Chess24 Play Zone and the new apps. This is of course also a great opportunity for us to market these products, and I think it has gone really well. Fantastic numbers here a couple of days ago when it was an exciting long game that Magnus won in the end. And of course, from a business point of view, we hope that this match will last as long as possible and become very exciting, because we know that that's when the audience is there. At the same time, we are obviously rooting for Magnus. And so it's like a plus and minus here, but it's very, 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 very.
Yeah, I think we're out of time, unfortunately, but I think you covered it very well, Andreas. So thank you, everyone who listened in, and thank you for taking the time to talk to us today, Andreas.
Of course, thank you so much. Bye bye.
Thank you. Bye.
Hello and welcome back to ABG Investor Day. My name is Rebecca Järdrup and I am an analyst here at ABG covering the IT and tech sector. With us today we have Johan Nordqvist, the CEO, and Jenny Karlsson, the CMO of Briox. They will give us an overview of the company and Johan, please go ahead.
Many thanks, Rebecca. Let me start by taking the opportunity to thank ABG for inviting us to this event. I presented last year as well, and I must say it's a very good forum to bring progressive companies and investors together. So next slide, please. As said, I'm presenting here today together with our Chief Marketing Officer, Jenny Karlsson. Jenny will present herself more properly soon, and she will talk more about Briox growth strategy. And I joined Briox as a CEO about a year and a half ago in May 2020. And this timing, as you know, coincided with the outbreak of the corona pandemic. So it's been a very interesting year and a half for sure. But my belief in Briox was very strong when I joined the company. I would say it's even stronger now. And I really do believe that Briox is uniquely positioned for sustainable accelerated growth. And I hope this will shine through in this presentation. So next slide, please. Our plan today is to give you a quick introduction to Briox as a company, including a summary of the results to date in 2021. After that, Jenny will take you through the key pillars of our growth strategy with focus on the exciting opportunities we see in the micro business segment specifically. I will then go into a bit more detail about our near-term priorities and what you can expect from Briox in the coming half year or so. Finally, we'll open up for some questions. So next slide, please. So let me start by giving you a quick introduction to Briox, if we continue. I guess that most of the people listening today know Briox pretty well, but for those of you who don't, I can tell you that we are a software as a service company dedicated to helping micro business entrepreneurs simplifying and managing their business administration. And we do this through a fully cloud-based, user-friendly platform where the micro business owner can work together with his or her accounting agency in real time. And our products and services are sold in Finland and in the Baltics, where we have local sales and support staff. And product development and marketing, on the other hand, is managed from Växjö in Sweden, where we have our head office. And what you're seeing in this picture are some of our amazing people. Next slide, please. So Briox is backed up by a very competent board, which is very important and in this important time of transformation we're going through. And they are quite involved in this process. Our chairman, Johan Rutgersson, works with several fast-growing SaaS companies, and he's also served as the CEO of Briox previously. We have also backing from Mikael Lindblom, who is one of the world leaders, founder of one of the world leaders in invoice automation, Medius. He's also the strategic advisor to Einride, as you may have heard of, that is currently revolutionizing the transportation industry. We have also Daniel de Souza, who has very extensive experience from the accounting software industry. And he's also served as the CEO of Visma, SBCS. And through Helena Westin, we have access to one of the most competent people, I would say, in Sweden within brand and communication. And she also serves on the board of the Swedish Television. And finally, the board is also represented by Martin Jönsson, who is an active investor in the tech space. If we move on, you will hear us speak quite a bit today about our increased focus on the micro business segment and about accommodating the needs of the micro business entrepreneur. And this is very important, but I want to make it very clear that Briox has and will continue to have a clear partner strategy. As of today, we have partnerships with more than 200 accounting agencies in Finland and the Baltics. And these agencies, they use Briox in their daily work with their clients, and they pay a monthly fee to us for using our services. Our software as a service model also includes a monthly fee for every client end user the agency then invites to Briox. And as one agency consultant typically handles between or up to 20, 30 clients each, the revenue upside for Briox is very big when the agency starts inviting the majority of their clients into our system. And this process of working through partners can be slower than working through direct sales. But on the other hand, it's a very, very powerful model when it starts scaling up, and churn is typically very low, as is the case for us. But to accelerate our business growth even further, we're now putting more focus on the needs of the end user, so the accounting agency's clients, thereby ensuring that we have a product offering that is just as relevant to the professional agency user as the end user at the end of this line. Next slide, please. Well, for those of you who have been following Briox, you know that a lot has happened for us in 2021. First of all, we have set a very clear strategy for accelerating our growth, including a revised positioning, which Jenny will speak about in just a second. I've also recruited a very competent new management team, which is now fully in place as of this quarter. Parallel with this, we have launched a new brand platform and also completely new product packaging, which has so far been very well received. So a very eventful year to date. Next slide, please. Now, has this plan for accelerated growth started to show some results? I would say yes. With the launch of our new product packages and our clarified positioning, we have managed to grow our customer base quite extensively. And in Q3, the number of user licenses was up about 65% versus the same quarter last year. Next slide, please. This trend is also visible in annual recurring revenue, which I would say is our most important key metric. The value of our recurring revenue is growing steadily quarter by quarter and was close to 40% up versus a year ago in Q3. So I would say that this is all good, but Briox has much higher ambitions than this. And I will now hand over to Jenny, who will tell you a little bit more about how we are further repositioning the company for accelerated growth. So if we move on, I will hand over to Jenny.
So thank you, Johan. So my name is Jenny Carlson, and I'm the CMO at Briox. Back to that slide. Thank you. I will talk about our repositioning for growth and our growth strategy. In our growth strategy, we have 4 key pillars that we grow our framework on. The foundation of change in our strategy is that from now on, we will be having a microbusiness segment as our target audience. And I will get back on exploring a little bit more on that shift and opportunity and what it means for us as a company. Secondly, we will be focusing on having an international core offer. In practice, this means that we will have one prominent product with additional solutions and services. This will allow us to be fast-paced and scalable. The third pillar is a highly efficient digital sales model. It will align all our functions within our organization to focus on sales, to make smart decisions and use data and analytics and the latest technology. And the final key pillar is win strategic partnerships. This means that we will continuously build and work on our partner strategy for us to have an attractive and extended offer towards our partners. And Johan will talk a little bit more on that later in this presentation. Next slide, please. Back to the previous slide. Thank you. So as previously described, we will increase our business. We will continue to work towards accounting agencies, but also described in our go-to-market strategy that Briox grow and our business grow once customers start using Briox. And as many of you know, identifying the right target customer is a key part of strategic planning. The choices determine what you sell, how you brand it, and what prices you charge, and to whom you're competing with. So as of our strategy evolves, we have discovered that the customer focus of our business have shifted a little bit. So our target audience moving forward will be the microbusiness segment, and we put great emphasis in improving our offers towards this audience. Next slide, please. So who is the microbusiness owner and what is this target audience? It's a large segment. It's actually the largest in Europe. So about 93% of all businesses in Europe are microbusinesses. It's a really fast-growing segment, and they have accelerated even more during the pandemic. The official definition of a microbusiness are companies with less than 10 employees, but we think that our sweet spot for Briox will be businesses with less than 5 employees. Next slide, please. Another reason for us shifting our strategic focus towards the microbusiness segment is from a positioning standpoint. We have discovered that in our markets, there is an unmet customer need and that they're missing the one-stop shop that cater their considerably simple needs. We already have a strong product on the market with focus on accounting, which is also relatively difficult to copy. Having this as our foundation will allow us to focus on developing and choosing additional solutions to secure an even more attractive offer for this segment moving forward. Next slide, please. So I will leave back over to Johan, who will elaborate a little bit more on the key elements that we have moving forward in 2022. Thank you.
Thank you very much, Jenny. Okay, if we move ahead. Thank you. So a very important element in our plan to meet the needs of the micro-business entrepreneur is the launch of our new app. The majority of companies with, I would say, 1 to 3 or up to 5 employees are active in the service industry. And in these roles, they typically don't sit in front of a computer. So to be relevant to this and to this group, we need to be where the customer is, which is why we're now focusing heavily on content, or we will be focusing heavily on content for the mobile device. Our new app will be launched at the end of this year, and we will continue developing relevant mobile content on a going basis then quarter by quarter. So we're quite excited about this, and the initial feedback we received from the markets about what we're process of bringing has been very positive. So next slide, please. Building on what Jenny said, and to support our ambitions to grow, we're also working on further developing our sales model. In this process, we put a lot of focus on marketing automation and on digital leads generation. This work is then going in parallel with all the product development work. And then finally, if you move ahead, we're also quite excited that to become even more relevant to current and potential agency partners, we will soon now launch the updated Briox Partner Program. This, I would say, is improved packaging of our service offer to small and large accounting agencies with quite powerful incentives to promote joint business growth. So again, continued focus on our partner strategy and working on building our business in collaboration with our existing and coming accounting agency partners. Next slide. And to summarize, it's been a very, very exciting 2021. And I would say this is the first year of transformation for accelerated growth in Briox. We are seeing good traction, as I've mentioned, and the Q3 numbers in Q3, as I mentioned, our number of user licenses grew by 65%, and our annual recurring revenue was up by close to 40%. And as been mentioned, to become even more relevant to the end user. We have clarified our positioning with the objective to accommodate the needs of our defined target audience, the micro business segment. So pretty much all our key initiatives in 2022 are designed to support this strategy. So I feel quite confident that we have a very clear plan how we intend to scale our business, and this plan is so far quite well on track. So with this, we wanted to round off, if you move ahead, and then open up for any questions you may have.
Thank you very much, Johan and Jenny, for the presentation. I have a few questions. Let's start with, in 2019, you entered the Baltics region. How has your product been received in these areas?
Right. We started, we've been present now in the Baltics for a little bit more than a year and a half. We started in Estonia, and then we followed that with entering Latvia and Lithuania. This has also, then as you know, coincided with the outbreak of the pandemic, so it's been an interesting time. I would say the following. I mean, first of all, our entry, I think, is very welcomed. We feel very much that the feedback we get is that we come with something new. To me, now having been quite active, being out to all our markets, seeing customers, it's quite clear that if we compare to Sweden, I would say this is by far the country where this development of, digitalizing this industry and collaborative accounting has come the furthest, followed by Finland and then the Baltics. So I dare to say what's happening in Sweden and in Finland is also happening in Baltics, and in this regard we're very well positioned. So it's quite welcome. Then it takes some time to build brand name, and we have started now to sign up our first agencies in all these markets, and we're now also seeing the end user base starting to come in. But what we're seeing, and this is also relating to what you've heard today, it's very, very important then to enable these agencies to actively invite their customers. And this is why we see the launch of our new app will be a key enabler to accelerate our growth further in the Baltics. So I would say that so far so good. We're preparing for ramping up, and with a complementary sort of offer for the end user, we're now in 2022 ready to ramp this up. But entering new markets take time, but I feel very confident about these our entry into these markets and using that as a complement to our what we're doing in Finland. And also on a final note, we are also working with many accounting agencies that have operations both in Finland and the Baltics. And in that regard, we're seeing synergies to be had when slowly but surely ramping up in the Baltics.
All right. And what about the micro companies? Are they as many in the Baltics compared to Finland, for example?
Yeah, I would actually say that this is more of a global thing. I mean, I would say I don't have the exact numbers, but I think that both in Europe, in the Baltics and Finland, even in the US, I mean, close to 85-90% of all companies, in terms of number of companies, are small with less than 10 employees. And out of those, the great majority are, have a lot less employees. So I think that's not an issue, having enough companies to work with. What we have felt very important for us is to be very, very clear about who we serve, because only then I think you can have a offer that is sharp enough to be relevant in that group. And that's the sort of repositioning we're taking. It's not a total overturning where we're going, not at all, but it's an attempt to be even sharper in our offering. But to answer your direct question, I think the demographics is more or less the same in all of the markets where we operate.
Okay. And as you said, it takes time to enter new markets, but are you planning to expand to any new regions?
I would say right now, my main focus, and also for the whole company, is to prove success where we stand. So we have no immediate plans to go outside the markets where we operate now. I think this is a very important. Focus is important. Having said that, I think that in the longer run, with an even tighter core offer, that is probably possible. But I think, again, that we need to prove our model where we stand. And then with that accelerated growth, we can potentially expand elsewhere.
All right. And you touched upon it, but how do you experience the market momentum now compared to in the beginning of the pandemic? Is the demand bigger or the other way around?
I think it depends on how you look at it. I think the demand for having to do your bookkeeping or having to managing your company, I mean, it's there all the time, regardless of a pandemic. I think it's only, I mean, just to have a personal example, it's only, I think, I joined this role 1.5 years ago. It's only, I think, 3-4 months ago where I could actually start having physical meetings abroad myself. And also when you're in an expensive phase, and also as you enter a new market, of course, being able to meet physically helps a lot. So in that sense, it's somewhat easier now. But I would say the underlying sort of need for these products and services has been there all the time.
All right. Thank you very much, Johan and Jenny, for the presentation. And thanks, everyone, for watching.
Thank you.
Thank you.
Hi, and welcome to our next presentation on today's ABG Sundal Collier Investor Days. Our next company presenting is FluoGuide. Myself, my name is Jacob Lemke. I'm an equity research analyst here covering the healthcare space. And with that, I leave over the word to CEO Morten Albrechtsen.
Thank you for the introduction and welcome to the presentation of FluoGuide. So what we do at FluoGuide is that we maximize the surgical outcome by intelligent targeting. And if I may have the next 2 slides, please. First a disclaimer, and then really what we are doing is that in FluoGuide we started out focusing in on the oncology surgery. And every year there's about 15 million patients that has cancer. And about 80% of them will need surgery sometimes during the surgery. And the problem with that is that the surgeon really have hard time to see where the cancer stop and the normal tissue start. And what we do basically is that we light up the cancer so the surgeon can remove all cancer the first time. We had here in October, we had the result of our first trial with our first study product. And really it was demonstrated that FG1 was safe and well tolerated, and come more into that. We have a strong basis, IP protection. We are listed on First North in Stockholm, and we have a market of about 1 billion. And we have a cross-functional team taking all the disciplines around. And I'm going to show you some pictures from the surgery, and if I may have the next slide. What you can see here is really, in a nutshell, what we are doing. I mean, on the left side, you have an cancer, or it's brain with the cancer, and it's what the surgeon see when they put aside the doer that is covering the brain on the left side. And what you see in the middle with the green arrow is the cancer. And for a neurosurgeon, this is easy to see that this is cancer. The problem then starts when they have removed the cancer. And now they have to make the decision if they should remove some more tissue with the risk that they could potentially disable the patient. They could take some of the function for the speech or for the movements, or they should leave it behind with the risk that the cancer will regrow after surgery. And this is a problem the surgeon is faced with every day. And if it were you, I mean, if you want to have a product that could light up cancer, I'm sure you would. And if you have the next slide, please. Sorry, not the next. Yeah, next slide. Sorry. Then you can see how actually it works very, very well for this first patient. FD1 on the left side is demonstrated that when the neurosurgeon checked this cavity after she had removed the cancer, she could see that something was left in the bottom of the cavity. And she removed that part of the tissue as well that was lighting up. And it was, of course, checked with a pathologist, and that actually were cancer. And then on the right side of the back images, this is the image after she had removed it, and you can see that there's nothing left. And this is really what we are doing. And it's clear for everyone that this is really, if you would have a surgery in your brain or everywhere else, you really would like to have it all removed with this extra security for the neurosurgeon. And of course, also the neurosurgeon is quite pleased with having an extra tool helping them in taking the very hard decision they're faced with in the middle of the surgery. So this is what we're doing. The rest of the slide is how we are executing on it. So if I may have the next slide, please. This is an overview of our procedure. It's a very simple procedure, and yet with quite a profound impact. The product is injected into the vein of the patient prior to surgery. It will circulate in the body, and it will bind to cancer. Then after it's bound to the cancer, it will be removed from the background, and then it will be left just marking up the cancer during surgery. So the procedure is really simple, and then it can be used during surgery. One of the neat things with FluoGuide is that everyone really likes us. I mean, the patient, obviously, because we help them remove all the cancer the first time. Hospital could potentially save cost in that they should not have a re-surgery. The surgeon likes it because they get a more secure tool that will help them doing their work better. And the equipment manufacturers also likes us, which is quite important because we take their technical feature and convert them into benefit, and they have a quite strong interest in seeing us being successful. So if I may have the next slide, please. This is an overview of what we are targeting on the cancer. We're targeting an proteolytic protein. It's an enzyme that's called UPAR, sitting on the top of the cells on the forefront of the cancer. It's quite an interesting one because it's what the cancer uses when they want to invade into the normal tissue. It will use UPAR to break down cancer as a normal tissue, so the cancer can invade into the normal tissue. It's quite an extraordinary good target in a way that it's very specific for cancer. So it means that it will only be in practical terms expressed on the cancer. It's also extensively expressed, so it means that patients do not have to have screening. They can just be enrolled directly into the use of this tool. It's particularly expressed on the forefront of the cancer, meaning that's exactly where the neurosurgeon would like it, because that's where it's difficult to see where the cancer stops and the normal tissues start. It's also proportionally with aggressivity of the cancer. So the more aggressive the cancer is, the more it will spread and the more UPAR it will express, and the better it is to see for the neurosurgeon. So may I have the next slide? So we think that it's quite extraordinary target we have selected. The next then big thing really is, and that's an issue for us, of course, because we have a luxury problem in the sense that we can go into multiple different indications, and we have chosen two. We have chosen aggressive brain cancer as one, because that will give us quickly to the market. We have also selected the lung cancer because that's an quite large clinical potential in this indication. So that is the two indications we have chosen. So if I may have the next slide, please. So the next thing that is very neat with FluoGuide is that we have very short paths to the market, and the main reason for that is that we need quite small studies in number of patients, and the patient have to be included quite a short time into our trials. And really what is needed in the trials, and that goes from now the whole way up to approval, and that is the patient is enrolled into the trial. The neurosurgeon will do the surgery as you saw on the images before under white light. They will switch on the fluorescent light, and they will check if they have removed everything, and then if you remove something more, it will be sent to the pathologist for final evaluation. There will be, principally, we are now doing the 1/2 study, and then there will be a phase 3 study that is needed, confirmatory, and that's it. Then we'll have an approval or submission time in 24, and then approval 25. If I may have the next slide, please. So the study we have ongoing right now, where we have the result here in October, demonstrate that the product FG1 is safe, generally speaking, and that is quite effective in eliminating this aggressive brain cancer. It was a study, it was a classical drug trial where we increased the dose, and we have that in 8 cohorts. And we was not limited by toxicity. We could either be limited by toxicity or by that we do not get further improvement in the image. So we were not limited in toxicity, and we did not expect so, because we have chosen a fluorophore that is known to be very well tolerated. We also have had an extensive preclinical safety program carried out, and also demonstrated that the product is really safe and well tolerated. We were not limited by toxicity in these animal studies. We were limited by feasibility. So for us, it was not a surprise that it was safe, but still it's quite important because also it was a very clean profile, and it means that we can use it also in a more lighter types of cancer. The important thing for us were that we also saw that it was lighting up cancer. And that is really great because we see a quite strong contrast created between the cancer and the background. And that means it's so strong actually that it can be used across different equipment. So even a poor equipment actually will illuminate the cancer very nicely with our technology. We also see that it is the weight of the patient independent. It's also some of the cancers have a more generally speaking, it can light up more than others, but we see in all of the cancers so very good homogeneity across cancers. So really good and strong basis we can build on. We have then have to select the optimal time, and we have 2 times. We have the evening before and then the morning. That is carry on right now. And when we have to coming into Q1, we will start the formal second part of the study, which would be really exactly the same as we did here in the first one, but in 12 patients with the same dose. And this is designed to be similar to the phase 3 study we anticipate. And we use those data here to go to FDA and EMEA to ask for buy-in on a regulatory supportive trials for the phase 3. So if I have the next one, we will have the data for the second part of the study. We will have them in mid of next year. An important thing by having completed the first part of it is that the safety part now is completed, And that means we can go into every indication we would like to principally. We don't have to have this more rigid safety setup. And that means that it's much easier for us to carry on the long study, but we could also go into other indications. If I may have the next one, please. So this is then an overview of our pipeline. We have the high-grade glioma as a lead indication. We have the lung cancer as a second indication. We have then the mini-glioma and low-grade glioma. That's really supportive to aggressive brain cancer. So we're looking, from the data we had, there was a few patients that did not have glioblastoma, the high-grade glioma, and they had other brain cancer. And actually our technology also lightened up those cancer as we expected, but of course it was nice to see. So it's not only a product for high-grade glioma, it's actually a product for brain cancer. And that we want to demonstrate with this study to broaden out the brain cancer indications. Then we have a second product that is being initiated in development. It's basically the difference is that it's going for the lower part of the body, and it's also a UPAR targeted product. And then they have some other small features with it that make it distinct with lighting up, for instance, you can see cancer deeper into the tissue and so on. An important thing with the first FG1 is that we have this photothermal therapy, that is that we can heat up the product. And in about 1/3% of the cases for brain cancer, the neurosurgeon will leave cancer behind because they cannot remove it all, because then they will impair the brain or impair the patient because it take out critical functions. Having this photothermal therapy is a possibility that we, during the surgery, can sweep and clean the cavity, and that way actually completely treat the patient. So we have a quite nice, it's a focused pipeline, but still it's quite diverse. We have the quick path to the market with the glioblastoma, and we have then the lung cancer with the large potential. If I may have the next slide, please. Thank you. It's an overview of the competitive landscape, and right now there's two products that is approved for guiding surgery of the first generation products. They are unspecific and they are unprecise. Basically, they're converted to the fluorescent molecule inside the cancer, and they're forming a cloud around the cancer. One of them is for bladder cancer, and the other one is for brain cancer. And interestingly, they're based on white light, and that means that you cannot see the fluorescence very deeply into the tissue. But still, they are now approved, have been approved for 10 years, and really start to take on now commercially. It's quite nice because it proves that the concept is relevant, and there's quite a potential in this market. We have then a range of second generation products. They are all based on near-infrared light, and that means that you can see deeper into the tissue, that you can see the cancer really 1 to 2 centimeters down into the tissue, and that's very important. For instance, considering the brain, that you really can see the cancer where you couldn't see it with the current product. So it's a dramatic improvement compared to the first generation products. All of them are based on near-infrared light. Some of them are equipment dependent, and that means that you use special equipment to see it. From our point of view, we've really decided from the very beginning that we want to stay equipment undependent, and that means that we are able to be used for any equipment out there. So we do not have to have special tweaks with the equipment. It's really a plug and play. We can go out, we can use it tomorrow on any equipment that is out on the surgical places. And then, of course, our target is quite unique in the sense that we have a very cancer-specific product, and then it's cancer type unspecific. So we can go into this aggressive cancer, get to the market quickly, and we can broaden out to lung cancer. May I have the next one, please? So a third thing that is very neat with FluoGuide is that we have some very supportive trends in the market. In the surgical area, it's been increasingly digitalized and minimalized and automated over the years. More equipment is coming into the surgical scene. And we started out in brain for a couple of reasons. And one of them as well is that all neurosurgeons have a microscope. And that means that we don't have to go out and selling microscopes to the neurosurgeons. All of the microscopes out there can see our products, so we don't have to go out to sell upgrades. I mean, it's a straightforward way. And really, it's a very much easier penetration than, for instance, an type of surgery where you do not have so much equipment. But generally speaking, all the large medtech companies now are moving into the field where they have microscopes or endoscopes or robotic equipment that can be used to help the surgeon in the surgery. couple of them, 3 of them to be precise, have acquired a camera because they need all a camera for the equipment. So they acquired specific camera, all very neat for guiding surgery. And then really what they're lacking is an proof for just like the one we are providing now. And ideally, of course, they will have one that is cancer type unspecific, but cancer specific. So that will kind of be our expectation, the next wave coming up. If we may have the next slide, please. I can say we're talking with all the large companies in different ways, of course. This is then and just a summary of our shareholder basis. I mean, we have 4 institutional investors into the company right now. Arbejdernes Landsbank were from the very beginning. Link came in just right after our IPO. Then we have 2 others. One is a Swedish pension fund and then a German bank. We have coverage by ABG, SEB, and Redeye, and we have a really nice shareholder basis with about 9,000 shareholders. We have had a very good growth on development on the stock exchange, and there's no reason for this not to continue. So if I may have the next slide, please. We have had the thing that is moving us so fast because of our short clinical trials have also meant that we have had a very steep development. We had an IPO in 2019. We were a preclinical stage company. We now in this year have a proof of concept. We have demonstrated that product is safe. We can expand into the more prevalent indication and started up the second product. In 2023, just to make an outlook, we will be a late-stage clinical phase 3 program company. We have 2 to 3 phase 2-3 programs running in more prevalent indications. So it will be a dramatic change as well going 2 years forward from here. And the market is quite interesting. It's large, it's attractive. The platform we have, it works, and we have a short path to the market. If I may have the next slide, please. We also, because we have such short clinical trials, we have quite several very important milestones coming up the next 12 months. So in Q1, we will have the histology data formalized for the first part of the study. We will have the CTA for the lung cancer study. I mean, that's the application for starting the clinical trials. We will have in the mid of next year, we will have the end of the phase 2 part, and we will have the regulatory feedback in Q3 for plan 3 next year, 2 FDAs and 1 with EMEA. And then we have in Q4, we will have the result of the lung, and as well, we'll have a preclinical safety package for FD2. We have a couple of milestones we haven't put into precise when they will come, but we'll start the study in this to broaden out the potential in the brain cancer. We prepare the phase 3 next year. We're doing all the production already now, and then we will start up the photothermal therapy development. So really quite a nice and packed news flow we will come up with. And I think that's the last slide, and I'm very prepared to take questions or any discussions.
Okay, thank you, Morten. So if we start with on your phase 1 study, you have treated or administered your product to 27 patients, and you have demonstrated safety. But you also recorded the tumor fluorescence, and as we know, tumors fluoresced in all of the patients at the relevant dose. So to what extent is this sort of an indication of that you're going to perform good results in your upcoming efficacy trials?
Yes, thank you for that question. It's a good one. I mean, our efficacy endpoint is coming in steps. I mean, the steps we need for approval is what is referred to as positive predictive value. So that means when the cancer lights up for the surgeon and sent to the pathologist, and the pathologist confirm a cancer, then there will be a positive predictive value of our product to determine or diagnose cancer. And that is a regulatory endpoint. Then we come in steps. What we have now is that we have demonstrated the light. So what we can see is that the cancer lights up compared to the background. We have macroscopically seen that what lights up is cancer. I mean, this is visible for the neurosurgeon. And then the step we will have in Q1 is that we have from the patient on the relevant dose, we will look at the histology. And that is really the same endpoint as we use for regulatory purposes, that we take the histology examination and make that as a truth. and then compared it to the light. And that will come here in Q1 next year. So that's the next step. But the fact that we can see it macroscopically is really very, very strong indication of an effect.
And during these clinical trials, you have sort of let the neurosurgeons, play around with your product and experience it. And what sort of feedback have you gotten thus far, or
yes.
on the potential?
Yes. Thank you for saying that. I will not say we have let the neurosurgeon play around with our product as such. We are under quite strict regulation. It's a drug trial, so there's a lot of things he cannot do, and a lot of things you're not allowed to do that he would like to do. But the feedback we get, and it's mostly coming from when you have a patient that comes in with high-grade glioma, they would not always have high-grade glioma. They are suspected to have high-grade glioma, and about 10% of the patient are diagnosed under the surgery not to have high-grade glioma. And we had two of those patients in a study. One was this meningioma, that was another brain cancer, and then we have a metastasize coming from the lung. The one that has the meningioma patient, we were able to publish the data because this patient was formally excluded from our trials. And that way we was able to take more samples from it because she was doing that during the surgery, which we could also publish. So the feedback we got from this patient and the feedback in general is that she's really very enthusiastic about what she sees, in the sense that they really light up very nicely, and actually it can potentially guide her in checking the cavity as showed on the images, where after the surgery is done, she looked at the cavity and she can actually remove more cancer in case it lights up, of course checking it with the pathologist. So it's a very, it's like having driving a car in the night and she can switch on the light. So she's quite pleased with it.
And as you said, a few of the patients you treated did not have high-grade glioma, but other types of cancer tumors. And sort of more in general, maybe you could just highlight sort of from a scientific perspective why it sort of makes sense that your product will work in multiple cancer types compared to perhaps some of your competition.
Yes, I mean the target we have chosen, uPAR, it is the enzyme the cancer used to break down normal tissue. So when a cancer wants to spread into normal tissue, we use uPAR to tear it down or destroy it, you can say, so it can get into the normal tissue. And that's why it's a very basic function, and all cancer types need this feature to be able to spread. And basically uPAR is a tissue remodulation marker, and that is particularly strong for cancer. So the reason for why it's very likely to work in other cancers is because all cancers that spread, and that is basically the definition of cancers, and then will be more than 80% of all solid cancer, they express uPAR in the forefront where they spread. So for that reason, it's a very cancer-specific marker, but a cancer type-in-specific marker. And so we did expect that we can see it in other cancers. And that's uPAR, the research on uPAR has gone on for a long time. It's not only us that have worked on uPAR such as target. We're the only one using it to guide surgery, but it's used for other purposes as well back in time. So there's a lot of literature on where uPAR is expressed and how it can work for diagnostic purposes, and also drug treatment has tried to use uPAR. So uPAR is a quite well-described marker in literature. And the data we have now also support really what is known already.
Interesting. And I think we have time for a final question. So on your competitive landscape slide, you mentioned a few competitors, and I believe one of them, On Target Labs, just recently got their first product approved in ovarian cancer. So maybe you could just sort of highlight what this means for you, but also sort of for the fluorescent guided surgery field in general.
Yeah, no, thank you for mentioning that. Actually forgot to mention it when the slide. That's very important, in fact, because they are the first of the second generation products that have a product approved. They have it approved in ovarian cancer, as Jacob mentioned, and there's a lot of reason of why this is very important for the whole field. But some of them is that it validates our regulatory path. It will. They have had a patient, about 300 patients reported the safety, and about 150 patients reported the efficacy. So that gave us a kind of a benchmark of what we could expect. The achievement they got is that 1 out of 4 patients only have a benefit of it during surgery, and 1 out of 5 patients had normal tissue removed accidentally because it light up normal tissue. So it gave a kind of a benchmark what is needed to get approval. It's also important because we do not expect that FluoGuide will kind of be relevant for all indication, but a couple of companies in this field that could push and develop and mature the field is very important. It's still a young field, fluorescent guided surgery, and having a couple of players in the field would be very relevant to mature the equipment, to mature the surgeons. Photocure, having the very first product for bladder cancer, have started that for a long time ago, and now there's one more that will push the market, namely OnTarget. So we think it's a very positive thing for the field, and they're watching this very carefully and really support what we have had expectations of what it would be supporting and approval. So we think it's a very positive thing for the field and for us.
Okay, I think we're out of time. So with that, I would like to thank you for participating, Morten, and I would like to thank all the listeners.
Thank you for your time. Thank you for listening.
Hi everyone, and welcome to this presentation with Napatech. My name is Eirik Thune Øretsland, and with me today I have the CEO, Ray Smets. He will give us a 20 minutes presentation, which will be followed by Q&A afterwards. So with that, I give the word over to you, Ray.
Okay, well, good afternoon, everybody. I'm Ray Smets, CEO of Napatech. It's a real pleasure to be here today. Thank you for joining us. I've been CEO of Napatech for 3.5 years, and we've been on quite a journey. So I'd like to share with you a little bit of the history of our business. I'll keep the business overview rather basic so you understand the technology space that we're in. I'll cover some of the technology areas that we invest in, customers, give you an overview of the market, and just touch on how we've been doing over the last couple of quarters. So with that, next slide, please. Typical safe harbor statement. Next slide. So Napatech is a 20-year-old company based in Copenhagen, Denmark. We have a deep history in building solutions on something called an FPGA, a field programmable gate array, which is a super high performance microprocessor that runs software applications at a very, very low level. So we have a lot of good ability to develop solutions that manage packets that move across networks and servers. We have an excellent expertise. We like to talk about our barriers to entry as being time and resources. We do have patents and patents pendings, of course, but the reality is our real secret to our success is in our software, and the software is not easily developed. Software on an FPGA does take some time, and the area that we're investing in specifically takes a long time to become experts. We've been doing this for a long, long time, building software applications that run on these types of microprocessors, and we've developed a solution that is highly leverageable in today's marketplace in accelerating applications in networking and cybersecurity, and soon to be virtual networks that run on data centers and data centers on servers. I'll explain that in just a little bit in a little greater detail in just a few moments. But we have an unparalleled expertise. We're worldwide known in this particular space, and you'll see some of the players that we compete with and cooperate with in the marketplace are some of the largest players in the industry. We've been building a good, solid financial track record over the last couple of years, and we intend to keep it that way. Hopefully, you've had a chance to look at our history. We're looking at approaching a fairly large market that is growing rapidly in the data center domain, specifically in the area of network interface controllers, or NICs. And we are a software programmable version of one of those, which makes us a lot more interesting in this market space. So I hope you'll agree with that as we go through the detail. Next slide, please. So keeping it simple, we build smart NICs. As you see in the center of your screen here, these little hardware devices are about the size of one or two of your hands together. They're designed to fit within any standard server that ships globally into any data center that is deploying applications today. But the hardware is well designed, and it's made to be very, very high performance and super high quality. But the real secret to our success is the software that runs on this particular smart NIC. On that smart NIC is that FPGA, and on that FPGA is our software release. And our software basically is managed on this design that is shipped to our customers to actually operate, accelerate, and enhance the applications that are running in the data centers. We have a range of prices for these small devices that we ship, anywhere from about $1,500 a unit to about $11,000 per unit. The price depends on the performance level. It depends on the type of release that we have, the type of features that we're delivering. And these are purchased by many different companies around the world to perform very important functions within the data center. So we have a lot of room from a margin perspective, and the margin is derived basically from the value that the software provides that we sell. We do ship the product together. It's a hardware-software combination. As you see, we ship these little hardware devices with software running on them. But more and more, we are designing our solution to be a software-only product, which also operates on other hardware designed by other companies. And you'll see that as we talk about the future of our business just a bit. So we build smart NICs. Next slide, please. The companies that consume them, this is a good slide, gives you an idea of the companies that consume our product. Many different companies around the world buy our products, and we sell in two different ways to the marketplace. And this slide gives you a bit of a balance between the two. We have about 220, 230 customers globally. About 70% of our revenue is derived from companies within the United States. And we have two types of companies. We have two types of sales motions into the marketplace. On the left-hand side of the slide, you see our OEM business. These are companies that take our product, design it into their solution. They buy the product from us, they enhance their solution, and then they ship our product to their end user customers. These OEM customers represent about 70 to 75% of our revenue on a quarterly basis, and we consider this to be the most valuable revenue. It's extremely good revenue for Napatech because these relationships are very long and more predictable in general. So, for example, we have end user OEM customers like IBM in the cybersecurity domain in what is known as their QRadar product line. We work with Rheinmetall and their military cybersecurity solution set. We work with Mobileum, for example, in their service provider signaling network domain. We work with a number of different companies in terms of network management, network monitoring. We also have a few other customers that are not listed here that don't like to be listed on presentations of this sort. And more recently, we have several of them, Lenovo being one of which is worth noting. Lenovo is a top server company based in Asia, and they have selected Napatech to be the branded solution, a Lenovo branded solution to sell into the new and growing virtualization domain. So an area that we're investing in pretty heavily, and we look to turn that into revenue very soon. These relationships typically just start with a design win. It takes time to get designed into the product line, and then these relationships last anywhere from 3 to 5 and even longer number of years. And we typically see a recurring relationship with these kinds of customers. They buy every quarter, every other quarter, but typically we see an annual relationship with these kinds of customers. On the right-hand side of this slide gives you at least a contrasting perspective of the type of customers that we go to market to. And these are end user customers. These are customers that use our product within their data center to accelerate or enhance a particular application that they've either built themselves or they've acquired as an open source application. We benchmark very, very nicely running applications that are open source, specifically in the cybersecurity and network management domain. And these customers typically buy us for particular projects. So for example, some of the banking customers like Bank of America, Morgan Stanley, Jump Trading, Citadel, those companies have high-speed trading applications. Some of them are purchased by other companies. Some of them are actually designed in-house. They may buy our product for certain projects at certain times within their data centers to sell their services to their end user customers. Facebook, for example, uses us across all of their internal data centers for an open source cybersecurity solution called Suricata. And they've selected our solution to actually deploy across all their data centers to enhance the performance of that particular solution. Just to give you another minor example, NASA uses us in various ways. One of the projects that we're involved in is to accelerate a communications application for their Artemis Moon project. So we're used in a variety of different ways from an end user perspective. We love those kinds of customers too. They tend to be a little bit more volatile. They're a little bit more lumpy. They're not typically recurring. They may come back for a couple of quarters to purchase our product. But the balance between the two, we think, is a good balance. We expect to go to market over the next couple of years and maintain the type of balance that we have, keep growing the OEM business, and keep going to market through partners and channel partners and VARs to get at the end user marketplace. And I think it's a good balance going forward. Just in the middle, just to touch on it, we also work with key technology partners. Intel and Xilinx are two of the most well-known technology partners globally, building those super high-speed microprocessor chips called the FPGAs. Xilinx and Intel share about 92 or 93% of the FPGA market. And we're also collaborating with an up-and-comer called Achronix. These are technology providers, and in some cases, they're solutions providers or go-to-market partners, depending on how we develop those relationships. But those are some of the top technology companies globally in terms of building the technology that we leverage. Next slide, please. Just to give you an idea, I won't spend too much time on this slide, but every quarter we like to describe the kinds of customers that have purchased our products. The reason why I like this slide is it divides our customer base into different segments and categories. For example, many of our customers are in the networking and security segment, like LiveAction, IBM, Cisco, Polystar, Toyo Corporation, Viavi. These are companies that need high-speed performance and help them manage evolving threats within the security domain. We have other customers that are in the telecom and cloud domain. You can see that with Facebook and GoDaddy, but others, of course, like Orange and NTT and British Telecom and Mobileum. These are companies that are focused on service provider applications, and we're seeing a lot of new demand and increasing opportunity in the 5G area, where speeds are of greater importance here, and more user devices have to be managed. In the government and defense arena, we see many different projects emerging from time to time in various ways. Our goal there is to provide mission-critical application support and typically the need for what is known as zero packet loss, which is great for cybersecurity. And then in the financial domain, which has been a growing area for our business, high-speed trading applications and just the need for speed and security drives the attention span over there. So it gives you an idea that small Napatech based in Copenhagen does business with some of the largest players globally. And we don't just solve one particular problem. We solve many different problems in many different customer segments and domains in the networking and the cybersecurity space, and soon in the virtualization domain. Next slide, please. I'd like to share with you a little bit about the marketplace to give you an idea of where we sit within this particular market. I'd like to start on the chart on the left-hand side, and each of these bars represents the market size for what the industry analysts call Ethernet adapters, or NICs, a network interface card or a network interface connector. Pretty much everything that connects to a network has a NIC in it. The NIC is nothing new. It's been around for a long, long time. Your smartphone has a NIC in it. Your laptop has a NIC in it. Every server that ships globally has a NIC in it, because no device is valuable unless it's connected to other devices or other networks. So when the NIC market was originally conceived, the concept of a basic NIC, or that little blue bar on the bottom of these bars, was invented. These are super high volume, super low cost, super low margin parts of the market, highly consolidated and dominated by Intel. Intel basically makes the majority of these NICs. That is not a market that we participate in, but it's a valuable and important part of the NIC market. The other two bars or segments of the NIC market, the green and the orange segments, are offshoots of the original NIC market, and they're the ones that are growing more rapidly. I'm going to go ahead and talk about the two, the green and the orange, but we are going to specifically spend a little more time in the orange just to give you a sense for how that market is evolving. The green bar is known as the offload NIC market. This market also has been around for a number of years as more and more companies realize that the way you get more bang for your buck and the way you get more performance out of your server is to offload certain functions from the server CPU, which ships with the server, and you put it onto a NIC, something that you can plug into the server that can run certain functions over and over and over again at very high performance. The offload NIC was invented as a hardware-based solution, run with a solution on there, a processor called an ASIC, which is a hardware-designed piece of software. So it's software designed in hardware. And it performs the same function over and over again to offload certain performance challenges from the server to the NIC. So the offload NIC category has also consolidated. Some of the key leaders in this particular part of the market are players like NVIDIA, Broadcom, and there's a number of others. And its primary differentiator from the next category, which we'll talk about, is it's hardware-based. It's a hardware-based solution. The orange bar is known as the programmable NIC, or what we call in the industry a smart NIC. The real differentiator of the programmable NIC or the smart NIC is it's programmable. It's actually software defined. So it's not a hardware designed offload NIC. It's a software designed offload NIC. So you have the ability to modify it with software very easily. And it's dominated by two different types of microprocessors. One of them is called the FPGA, which is the one that we've focused on, and there's another one called the SoC. You'll see that on the right-hand side is the market share of all of the entire three categories that we see: the basic, the offload, and the programmable NIC category. NVIDIA, Intel, and Broadcom lead the pack in terms of market share. You see a number of major players that we all know. They're all name brand. And you also see Napatech. We are on the top 10 list. We're happy to be there. That's a place that we've entered into the space about 2.5, 3 years ago. And we're very happy to be on the top 10 list and listed with a number of other very large public companies. We know that this market is going to continue to evolve, but the real action is happening right now in the programmable NIC space. And I'm just going to point something out on the left-hand side, and then I'm going to dive in a little bit deeper. If you look at the programmable NIC market, the industry analysts expect that that part of the market will grow most rapidly over the next 5 years and will soon become larger than the other two segments combined. So the programmable NIC market is where all the new action is. It's being driven by two primary reasons. The reasons why it's growing so fast is that you tend to get a higher price for the solution because it's software enabled. So you get the benefit of software in that particular part of the market. And it's increasing numbers of ports being shipped. What's driving this market is a number of different use cases and applications, but we're beginning to see the acceleration of the investment in 5G as a major growth driver there. So that's the market we play in, is the orange part of the market. That's the segment that we are focused on. Next slide, please. So just giving you a little bit, you'll see that next slide in just a moment. Just focusing in a little bit more deeply on the orange part of that market. And I guess we're having a little trouble advancing the slide there. So, but that's okay. I'll just, it looks like we got it. Well, maybe not resolved. Okay, sure. It's all right. We'll continue. It's easy to see it. It's more visual to see it. But if you look at the orange part of the market, the programmable NIC market, and maybe this slide is corrupted. Okay, it's blank. It's okay. Well, you can leave this chart. You can leave that slide, and we'll just talk it through. If you look at the orange segment of the programmable NIC market, it's dominated by two major players today, Amazon and Microsoft. They are unique in that they've chosen to design their own smart NICs for the purposes of competing in the cloud domain, to be a higher performing cloud domain. They own about 50% of the market between the two of those companies. But the key issue there is that they don't actually design it and sell their product to others. They only consume it for themselves. So they consider themselves self-builds. If you take the remaining portion of the programmable NIC market, you'll see that shared amongst a number of different players: Marvell, Broadcom, Xilinx, Silicom, NVIDIA, Intel. All are shared within that marketplace, all focused on building businesses in the programmable NIC domain. Napatech is the #3 largest provider in this particular domain. We have, if you look at the total NIC, programmable NIC market share, we have about 4% of that share, and we're actually the 3rd largest vendor in that space. The two different kinds of technology areas that are focused on here is the FPGA and something called a system on chip, or an SoC. I don't want to get too technical here, but the FPGA, which is what we've selected, is the same technology platform that Microsoft Azure has chosen to accelerate their cloud infrastructure. And we're building software and selling our solution to end user customers. And we're going after the growth in this particular orange segment. The growth is going to be dominated by service provider investment, and we hope to activate that through some new investments we've made in virtual networking. So we're very happy to be. The reason why we show this to our investors is to demonstrate that we have room to grow, and we're doing everything we can to develop solutions to get active growth in that area. Next slide, please. So just to, I think we're going to go and so just to give you a sense of where things are going for the future, we believe Napatech is in a very unique position it's never been in before. We have a really solid core business we're taking to market with our current product line. We're delivering solid financial performance. The growth is not as high as we want it to be. We aspire to much higher growth than what we've been delivering in the past. but we're delivering relatively solid results on the current core product that we have. And we're using the benefits of the core solidity, if you will, the benefits of our financial position to invest in a new area we call virtualization, which I'll get into just a little bit. So next slide, please. So the way we're going to activate growth in a company like Napatech is, in addition to having a very strong core business, is to invest in a new technology area called virtual switching, to accelerate virtual switching in the new evolving network architectures. And the way we're going to get access to that market is through partnerships. So we have to build new partnerships to get there. So 2021 and beyond is really dominated by execution in the core, but building partnerships to get access to the new parts of the market that we believe grows faster. That's how we unlock growth. Next slide, please. The types of customers, the types of partnerships that we're developing, we've disclosed so far this year, are those like what I talked about a little bit earlier about Lenovo, a top server company that has selected Napatech to take their product to market. The product that they're taking to market is what is known as OVS acceleration. It's virtual switching acceleration, and it's exactly going to the direction of our future growth opportunities. We are also working with Intel in their new design area called the IPU, which is a new type of SmartNIC. And it is designed, the hardware is designed by Silicon, but it's all specified by Intel. So it's a three-way relationship, and we're working in the same area with network virtualization to accelerate applications in the domain for service providers and cloud providers. And we're also partnering with the new up-and-comers in this space, like Achronix, and so many others that you see on the right-hand side of this slide with our new design wins. The way a company like Napatech grows in the marketplace in terms of revenue is we have to design great products. We have to get them designed in to another company's product area, and then we have to go to market to win the business. And it takes time to get there, but once you get there, you begin to see revenue streams and revenue growth that is very, very useful to a company our size. Next slide, please. I mentioned this briefly, but Intel is one of many in the industry that is designing the next evolutionary step of a SmartNIC. It's called an IPU. The FPGA and the CPU work together on this little hardware device to actually enable a much higher level of performance. The goal here is to offload the entire network stack onto the SmartNIC from the server and basically accelerate 5G performance. So Napatech has already made this investment to get involved in this space, and we're very excited to continue to drive our growth in this area. Next slide, please. Oh, another little challenge. I think since we're going to run into a time crunch, I'll bring things to a close, and then we'll go to Q&A. I think that'd probably be the easiest thing to do. If we can get the slides back, we can go to some of the later slides. But I think from an investor point of view, why invest in Napatech? And I'll just conclude with that. This is a company that has a very strong history of developing solutions in the area of FPGA SmartNIC domain. We have a competitive advantage that we're leveraging, and we're trying our best to pivot that core expertise to some new areas for growth in what is a growing and viable market for us. Everything is becoming an application that runs on the server. Everything is going from hardware designs to software designs, and everything is running in a data center. So Napatech sits in a marketplace that is really in the spotlight of what's happening in the data center world today. And we fit within every server that ships to any sort of data center globally, and we are developing software solutions to activate competitive advantages for applications and cybersecurity solutions that run in data centers. So with that, I think we'll keep it short and sweet. And Eric, why don't we go to some Q&A?
Yeah, I want to ask a few questions around the virtualization opportunity that you're talking about, since this could be potentially transformational for Napatech. So could you try to explain what this opportunity entails in terms of the end customer needs, in essence, why the customer needs to adapt your solution, and also, a little bit more about how you're positioned to capture this opportunity?
Sure. It's so I used to work at Cisco. I was an executive at Cisco, and I was also in my prior life a very big customer of Cisco. And I'll use this as a case in point. When telecom or other companies were building networks in the past, they used to go to companies like Cisco and buy switches and routers. And switches and routers were hardware devices that were a combination of hardware and software that were really focused to perform some key functions in terms of switching and routing. Switching and routing is no longer a hardware solution. Now they are software solutions that run on servers, and networks are no longer designed as switches and routers. They're designed as applications running in data centers on servers. And when you take a look across the board of what's happening within networking, is everything is moving to the data center. All of the switching and routing is now done in applications, and now it's a matter of performance because speed and devices are going up dramatically in this domain. So you have to run this at very, very high speed, very high scale. The area that we believe that we have the most presence and opportunity to succeed in is in the area of helping the performance area get improved in the virtual switching part of that architecture. So we've been focused on building applications that run on the FPGA on the SmartNIC that take the switching function from the server and run it on the SmartNIC. And if you can do that, there's a TCO benefit to our end user customers. You don't need to buy more servers, you buy less servers, and you increase the performance of those servers by plugging our SmartNICs in them. So you save on how many servers you deploy, how much floor space you need, how much power and energy you need to consume. And basically you get a much higher performance profile out of your new network design. So that is, in a nutshell, what we're trying to achieve here with virtualization, Eric.
And so the next question then is, when can we, start to see revenues from virtualization opportunity, and at what stage are we now, and sort of what is the next milestone for the virtualization opportunity?
Yeah, we've been talking about our product strategy in this area for about 2.5 years. I first called it the 3-prong strategy, where our core 2 product areas were our first 2 prongs, and our risk area, our going big strategy, was our 3rd prong, and that's the network virtualization domain. And we've been designing this solution for a couple of years. And in order to get this product right, you have to work with partners and end users to design it. We can design it in the lab, but the most important part of the solution is actually when you get it into the lab and you actually get it into pilot scenarios. So we designed it based on our best guess as to what was going to be needed in the marketplace, and then we've been working with various partners. And this is where the time scale begins to change, because we can't control how quickly customers will consume our product. What we want to do is be in a position for them to use our product when they're ready to buy. And we've been working with the likes of Lenovo as a key lighthouse partner here. We're working with Lenovo, who is working with several end user customers that they sell their products to in the service provider domain. We're talking about some of the largest service providers in the world, so you can imagine who they are. And we are in active iterative development cycles right now with those end user customers as we continue to develop the software that they require and they begin to test the solution that they need. So it is an iterative process. It can take a couple of years, but we're no longer in the design stage. We're actually in the implementation stage and the testing stage. And we're optimistic that the work that we're doing is actually going to deliver revenue. So we're working towards first revenues here after initial design wins. It can take some time. We would like it to be sooner than later, of course. We're very ambitious here. But if some of these customers bite, you use the word transformational, Eric, the revenues here could be quite large. We're not talking about 10 units or 15 units. We're talking about 10,000 units at a time that could be purchased, high volume opportunities for us in the service provider domain. And we're actively pursuing it. And we're optimistic for success here.
And as you say, it could be a large opportunity. And that's why I guess you're also investing more in R&D now going forward over the next couple of quarters. Could you just briefly, before we finish, just tell us a little bit about what this investment entails?
Yeah, sure. The slide that's actually the backdrop it's a good slide, and I'll just pivot from that. So you can see our growth from Q3 was a 7% year-over-year growth rate, which delivered very solid results. But our aspirations are much higher than that. The opportunity, we believe, unveils itself with this investment area. If we're successful, could create very significant double-digit growth. The kinds of growth that we aspire to is 20 to 30% year-over-year growth. But even some of the opportunities could strip outstrip that kind of growth rate. We don't want to get too crazy and too optimistic yet because we have to get to first revenue first. But we believe that the kinds of opportunities that sit within our grasp are the kinds of opportunities that could have a transformational effect on our revenue stream. So we're doing our best as management to deliver a very solid business that you guys can feel confident in terms of how we're delivering and going to market. And we're also taking that solid performance and pivoting it into an area that we believe will deliver significant growth. And we are a player, and we are making progress, and we feel pretty good about where we're at. We are solving significant problems and bringing a real novel solution to the market.
Yeah, I think thank you very much for the presentation, Ray. I think that's all we had time for. And for everyone who listened in, thank you to you as well. Goodbye.
Hey, thank you very much, Eric. Thank you, everybody.
Thank you.